It is 9 a.m. here on the East Coast on this Monday, February 1st. I'm Julie Hyman with Miles Udland and Brian Sozzi. What a beginning to the week. Let's take a look at stock futures here this morning. Last week, U.S. stocks had their worst week since October. This morning, things are perking up a little bit, at least for now, with all three averages indicating a higher open. Reddit traders have a new target. It's silver. They may find, though, that the precious metal's a far cry from GameStop. We're going to have the latest action in the so-called meme stock trade. Plus, why that trade has held up a mirror on some long-running as well as some emerging trends from populism to market manias. We'll break them down. And the electric vehicle trade as well is hot. The CEO of Faraday Future is going to join us as the company prepares to go public through a SPAC deal. But first, let's talk about the latest with the so-called meme stock or GameStop trade, whatever we're calling it now. And I do want to start with what's going on with silver, because that seems to be where now the Redditors have trained their attention, and they're talking about going long silver. We're seeing big increases for the ETF that tracks silver. You're looking at it there, SLV, up 9% here this morning. Underlying futures are also higher. The miners are higher. What's interesting here is that this is a lot bigger than GameStop. So there's some significant differences here. The physical market for the metal is something like $32 billion. So that alone is larger than even the peak valuation that GameStop got to through all of this. Also, more investors are long. There's definitely not as significant a short position in the silver to get a squeeze on. Incidentally, one of those that is long on silver is Citadel Securities, which has been the target of ire on the part of some of those Redditors on that SLV ETF. As of the latest filing date at the end of September, they had 6 million shares. Citadel did. So that's 0.393% stake in that. So interesting here, some key differences. And, we'll see how this all turns out. Brian, I know that you've been watching the trade in those miners in particular as a sort of outgrowth of all of this.
Yeah, we're seeing the miners trade up here in the early going. Newmont Mining, Freeport-McMoRan, those caught a bid when we were coming into our morning meeting this morning. But I'm also watching, guys, where this money could be heading next. It's almost as if you have a whole gang of retail investors that have made a lot of money on a GameStop, a COS, a BlackBerry, and even Build-A-Bear the past 2 weeks, and now they're looking for the next target. And I just want to highlight the SPAC and new issue ETF, SPCX. That's catching a bid this morning, too, up 2%. And I wouldn't be surprised, in talking to some folks on the street the past few days, if the SPAC market is the next one to get the attention by these retail traders. Keep in mind, the SPAC boom was going on well before a lot of this recent this frenzied trading activity took effect. These are companies that don't have a lot of history. They're easy to speculate on. They have they've offered up, in a lot of cases, very big financial projections for the next 5 years. I can't think of a better target, Miles, really, to go to after GameStop than a lot of these speculative SPACs.
It's interesting, Brian. We were talking about this in our morning meeting and sort of wondering, when does this energy end? Because this energy in the market, you can feel it. It is a frenetic day once again, and we're really going on day 7 or 8 of this kind of tone being out there in the market. It's funny you mentioned Build-A-Bear. Maybe a missed part of the meme rally last week is it was all about stocks that had B at the beginning. Bed Bath, BlackBerry, Build-A-Bear, that became part of the meme. Now, it kind of moved on quickly, but that was also out there too. And I think to your point about silver and now that big journal story about SPACs and about where does it go next, what theme have we covered more on this show than everything in the market happens faster and happens more these days, right? So you're really outlining this scenario where it's just kind of this energy will come and go as fast as the market can possibly tolerate. And I do think we're starting to see maybe something like the end game. And I'll say it this way. I will caveat it this way. Robinhood is clearly still under a lot of financial duress because of the settlement issues that we're going to talk about all through this program and probably over the next couple of weeks that have affected that company. Just as we came on the air, Public, another stock exchange that's trying to compete with Robinhood, said they're going to no longer be part of payment for order flow. Basically, they're going to try to change their model. They don't want to be gamified. They don't like the hot money retail flows that have resulted from this. And we are starting to see the businesses, the platforms that were used to unlock some of these market hacks, if you will, start to roll back already. And we're only like 10 days into this entire episode. And so I think when we start asking what happens next, I don't think it's just a rolling series of these kinds of bubbles and bursts and bubbles and bursts. I mean, you've junior silver mining stocks up 130% this morning. It feels like this game of musical chairs probably lasts a little bit less long than people maybe popularly think.
I wonder if some of it will be a factor of people just getting bored with it and giving up on doing this or cashing out of their positions. We'll see. Something else I just wanted to mention as you talk about Robinhood and some of these other trading platforms is the latest status on the restrictions on these platforms. This morning, reportedly, coming into the session, 8 companies had restricted trading on Robinhood. That's down from about 50 at the peak. And when we talk about restrictions, it differs depending on the stock, but it means some restrictions on taking new positions in these companies. We should also mention that Vlad Tenev, who was on our air on Friday, was on Clubhouse, which is a new hot sort of audio / podcast / social app. He was on it with Elon Musk, and they had a conversation about all of this. And Tenev said that he sort of explained more about why they had to restrict trading and the sort of capital position that the company was put in, and that led it to take those decisions. So kind of interesting that he's been very visible through all of this, trying to do some damage control as the so-called, the Redditors have sort of turned against him.
And, I think also I'm surprised at how much, our producer Val just pointed this out, I'm surprised at how much he keeps talking. I'm surprised that Robinhood feels the right move here is to put their CEO out in extremely public places for 5 straight days, and to continue. And I know it's been explained by Vlad and by CEO of Webull was on our air, I think Wednesday or Thursday, probably had the best explanation of it. And that was before everyone all of a sudden became a DTCC expert, saying that they didn't decide that they couldn't allow trading in these names. They were told that they couldn't allow trading in these names. And I think it's very interesting. And again, none of us are PR experts. It's interesting as a PR strategy for Robinhood to continue to try to spin the story like they are actually on the side of investors when they're not on any side, Sazi. They're just being told what capital they need and what capital they don't have. And it appears for other people who might have an agenda about what the company does that they're coming down on a side of hedge funds or the government, whatever it is. I mean, that's just all kind of misinformation at this point. They're just told to follow rules that are put in place on how much capital is required to clear certain trades. And that's the mechanism here. And so it's very interesting that the company continues to put its CEO out there, and he continues to say this line like their mission hasn't changed. And I mean, their mission is fine, but right now, I mean, this is a capital crunch. This isn't time for a mission. This is time to survive as a business.
Miles, I would say, this strategy, this PR strategy or the comm strategy for Robinhood really falls into the category of can't lose strategy. First of all, Robinhood, it's not public. Not a public company. They have already proven throughout, I would say, their own crisis of the past week and a half, the ability to raise capital. And you have a company that, whatever, they're going to get attacked anyway on social media. So why not put the CEO out there in the hopes of maybe getting a little bit of sympathy? But again, you're seeing really the benefit here of not being a public company and why, again, I think Robinhood may not ever be a public company. It should just be a division of a larger bank.
And by the way, the Robinhood app is still the most downloaded on, I think, both on iOS and on Android still at this point. So hasn't slowed down demand for the app as all of this has been going on. Let's talk about the regulatory framework and role in all of this. We are joined now by Chester Spatt. He is the former SEC chief economist. He's now professor of finance at the Tepper School of Business at Carnegie Mellon University. Thank you so much for being here. This is a piece that we haven't yet talked about this morning, the whole regulatory piece. And there's been a lot of talk in Congress about what role regulators should be taking in all of this. On the part of the Redditors, of course, as always, there's some conspiracy theories about the SEC's role in all of this. What do you think the SEC should be doing, if anything, in this situation?
The SEC indicated late last week that it's monitoring developments, and I think that's extremely important in the current situation. Some of the issues that you were just chatting about, namely the capital needs of Robinhood, and the necessity and the possible necessity of the trading limits that they imposed, are certainly something the commission staff ought to be getting a handle on and understanding. What was the nature of the capital before this happened of Robinhood? Was it inadequately capitalized? What are the restrictions that they've imposed mean? For example, restricting, I'm not sure if I understand it, but restricting the gaming stock to one share. What sort of brings about that particular restriction? I think these are all important to understand, and the regulator at the same time, may be interested in understanding whether the Redditors manipulated the markets to produce an artificial price. It seems to me all issues are on the table, but these are issues for the staff, for them to explore. These at this point, they don't seem to me to rise to the level of lawmakers already trying to do an autopsy. I think first we have to let the SEC staff do an autopsy, and only later should lawmakers be debating possible changes in the regulatory framework. First, let's see what our regulatory framework did, and why did it do that, and to what extent were the actions of the market participants appropriate?
And, Chelsea, you brought up the issue of market manipulation. I'd love if you could maybe briefly outline how the SEC goes about trying to define when a security has been manipulated, because I think there's perhaps a popular misunderstanding that discussing that a specific stock constitutes manipulation of that stock.
No, well, I certainly wouldn't think that discussing a particular stock would be manipulation. It's been a difficult issue for the commission to define. I think of manipulation in terms of attempts to create an artificial price. But I don't think just communication, for example, that this stock is undervalued because there's the potential to a short squeeze. That in and of itself, it would not seem to me to constitute manipulation. But what the nature of the communications were, this is something also that the staff might be interested in understanding. So here we have an interesting situation. We have two forces knocking heads against each other. On the one hand, we have short sellers who felt that the earlier prices of some of these stocks and especially GameStop was artificially high. On the other hand, the Redditors saw that there was potentially vulnerability here to a short squeeze, and felt that the actions of the shorts were not justified, and so they pushed back. And so you have these two very strong forces. The shorts, to some extent, can be broken by a squeeze, and indeed, I think here they have been broken. But also potentially aspects of the risk management framework and perhaps broader kind of issues of market rationality may also ultimately put a stop to what the short squeezes try to do. Ultimately, a short squeezes end. Sometimes they end, of course, in great success. So here you have these two opposing forces really coming to loggerheads.
Chester, if you could put your broader business hat on now, what should the CEOs of a GameStop and a BlackBerry, these heavily shorted stocks, what should these executives be doing GameStop CEO is now worth $1 billion because he owns 4% stake in the company. But I mean, should they come out and say, hey, you know what? Yeah, I get the trading activity, but man, our businesses don't match up with this.
I might want to confer with a good securities attorney and decide if I can sell my stock into this, so I could liquefy my $1 billion. But I mean, in all seriousness, though, these are issues. Should they put out? I don't know. Do they have an obligation to put out an announcement? It's not clear to me that in terms of running their business that they necessarily need to. Now, we had a kind of a somewhat analogous situation last year that I thought was quite interesting. We had a situation involved, and maybe a little cleaner situation, involved Hertz. Hertz was in bankruptcy, and the bankruptcy attorneys for Hertz got the judge to agree that Hertz could issue new shares. Hertz was still selling for several dollars in bankruptcy. The equity was selling for several dollars, even though the value of the debt was only about 40 cents on the dollar. So basically, the capital markets were saying, at least through as it priced the debt, that these securities, that the equity was likely to have little, if any, value because of the absolute priority rules that are used in bankruptcy. And so the Hertz attorneys went to the bankruptcy judge and said, "Oh, we want to issue more equity." And the judge said, "Okay, go ahead and issue more equity." And they were planning an equity offering of about half a billion dollars. And then the chair of the SEC, during a broad-ranging interview on one of the cable networks, said that he had serious disclosure concerns. And within a few hours about the Hertz offering, and within a few hours, basically the SEC and Hertz met, and within a day or so, the offering was withdrawn. And the concerns basically that the SEC had were that the offering was going to be a violation of investor protection. But still, this raises a broader point about what executives whose companies are inflated up in the context of a short squeeze might consider doing. And one thing they might consider doing is if it's if the security attorneys opine that it's okay, to consider the possibility of doing an equity offering. I understand that there was some discussion by one of the major airlines at the end of last week to possibly view this as an opportunity, for example, to do an equity offering.
Yes, I believe it was American Airlines, and AMC definitely did an offering as well, which raises the question throughout this of how much you need to protect investors from themselves. We've got to leave it there, Chester. Thank you so much for your time this morning. Chester Spatt is former SEC chief economist and a professor of finance at the Tepper School of Business. Thank you very much.
Thank you.
Take care. All right, we're going to take a quick break now. When we come back, we will talk about the latest in Washington with stimulus. Stay with us.
All right, welcome back to Yahoo Finance Live on this snowy Monday morning here in New York City. All the attention in markets is on what's happening in GameStop, some of those other retail names. That saga continues and is certainly not going to be resolved today, maybe not even this week. But in the background, we still have negotiations or discussions, I should say, underway down in Washington, D.C. on what the next round of stimulus may look like. Yahoo Finance's Jessica Smith joins us now with an expected meeting on this topic between some Republican leaders and the president.
Right, Miles. A group of 10 Republican senators is going to meet with President Biden later today. They wrote him a letter over the weekend asking for this meeting and proposing a $618 billion plan that they say can get bipartisan support and can move through Congress quickly. Just in the past few minutes, they actually released the full details of that plan. It will include $160 billion for vaccines, testing, tracing, and PPE. It has $1,000 stimulus checks, but they would be more targeted than the previous direct payments we've seen. It would also extend current $300 a week in enhanced unemployment benefits through the end of June. It would have $4 billion for behavioral health, substance abuse services, and then $40 billion in funding for schools and childcare, as well as money for small businesses. It does not include the $15 minimum wage that President Biden has been pushing for. That's something he really wants to see in a stimulus package. But the White House did quickly accept the offer of a meeting. They said they'll have a full exchange of views. And the White House press secretary said in a statement, with the virus posing a grave threat to the country and economic conditions grim for so many, the need for action is urgent and the scale of what must be done is large. Julia Miles, she went on to say the danger is not doing too much, but doing too little. So we'll see if this group today can find any common ground to move forward.
And Jess, if they cannot, do the Democrats then have sort of a backup plan to try to get something through without Republican support?
They do, and they're moving ahead with that backup plan today. In that White House statement, we found out that President Biden did speak with Leader Schumer and Speaker Pelosi yesterday, and he thanked them for getting to work on laying the groundwork to pass his $1.9 trillion plan. This week, they're going to consider a budget resolution, which is the first step in the reconciliation process, which allows Congress to pass legislation with just a simple majority vote. But we should note, even that is going to be difficult because the Democrats have to satisfy every single member of their party, including Senator Joe Manchin, who is very moderate, and Senator Bernie Sanders. So that's going to be an uphill battle as well.
All right, Yahoo Finance's Jessica Smith with the latest on discussions down in D.C. Jess, we'll talk to you later this week. All right, again, futures pointing to a higher open here on this Monday morning. The action still remains in some of those retail-heavy names. Continue to see changes across platforms here as really just this bizarre, strange, compelling, fascinating, unique market moment continues here. We're going to have a lot more coverage coming up on the other side of this 2-minute break.
watching Yahoo Finance Live. I'm Julie Hyman, and we are preparing for the market open in just a few minutes here. It looks like we're going to get a rebound in stocks. To talk more about it, let's bring in Andrew Macy, Sixth Meridian Chief Investment Officer. Good to see you, Andrew. So as we watch the setup this morning, of course, there's still a lot of attention being paid to the Reddit trade and now what's happening to silver, although we're also seeing some action in the heavily shorted stocks like GameStop. So we've been starting most people there. We should probably start you there as well, just to see how you're incorporating this or not into your strategy here. But something else you said in your notes to us, which kind of maybe keys in with this, is that the market doesn't seem to be worried about anything right now. I mean, last week's drop notwithstanding, things still feel pretty Teflon.
They do, and thank you for having me. I can tell you this weekend when I saw the few people that I did see, there weren't many people asking about anything other than GameStop and how to do short squeezes. And so I think to your point, this can continue for a while, but eventually it probably does burn out as these things do over time. But it goes to that point I was talking about, the concern or the wall of worry. And I think back to last September and October, and when we talked to clients, people were worried about the virus because at that time we didn't know anything about the vaccines. People were very worried about the election and what the outcomes were going to look like from that. We didn't have anything in terms of a stimulus deal passed. And so there were a lot of things that investors were worried about. And today when we're meeting and talking to clients, there's very few things. Everybody's absolutely certain that 21 is going to be a complete bounce back from what 2020 saw. And there's no doubt that the vaccine is going to work. And so I do think that there are a little bit of complacency setting into the market.
Andrew, among other things you focus on at your firm, you do have a focus on small cap equities. Have you traded a GameStop? Have you traded a Cost? Have you traded a BlackBerry? And if you haven't, why or why not?
We have not. So our models are pretty quantitative in terms of telling us what we should buy and what we shouldn't. I will tell you that we have, in our small cap strategy, we owned MicroStrategy, not because we thought that they were going to go buy a lot of Bitcoin and the stock would go up a lot. There were other reasons that we owned it, but that's been a big driver. And I think that if you look at like the S&P 600, the return it saw last week, which was driven significantly by its position in GameStop, and the Russell 2000 as well. It's just not what we do in terms of chasing into that. We look at things on a more fundamental basis, but there are residual impacts that have helped some strategies, no question about it. We had one client who did own GameStop. It was a remnant position they'd had from a long time ago, and when we called them and told them about it, they were pretty excited. I think they ended up selling it.
You know, Andrew, I think everyone's trying to figure out what role retail is going to play going forward after this is all over. And we've seen retail come back in the market in 2020, or we saw it come back in 2020, but it was really like a 2-decade break between retail being a big part of this. I mean, have you started to think about what a more retail heavy market could look like? Not today, this is kind of crazy, but in 5 years, 7 years, even 15 years.
Yeah, you're exactly right on the timing. One thing that's been interesting for me is I have a 16-year-old son, and he and his friends on his cross-country team, when they run, they used to talk about music or friends or girls. Now, when I ask him how his run was, he comes back and he tells me they were talking about stocks and what stocks they should buy. And I think that's actually that's a net positive, is that getting more people informed and knowledgeable about investing, and also trying to explain to them that the long-term benefits from being a consistent investor can be significant over a lifetime. So I think that there's some net positives for the retail investor getting more engaged and more involved.
It's funny. That's actually something that Miles has been saying as well. And just wanted to mention, we've got the opening bell there happening, and as trading gets underway this morning. Do you think that lesson is taking, though? I mean, I guess if you use your son as an example, because there is so much noise around the sort of quick pop, get rich quick nature of the meme stocks and of trying to chase that trade, do you think people are going to be more, scared by that lesson, or will learn from that lesson, or are they going to try and duplicate that to their peril?
Yeah, you're exactly right. Because right now people want to know what stock's going to double tomorrow, not what what company or industry can I own and in 10 years or 15 years made a reasonable return. But anything that sparks interest in the financial markets and causes people to be more educated. I was talking to somebody over the weekend, a niece of mine, and she was explaining to me all the research she's done about short squeezes and what shorting means. And so the more education and more knowledge, I do think is a benefit. But you're right. Right now, everybody's focused on what is the next stock that, to put it simply, is what's the next stock that I can own that's going to make me a lot of money quickly. And that we know ends up fading. We know that that's going to pass because at the end of the day, everybody has, all those GameStop shares have to be owned by somebody. And the people who own them today probably aren't looking out 5 years from now and doing a discounted cash flow model and saying, I really am excited about the prospects. Eventually, somebody has to own the stock because that's why they want to own it.
Yes, indeed. And we'll see who those people are. Andrew Meese, good to see you. Thanks so much for your time this morning. Six Meridian Chief Investment Officer. Appreciate it.
Thanks for having me.
Thanks. Well, as we mentioned, stocks are now trading. Let's get an update on what's going on here as we see now a rally after last week's declines. Jared Blickery is with us with the latest. Jared.
We're looking at some gains across the board here from small caps to big caps. NASDAQ is leading. Interesting situation. We'll go over the sector leadership here on the Wi-Fi Interactive. You can see the Russell 2000 up 1%, NASDAQ up the most, just over 1% here. We'll take a two-day look to see that opening pop, almost recovering Friday's dip. So let's take a look at our heavily shorted heat map because that is what people are interested in seeing. And we got a couple additional members today from silver, which we can talk about if we have a little bit more time. But here's one, for instance, Albino Silver and Gold Mine. That is the top of our list today, up 100% in early trading, followed by AG. That's another silver play, Sundial, and then AMC up 20%. GameStop, it looks like, I'm just looking for on the screen here, that is down 9%. You take a look at what it's done over the trailing month, still up 1,400%. Now, here's a look at the sector action today. And now we have tech and discretionary in the lead. So that's a little bit of a change here. Materials and industrials still outperforming. So cyclicals and big tech in the same boat. Looking at some of the other sectors here, we got travel. Those shares are popping here. We got Southwest is up over 1%. Royal Caribbean right there with it. Hilton also up over 1%. And then in the banking sector, most of these earnings have been trailing out here. We got JP Morgan, Bank of America, and Morgan Stanley and Wells Fargo each up less than 1%, guys.
Jared, let's talk a bit about what is happening in the silver market. And of course, you are a historian of markets. It always comes back to silver in the end, right? When all manias eventually find their way to the silver market. But, you highlighted for us that the actual price of silver is being influenced by what's happening in the ETFs and the miners that are related to silver. And it gets us to, and I know we're going to talk about this probably with Steve Stosnik of Interactive Brokers in a bit, but it gets to that interplay between the derivative, so that would be the ETF or the company, and the actual object itself, in this case, actual silver.
Yeah, actual silver. And just looking back in history, we have seen the silver market attacked at various times. The Hunt brothers stand out in the early 80s, or maybe it was late 90s. But here we have a short squeeze going on in silver. And let's take a longer term look. Over the last 6 months, silver largely trading sideways. But here's what I want to point out. These are silver futures here. We already had a technical setup where it looked like silver was a market that could break to the upside. So I think it's remarkable that Wall Street Bets is now influencing an actual commodities market, as you said, by really attacking some of these smaller names, silver miners, but also the SLV ETF. So we're taking a look at Avino Silver and Gold Mines here, up 131% over the last 6 months, most of that happening just today. So I think it's remarkable that we're seeing these kinds of breakouts here. And even if GameStop, that trade falls by the wayside, we're going to see, and we're going to want to concentrate on some of these smaller markets that are that have been consolidating and may just be poised for a breakout here.
Maybe. All right. Thank you. We'll continue to watch that trade. Appreciate it, Jared. One other stock that we watch pretty consistently is Tesla. And as we take it a break, just wanted to take a look at that. It's up 4%. And that's after the stock got its highest target on Wall Street, $1,200. Piper Sandler's Alexander Potter just increased his price target. In fact, more than doubled it to $1,200. We've seen a number of different analysts raising their price targets on Tesla as of late. So that's just the latest to help fuel that stock's rise. By the way, Tesla had something of a short squeeze as well, although a lot of the shorts then were squeezed out. We'll be right back with much more.
All right, welcome back to Yahoo Finance Live on this Monday morning here in New York City. Markets higher across the board as we get today's trading underway. But of course, the big story remains everything that is going on with the retail trade, GameStop, Robinhood, sort of pick your poster child here, silver star of the show this morning. But over the weekend, Yahoo Finance editor-in-chief Andy Serwer wrote about the 5 big trends that this mania or this event really speaks to. And so, Andy, let's start with one of them, which is populism. And I think that I'm curious how you see that unfolding, because everyone can kind of apply their own populist lens to this event. And I think any spin that people have on it really leads down some fascinating roads.
Yeah, I think that's right, Miles. I mean, the bottom line is here that retail investors were always sort of the joke on Wall Street, and they were always wrong. But, part of this phenomena is that retail investors are right. They're driving these stocks up and encouraging their friends to get in, and then they're making money. Of course, how long is this going to last? The other line I heard someone say was from a hedge fund person was that 2020 was a bad year for humans and a great year for finance. Well, guess who's taking revenge right now? And, I think the WSB people, this is not a secret, but they're feeling all these years of being maligned by the system, and that they are sort of getting their torches and their axes and sort of storming the castle. And in a way, they are sort of parallel to the Bernie and Trump people. You don't want to take that too far, because there's obviously not an equivalent between storming the Capitol and, picking up on a short hedge fund. But people are discontent with elites in America, you guys.
Yeah, they are. Although ironically, on this trade, I mean, there are certainly hedge funds on their side of the trade also, and with the silver trade as well. Citadel Securities is one of the biggest longs on the silver ETF that the Redditors now seem to be buying. But you mentioned the sort of political connection here, and this is something that this has reminded me of as well, the sort of populist trend that we have seen in politics. So what are some of the parallels that you're watching there? And then what does that tell you about the sustainability of what's going on?
Yeah, and these trends are connected, Julie. And so, with the government, there's a couple things going on. First of all, I think that this transition from Donald Trump to Joe Biden has been underestimated in terms of the impact on the markets. I mean, it's just not going to happen. You've got this pretty big, abrupt change without any market dislocation. And some of that has to do with the fact that hedge funds had such a great year last year, up 20 and 30%, some of the biggest ones. So these long short hedge fund managers, places like Citadel on the other side of that business, Coatue, et cetera, they were looking to unwind these positions simply because they were concerned about the trade. Also, of course, government, another big government influence here is that Biden and Yellen are looking to flood the zone with liquidity. So that's part of what's going on as well. And then finally, governments like to investigate. So, we've seen, of course, that AOC and Ted Cruz are all up in arms together. They were in concert for 58 minutes before they started squabbling again. Elizabeth Warren, the SEC, Letitia James, the AG in New York, and Sherrod Brown, Maxine Waters, they all want to investigate. So there's a lot of, rattling of sabers there. What they need to do or will want to do is, of course, up in the air.
Andy, in talking to folks for this story, did you come away with the sense that there is systemic risk from this frenzied retail activity we've been seeing?
Yeah, I mean, that is arguably the biggest question here. And, people look at it two ways. One, this is uncharted territory. So by definition, there's systemic risk. And, I said this is got to be in the Black Swan Hall of Fame, right? I mean, no one saw this coming. I'm sorry, maybe someone did, but I'd love to talk to them. So there is that. On the other hand, if you look at, say, the market cap of GameStop at its highest, it was, less than 1% or about 1% of Apple's market cap. And then you add all the rest of them up and it's pretty inconsequential. But the rattling that's going on to the status quo suggests that, this time is different. So that's a little bit unsettling. And the hedge funds, their unwinding of positions is now pretty much equivalent to what it was in March of last year. So that's a big deal.
Yeah. And I think, I don't think the size of a market cap or the size of a trade, certainly, as you know, Andy, going back to long-term capital management, certainly shows that the size of a trade need not preclude it from becoming a systemic event where a lot more things happen. And I think we're sort of just seeing the beginnings of what may be the fallout in this specific situation. All right, Yahoo Finance Editor-in-Chief Andy Silver. Andy, appreciate you joining the show this morning.
Thanks.
All right, as we head to break, check on markets here. All three majors are higher in the early going. Let's see, we've got the NASDAQ leading the way, up more than 1%. But again, silver, big story today. And what a story it is. I really just cannot imagine how much longer this silver play has to go. But then again, the idea was hatched on Saturday night, and here we are 2 days later, seeing it play out. So we'll see how things unfold as we get through today's trading session.
Well, the luxury electric car maker Faraday Future recently struck a deal to go public in a SPAC transaction, merging with Property Solutions Acquisition Corp. The combined company will be valued at around $3.4 billion, and it's set to close in the second quarter. The CEO of Faraday Future, Karsten Breitfeld, is joining us right now to talk with us about the deal and about the plans here. Karsten, thank you for being here. There was also the recent news that you were talking to Geely, the Chinese car maker, about them potentially contract manufacturing your vehicles. And so the two pieces of news together, I just wanted to talk to you about the timeline for when we will start to see Faraday Future cars. I know that you have a number of people who have orders in. When are they going to get their vehicles?
So good morning. First of all, thank you for having me here. Yeah, we are going to launch our first product, the FF91, here in the US, out of California, 12 months after the deal closes. So the first product will be shipped from the US to the rest of the world. And then you were mentioning Geely for our market entry in China. We are setting up a joint venture. We are discussing a setup of a joint venture, and Geely will be one of the partners there, which will give us, which will speed up our market entry into China.
Karsten, can you explain? I mean, Faraday Future has been around for a good bit. But it has gone through some troubles here. You were recently brought in to really drive the company's vision going forward. But the founder, Jia Yuting, he's still now he's the chief product and user officer. He ran into some financial difficulties last year. What is your relationship with him, and what's his role in the company right now?
So Faraday Future is, I think, the only company in this field who bring two worlds together, which is the car industry, the car world, the car experience from one side. I have 25 years in this industry. I spent 20 years with BMW. I made the BMW i8 program become reality. And Jia Yuting is coming from the internet side, from the user ecosystem side. And these are the two DNAs of our company. And together, this creates a strong product and strong business models. When I came in 16 months ago, we had to do some changes in the company. We focused it more on execution. We had to rework the governance. The founder had to resolve some personal situations and personal issues. But now this is all gone and all behind us, and we are looking very much forward to launch our first product with the proceeds of this transaction we just announced.
When do you plan to start making a mass market car that would rival a Tesla Model 3?
So, we are building a top premium brand, and a top premium brand always starts with a halo product. So the first product, the FF91, will be top luxury. It will shine. It will define the brand. And then maybe around 18 months later, you will see the next product going down one market segment and competing more in the Tesla Model S and Model X area. And then after this, we are going to have a third product, and this will then address the real market, the real volume segments like Tesla Model 3 or Model Y.
You know, Karsten, you mentioned your experience with BMW and your involvement with the i8 program over there. I'm curious, given that experience, why right now is the moment that it seems the electric vehicle future is kind of arriving. I mean, it seems like the acceleration point is here. And, what were the challenges for the industry, whether it's traditional OEM or Tesla or, Faraday, getting from kind of concept maybe 10, 15 years ago to the point today where I think a lot of consumers are going to have access to these vehicles sooner than maybe they think?
This is funny. A couple of years ago, when I still was at BMW, everyone told me that Tesla can never be a successful company for several reasons. If you look to the valuation today, then the valuation is more than all the premium car companies together. So things are apparently changing. We are at a pivot point right now. And you know that some of the biggest economies in the world, they're discussing bans of gas cars by 2030. 2030 is 9 years from now, and this is a little more than one generation of cars. So the markets are changing completely right now and at a very high there's an exponential growth coming up, and this puts company like us in in a very good position. Now, Faraday is differentiated from other startups. We are very close to production. It's less than 12 months to go. We invested up to $2 billion up to date into technology and into products. So we are not a startup in that sense, and we think that we can have a very, very strong market entry very soon.
Carsten, so Faraday won't have revenue this year. Now, you are planning to go from no revenue this year to $21.4 billion in revenue by 2025. In 2025, how many units are you making to drive close to $22 billion in sales, and where are the bulk of those sales coming from? Which market?
So, I'm German, and I'm engineer from my background, and German engineers always have a certain work ethics. And this is under promise and over deliver. So the business plan we have right now is quite conservative. I personally think we can do more than we have in it. So we start with quite low volumes, and then we scale to a couple of 100,000 units by 2025, which, given the markets, how they develop right now, is absolutely realistic. If you ask about the market split, then we are a global company. As said, we are going to launch in the US and California. We are going to deliver from California to the rest of the world in the beginning. Clearly, China is the most important EV market right now and will continue to be this. So I expect that maybe something like 50% of our volume on the midterm will go to China, and the rest will be split between the US and Europe.
Carsten, thanks so much for being here this morning. I know it's early on the West Coast, so we appreciate it. Carsten Breitfeld is the Faraday Future CEO. Hope to catch up with you again soon. Thank you.
Thank you for having me. Have a nice day.
And speaking of auto manufacturing, just wanted to mention some manufacturing numbers overall coming in just a few moments ago. PMI, IHS Markit's PMI reading of January manufacturing coming in at 59.2. That is the highest reading since they began taking this measure back in May of 2007. We have talked a bit about how the manufacturing part of the economy has borne up better than services, as you might imagine, with people buying stuff versus going out and doing stuff. So again, we're seeing that rise. The output prices, by the way, also on the rise, and the highest reading since July of 2008. So interesting report there. We're going to take a quick break. When we come back, more on what's going on in the markets.
All right, welcome back to Yahoo Finance Live on this Monday morning. Stocks are higher, but we are coming off the highs and just seeing a little bit of pressure in some of the squeeze names. GameStop shares had been off as much as 20%, seeing it down about 13% right now. So some pressure out there in the market. And Brian Sazi, this as the market comes off its worst week since October. And even though earnings have been quite good, and Julie just mentioned those really stellar manufacturing numbers, the market right now does appear to be in a bit of a spit of bother.
Yeah, it wouldn't be surprising, guys, if this de-risking continues in the market. Really, the market under a lot of pressure this week, last week down 3%. And let me call attention to this note from Goldman Sachs out this morning. He said last week represented the largest active fund degrossing since February 2009. Essentially what that means, hedge funds selling a lot of long positions to help counteract some of their short bets, which clearly went against them. But Goldman does note, despite this active deleveraging, hedge fund net and gross exposures on a mark-to-market basis both remain close to the highest levels on record, including ongoing risk of positioning-driven sell-offs. And we have a chart here to really show how long hedge funds continue to be in this market. And if these shorts could continue to go against these hedge funds and a lot of other institutions, you could see them sell a lot of their long-term holdings just to fund what they're seeing or what's happening to them in their short positions. And I think some of this risk that we're seeing, and Andy was talking about a risk, systemic risk, and I would characterize that as this. You saw the weakness in the FANG stocks last week. FANG, Facebook, Amazon, Apple, Netflix, Google. These are some of the most over-owned names in the entire stock market. And so to see hedge funds selling some of their favorite stocks to offset these shorts is alarming, and it should be alarming. And I think when you see days like today, where you see the market up a little bit in the first half hour of trading, you have to question, is that sustainable given where the mindset of institutions are right now?
Yeah, and I think also, Sazi, it's challenging, though, because when you look at that kind of increase, in net exposure, that's also in reaction to being underexposed during a 30% rally back in 2019, having to delever during the sell-off back in March, and so, again, being too underweight the market as it started to rally. And also this notion, if we are indeed at the beginning of a new economic cycle, why would you be afraid of stocks? And I think this event might scare some people in the near term, but until we start hearing talk about actually this isn't the beginning of a new economic cycle, and I'd be curious to see who or how that case would be made. It's going to be, I think, difficult to get folks to really start changing how they're thinking about their setup. And this also comes on the backdrop of a decade when the hedge fund community has underperformed, seen fees go down, and really just taking it on the chin as an asset class at large. All right, a lot more coming up here on Yahoo Finance Live. On the other side of this break, stocks remain higher, off our best levels of the session on another wild day in markets. We're back with more in just 2 minutes. All right, 10 o'clock here in New York on this snowy Monday morning. Welcome to Yahoo Finance Live. Miles Udland here, joined as always by Julie Hyman and Brian Sazzi. Let's take a look at the major averages about a half hour into today's trading session. We see that all three majors are higher. The NASDAQ is leading the way, but we are seeing stocks come off that open where we saw all three majors up better than 1% at one point. GameStop, the retail trade, Robinhood, all that good stuff continues to be a big story within this market. As we mentioned into the last break, seeing just a little bit of pressure in some of the I guess we're going to call them old timers within this group. That'd be the likes of GameStop, got your Bed Bath in there, National Beverage, all of those off more than double digits. The new entrants here, number of those stocks in the green. We see SLV, that is the silver ETF. AMC, our old friend, also up 14%. American Airlines off about 3%, seeing that trade kind of level out. Of course, American and the airlines, they've been involved in all kinds of short business, reopening trade, industrial, so on and so forth. American Airlines coming to market last week for about $1 billion worth of stock. And so, again, I think that story may be leveling out amid some of the other goofiness that is happening here with a number of these names we're looking at on the screen. But let's stay on the market and talk a bit more about everything going on. Joining us, old friend Steve Sosnick. He's the chief strategist over at Interactive Brokers. Steve, where do you want to start with this whole thing? Because the story seems every day to kind of change, and what we know, what we think we know, what it means, what it doesn't. As we sit here today, what's your biggest takeaway so far from this entire Robinhood Reddit short squeeze saga?
Well, first of all, good to see you, Miles, on a snowy Monday. It's a very tough takeaway because there's so many moving parts here. I guess my biggest thought is there's nothing that's that new about this. There have been short squeezes ever since there have been shorts. There have been manias even before that, probably. And what I think the difference now is it's the nature of it. In each different bubble or mania, whatever, the methodology changes. We're not getting tulip bulbs from Turkey this time. We're getting stocks that had been left for dead in the malls now. And well, actually, that was last week, and now we're finding silver stocks that are it's the silver that's in Grandma's attic. Is now what's rallying. It changes, but I think the difference is, it's moving faster and in a bigger way because of technological changes, the changes in social media. We're not using Yahoo and AOL message boards that we did in 1999. We're using Reddit and other forums. It's an older game. It just changes form every so often.
And Steve, it's good to see you. It's Julie here. So, do you think that the Redditors reported sort of ire at Wall Street, or, feeling like the system is stacked against them? Do you think that is misplaced? Is that similar to some of the manias that we've seen in the past also?
Well, Julie, there's two parts to unpack. I think what we're seeing actually is populism in the markets. I in a piece I wrote not that long ago, I compared it to the run at the Capitol. It's that same sort of anger manifesting itself, and this time through the markets. I do think it's misplaced because, if your enemy is Citadel, they had I assume they had a fabulous week market making in these same stocks that they were trying to rip them on. This is a much more subtle feature than stick it to the man. This is actually a very poor way to stick it to the man. I have zero problem, absolutely love the fact that individuals are coming into markets and see them as an opportunity to make money and as a source of investment. What frustrates me is that they're kind of getting abused, and that there will be a lot of little guys left holding the bag when this is all done. And that's the very frustrating part. But I think this is, one of the differences is that we have a populist mindset throughout the country and the world right now, and this is one of the ways it's been manifesting itself.
You're right, Steve. A lot of the small investors will eventually be hurt. And on that point, if you're an executive at a GameStop or a BlackBerry or a Koss Corporation, nobody even heard of that company 3 weeks ago, how should you be communicating with investors right now?
Well, Brian, I think some of it is there. It's a little bit tough. I think what AMC did is was right out of the playbook. You know, the stock got moving actually there because of fundamental good news. They avoided going bankrupt. That is pretty much the ultimate good news. You know, they then used that rally to sell enough shares that really paid off the bonds that prevented them to go bankrupt in the first place. That's fabulous. From what I understand, I believe GameStop is in its quiet period ahead of earnings, so I think they can't really do much. I mean, if I were these companies and could, it would seem logical to sell into some of these valuations. It doesn't make. If you thought GameStop was maybe a bit undervalued at 17, it's kind of hard not to think that it's a bit overvalued at 300-ish. So that would be the way to go. And I don't know about the messaging, but the fact that it comes at earnings season, I think makes it harder for a lot of these companies to message, because in some cases they can't say much with earnings expected soon. So it's a weird irony.
Yeah, and I want to talk about one of the targets now that's not a company at all. Although to your earlier point, by the way, about this being a poor way to stick it to the man and Citadel's returns, interesting note in one of the stories this morning about Melvin Capital's losses in January. The same story said Citadel's returns fell 3% in January, but it was very specific. It's hedge fund returns. It did not talk about its overall market-making returns. But let's talk silver for a moment. How is this trade going to play out? Because silver is a whole different ballgame than a little one-time penny stock like GameStop.
Yeah, doing this in a commodity is going to be very different. So, you know, if people are attracted to the trade because there are some small silver stocks that have short interest, or the SLV ETF has high short interest, that's only a fraction of the puzzle here. The difference between a physical commodity and stocks is that, first of all, physical commodities are much more pure supply and demand, and you would think that should benefit, you know, this wave of investment coming in, because that's pure supply, pure demand versus supply. The problem is supply comes out of the weirdest places. And I actually did look up the Hunt Brothers saga of the late 70s, early 80s. I heard Jared refer to it earlier. So it's older than he thought. It's the late 70s, early 80s. And you know, I was not in the markets at that point, but my dad was, and I remember hearing about all this stuff. And you know, one of the interesting situations is they got the commodity moving. They used a ton of leverage through futures and options, not options, really futures. But then guess what happened? The clearinghouses basically put position limits and stopped new purchases. Does that sound familiar to anybody? Yes, because clearinghouses have to protect themselves and their members in the system. And eventually it started to fall under its own weight. And one of the things that's interesting about my company, you know, which Interactive Brokers now started as Timber Hill, but Thomas Petterfee worked for a guy named Henry Jarecki, who ran a company called Mokata Metals. This is how he got started. And I'd heard crazy stories about him paying toll authorities, you know, 10.1 cents for all their dimes, because some of the dimes had silver. Silver can come out of the weirdest places. There's silver in all kinds of people's attics and basements that the families have been wondering what to do with. So this is going to be a very tough one. It's not like Bitcoin we created out of thin air. It's not, or it's mined virtually. It's not a stock where a company sort of has supply and demand, but you know where all the stock is. You don't know where all the silver is. It's in all the weird places, and a lot of it's controlled by industrial users who are non-financial, which is, so it's you're really getting far out over your skis. And the biggest worry here is this one's been tried before and failed, and there's an actual playbook for this, and it's really easy to read up on this. Anybody who sort of came into the industry in the late 80s, you know, in the 80s, this was still in the collective memory. But, you know, so it may have been forgotten, particularly to some of the younger people, but this is there. It's an interesting feature.
And, you know, Steve, just quickly before I let you go, coming back to the stock market and some of the dynamics that really came up last week, we've all now had to become quasi-experts on T+2 settlement and sort of the role that plays in the actual execution of trades. Certainly something that, you know, this is the core of Interactive Brokers business. Where does that fit into this story? And do you, I mean, there's calls now for we need to go to T+0, but I feel like people have no idea why T+2 is important and what it's there to really do.
Well, T+2, just for the viewers who aren't used to the terminology, means that you buy a stock today, you pay for it in 2 days. The settlement occurs in 2 days. Now, from talking to clearing people over the years, they want this period shortened. It's been getting shorter and shorter over time. It was T+5, then it was T+3. Each day that you take out of the settlement cycle, in theory, reduces the risk to the system because there's that much less that can go wrong in 2 days than in 5 days, for example. Although I think what we're seeing now is there may be some advantages to not having it go T+1 or T+0, which I guess is theoretically possible. If you use blockchain, in theory, you could do it in T+0, but I don't even want to get into that one. But what I realize now is I think that T+2 gave the system a little time in which to orient itself. I think, without going too much, I think that these clearinghouses were able to see what was going on, what was anticipated in terms of liabilities and deliveries and money that was coming down the pipe, and allowed some of the brokers that might have had some issues in that regard to adjust. This points out the difference in capital. I can't speak too much to it, but a well-capitalized broker didn't have a lot of problems with obligations, but had problems with the clearinghouse imposing those obligations, and in terms of worries about whether all the clearing members could settle on time, because a failure by one member is borne by the other members in the clearinghouse system. And so what I think we're going to get some interesting debates. There's going to be a lot of stuff that's brought up in terms of regulatory cycles, in terms of Congress. Not all of it pleasant for the industry, because a lot of it gets poking around in places you don't expect. This is going to be one of the more arcane elements that's going to come up. And I think we're going to start to hear from some people who are much more expert in the clearing process than I will. What is the right amount of time? Is it T+0? Is it T+1? Is it T+2? I think the industry sort of did reasonably well here with T+2, despite all the the obvious issues in terms of some of the worries that went into with stocks getting halted essentially and things of that nature.
Yeah, and I think Robinhood's mission, they say it's democratizing, but they kind of gamified trading in the market, and I think we found out it's not a game. And next time when we have like 3 hours, we can talk about whether the industry's building the foundation on margin even makes T+0 possible, because margin requires a certain amount of time to actually score out. But Steve, we'll save that one for maybe a couple of years.
I'll look forward to having a full hour with you on that one, Miles.
There we go. All right, Steve Sosnick, Chief Strategist over at Interactive Brokers. Steve, always great to get your thoughts.
Thank you.
All right, let's turn our attention now to what's going on in overseas markets, where, last week for a time, we didn't see a huge impact from some of the Reddit craziness happening here in U.S. markets. But silver, certainly a storyline over in European markets this morning. Latoya Harding joins us now for more on this story.
Yeah, stocks in Europe are bouncing back today in what is the first trading day of the new month. Now, last week, we saw the worst 5 days of trading since October, but that gave investors a major opportunity to buy since the sell-off. Major indices, the FTSE, the DAX, the CAC, they're all more than 1% higher today, and amongst the best performers are those in the mining sector, pushing indices even higher. And of course, as you said, that's on the back of one of the big stories today, silver prices hitting their highest levels since 2013, pushing beyond the $30 an ounce mark, and that retail frenzy that we saw last week with GameStop and AMC spilling into the commodity. Now, drilling down into some of the companies that have surged higher today, we've seen Fresnillo up as much as 20% at one point, with Polymetal, Glencore, Anglo American also among some of the front runners with that boost to silver today. Also boosting markets in Europe, we've seen a lot of optimism again regarding the COVID-19 vaccine across the continent, with hopes of quicker return to economic growth. In the UK in particular, we've heard about the UK hitting a new milestone with the vaccine rollout. The UK government announced that all care home residents had been offered a COVID jab. And on the weekend, they recorded the biggest number of people being vaccinated. So all of this news with silver and the vaccine and hopes of economic recovery has given Europe a really nice boost and start to February.
All right, Yahoo Finance's LaToya Harding with the overview of everything happening over in European markets. All right, we're going to be off for a quick break. Again, stocks higher here in the early going on this Monday morning. NASDAQ now back up more than 1%. We're back here with more in just 2 minutes.
Well, the big snowstorm in the Northeast have been postponing some vaccinations today, but we have seen some progress on the vaccination front, even as we see the COVID case count and death count continue to climb. Our Anjali Kamlani is here with the latest numbers for us. Anjali.
Hey, Julie. Yeah, so we know that while cases and deaths and hospitalizations continue to be a concern, the trend overall has come down just a little bit. But experts warn that that is possibly just a temporary situation. As we know, the new viral strains are of concern and are spreading here in the U.S. We've confirmed all three troubling variants here in the U.S., as well as the ongoing concerns about certain hotspots in the country. We also know that vaccinations continue to be a struggle, even as we know that more are going to come out. We've got Johnson & Johnson in the wings waiting for that emergency use authorization, probably applying for that this week. But we know that the vaccination distribution continues to be a problem. Reports over the weekend of the Biden administration not being able to track specifically 20 million doses that were distributed previously, as well as news out of New York City that sort of displays the concerns about the differences in different communities and how more white individuals in New York City have been vaccinated compared to Black and other minorities. So that continues to be a concern. It sort of reflects what we've seen overall with the way that COVID has disproportionately affected these communities and remains a concern for experts who see the death toll reaching and possibly surpassing 500,000 sometime soon. Julie.
Anjali, thank you so much. And we have been covering that aspect of the COVID crisis consistently throughout it. That is the disproportionate effect on minority communities. We will be shining a light even more on it during this Black History Month, which of course begins today, it being February. And to talk more about this, I want to bring in Aaron Betru. He is Managing Director of the Center for Financial Markets at the Milken Institute. Our Reggie Wade is with us as well. Aaron, thank you so much for being here. So one of the things that you have written about and examined is the role that community-based financial institutions have in trying to address some of these disproportionate effects, not just obviously health effects, but also economic effects. So walk me through how that works within these minority communities and how you think these funds and this aid is best deployed through these institutions.
Thank you, Julie, and good to see you again, Reggie. I appreciate you spotlighting this issue, not only just because it's Black History Month, but because it's actually a major issue, not just within the African American community, but the nation at large. When we talk about, what happened in 2020, both in terms of the high rate of COVID cases, the high rate of COVID deaths that occurred in the African American community, that impacts the nation at large, both in terms of its impact on the economy, its impact in terms of the multiplier effect that the stimulus would have overall. And here is, a couple of things to keep in mind. Prior to 2020, African American wealth disparity versus white American was significant. And we're talking essentially by 2053, Black wealth median was going to hit 0. And so that means we were projected towards where nearly 50% of this country, of the Black American population by that time frame, was going to end up having negative, 0 wealth. And so when you think of what is it actually going to take to mobilize wealth creation, small business is a critical part of that. They need money to be able to grow. And we've had a long history of financial institutions, the banking sector, essentially missing an opportunity to support this group due to everything from unconscious bias on one end of this all the way to systemic and explicit racism that happens in the banking sector. And so when we want to make sure that wealth increases, we want to make sure that the group that has been serving this, and in particular community development financial institutions, minority depository institutions, have the tools they need to mobilize capital. And so that becomes a critical part of what was in some elements of the first stimulus package from 2020, but also in the December package. We needed to see everything from lending capacity through the PPP, but also by virtue of kind of longstanding structural issues where small banks, MDIs, CDFIs as well, were much effectively dealing with a regulatory environment that really went against their ability to serve these communities. And so we needed to see Tier 1 capital come in to help scale them up. And with that increased scale, you see more lending. And with more lending, specifically to small businesses, you see more job creation and a much better ability to actually bounce back from the twin health and economic crisis brought on by COVID-19.
Aaron, Reggie Wade here. In your latest report, you cited that the National Bureau of Economic Research reported that Black business ownership is down 41% from February to April, and Latino businesses are down 32%. Is it just going to take stimulus to help fix this, or do we need more of a fundamental change?
That's an excellent question. And yes, I think we're looking at the precipice of something that needs to be a much bigger, a much more bolder look at how to address this. And in the beginning, I mentioned, addressing the African American and minority joblessness and essentially ability to bounce back from this COVID crisis wasn't just good for that community. We're talking about a very large part of this country's economic potential. Addressing some of these issues was spotlighted as part of the Milken Institute paper that they released back in, I believe, 2018, 2019, said, if we address these problems, you end up moving $1 to $1.6 trillion of economic productivity in this country. That's 6% US GDP. So it's good for the country at large. And that requires a much bigger, bolder look. Yes, we should be looking at, in any scenario, stopping kind of the negative slide that occurs. And sure enough, as part of the December package, we had something to help repair some of these MDIs and CDFIs And that was in the order of, I believe, we had about $3 trillion of funding that was going to go to the CDFI fund, and about $9 billion that was going to go to something called the Emergency Capital Investment Program to help shore up these financial institutions and provide that access to capital that's quite critical. That's kind of that first stage repair, if you will. And then we need to kind of restore access to capital kind of at parity across this country. If we have predominantly minority census tracts having, I would say roughly 70% of them not having a bank branch in their backyard, that becomes a very fundamental gap in being able to create wealth. And without that ability of both fueling wealth creation and addressing the income gap, we really have a big drain on this economy. But more importantly, we need to look beyond 2020 and say, how do we reimagine this country in a much more equitable stance? I think we're going to end up seeing, something in the range of a couple of $1 trillion going to infrastructure, a couple of $100 billion to addressing the health supply chain. We need to really wonder, how is that money being spent in this country? And how can we make sure certain parts of this country that have not participated in the rising tide, getting a piece of that increased stimulus spend? And with that, that's how you unlock the much larger economic potential of this community. And then it becomes not just good for the minority community, it becomes good for the country at large, which is exactly what we want going forward.
Aaron, we talk a lot about federal stimulus. Today, President Biden will meet with some members of the Republican leadership to talk stimulus. But do you think there's some onus that lies within the state and local governments? And what should they be doing right now to support minority investors, minority business owners?
Yeah, that's an excellent point. Essentially, the federal government can only do so much on the ground across all 50 states and the various territories. There are pockets of underserved populations, and definitely African American and minorities are a critical part of that. And there's been a bit of lead that was taking place, definitely as part of the stimulus package. We saw all of this increased focus with regards to MDIs and CDFIs being a critical part of that. And at the state and local level, there is a need to recognize that effectively looking at the local community financial institutions can only help them, because those are the institutions that are going to create the jobs in their backyard for their local citizens. But above that, that raises the potential for tax revenue that this group ends up catalyzing. The state and local governments are definitely going to be a part of looking at that. So, whether it be local regulations and zoning rules, or whether it be effectively some of the state and local stimulus that's coming from the federal government and thinking about distributing it into a co-investment that might happen with the local financial institutions, these things end up being kind of a critical way to localize the bounce back that's necessary. And then taking that a step further, I mean, the executive order that President Biden signed in terms of racial equity and support for underserved communities, that gives you a playbook for what essentially at the state and local government. We saw kind of 4 things that were kind of critical in it. We saw a definition of equity that was necessary, that we haven't seen that level of specificity. We saw essentially a recognition that we needed to be evidence-based and data-driven. That was a requirement in that executive order. And I think that can help both state and local governments. And we also saw then a mandate that do the work, have a plan for addressing these inequalities in your backyard, both from the federal government level, but I think we should be emulating that at the state and local. And then, something that definitely was seen as kind of a hindrance on the federal side is a revocation of, executive order, 13950, which essentially had barred sensitivity training by the previous administration that said, we need to actually engage on these issues. As American citizens, we do better when we lean in and talk about them and address them. And I think revoking that executive order helped actually advance dialogue in a much more meaningful way.
Yeah, transparency, accountability, these are all things we've been talking a lot about. So hopefully some of these actions will actually deliver. Thank you so much, Aaron. Appreciate your time this morning. Aaron Betru is Managing Director of the Center for Financial Markets at the Milken Institute, and our own Reggie Wade as well. Thank you both very much.
Thank you for having me.
When we come back, we'll get another check on what's going on in these markets and tell you what's on the move. Stay tuned.
All right, welcome back to Yahoo Finance Live on this snowy Monday morning. Let's take a look at where the markets stand and where we're seeing the action in some of those heavily shorted names. Shares of GameStop had been halted for trades, falling some 34%. We see shares here resuming trading just within the last minute or so, now down some 28%. So certainly a little bit of pain for GameStop there, and we see the broader markets higher as well. But let's talk quickly about a story that crossed late last night that isn't moving the stocks a whole lot, but certainly has folks in the energy space asking some interesting questions, and that would be a report from the Wall Street Journal that Exxon and Chevron last year discussed a potential merger. Of course, these two companies are descendants of the Standard Oil empire. Brian Saza, we've talked about Exxon over the last couple of months, and basically the capital crunch that Exxon is in, or, sort of not a capital crunch, but what the future of their business looks like, and how they're reconciling the dividend, the share repurchase program, and anything resembling growth in the future.
Well, first thing I thought when I saw this was it has to be some form of joke. This becomes before Exxon's earnings on February 2nd. Chevron just reported on January 29th. But listen, we've talked about it at length. Exxon has been one of the most horribly run oil companies in the business. I mean, this stock is down close to 50% since CEO Darren Woods officially started on January 1st, 2017. When Exxon reports its earnings on February 2nd, they will announce close to a $20 billion write-down. Also, let's keep in mind, there is a major, there's a big risk of a dividend cut here. Exxon needs $64 a barrel oil to fund its dividend. For the past, since 2014, they have been funding this dividend through debt. And their net debt position has gone from $24 billion in 2014 to $57 billion right now. It's not good. And how, if you're the government, how can you possibly let Exxon and Chevron merge when you won't even let Staples and Office Depot merge? I mean, Julie, this is a joke. I mean, it really falls into the category of news you just can't believe.
Well, I don't know. I don't know about that. To take the other side of the argument here for just a moment, Brian, I mean, to be clear here, this reporting says that these two were having these discussions sort of at the depth of the pandemic last spring when we first saw that plunge in oil. And yes, if you're talking about a combination here, you're talking about a company that could top $350 billion in market cap. However, if you look at an Office Depot and a Staples, what else is there? There are other oil producers. They may be somewhat smaller, but this is a much diminished market overall. So you're talking about two weakened giants here that would potentially be merging. So I'm not sure it's quite apples to apples if you're looking at this versus the office supply market. And so that's an argument perhaps that these two companies could make, that they would need to be stronger together going into what looks like also a radically different energy future, particularly under this administration. So, you potentially could make an argument there. That said, there's no indication that these two companies are currently in talks. Again, the reporting of the Journal said the talks were preliminary. They could resume at some point, but it seems like that's going to depend upon the dynamics of the current market and what's going on with oil prices.
Exxon has lost $274 billion in market cap since 2013. I mean, that's absolutely
dreadful. There you go.
Totally dreadful.
I think certainly at the very least, and we talked about it very, very briefly this morning, who motivated this article, who wants it out there. I think we all probably someone who works at a bank. And I think the signal might be, well, these companies are going to have to either make divestitures or maybe they're looking for another acquisition, because if they're talking to each other about a tie-up, clearly there's some appetite there, for those boards to make something happen, because, as we outlined, not a whole lot exciting happening in the core business for these companies, not just today, but really where the next 20 or 30 years are going. There you go. Yeah, Exxon, bring GameStop in-house. Deep value play maybe on that one. All right, a lot more coming up here on Yahoo Finance Live. We're off for a short 2-minute break. We're back right after this.
Well, there is yet another new SPAC that just began trading in January. This one, though, has a twist. It is all female run, and it's looking at sustainability investments. Victoria Grace, the Queen's Gambit Growth Capital Chief Executive Officer, is joining us now. Victoria, thank you so much for being here. So talk to me about how this came together. It seems like a natural idea, right, that you would have a SPAC that had this sort of specificity and is a way to get female capital out into the market. So how did this come together?
I think, we, first of all, thanks for having me. I really appreciate you taking the interest in our story, and it's exciting for us. So I think my background and experience investing was a big part of kickstarting this idea. I've also gone through a SPAC merger on the target side last year with Hylian, one of our portfolio companies. That's been very, very successful and very well run. And it opened up my eyes to the opportunity to have this type of vehicle for us to deploy for later stage high quality companies. Another aspect that was very sort of moving for us is the quality of targets willing to go down the path of and partnering with a SPAC is something that evolved over the last 12 months. And that was a huge, huge driver for us to embark on this, because quality is going to be of paramount importance for us to execute really well. And certainly the female element, I think, was very logical for us. And we bring different element, different perspective to the table through our sort of all-female, super experienced and accomplished board and advisory and management team.
Victoria, I was digging through the prospectus, and one stat really stood out to me. It notes in your prior company, 44% of your investments have had diverse founders. Walk us through your selection process, because I think that's a great stat. And a lot of other investment firms could share stats like that. How are you finding some of these folks and these companies?
It's a great point. And actually, we only done this stats recently when we were going through our portfolio. We do not have a lens where we have to have a female founder or female management member. We're really all about merits and backing the best possible management teams and the best companies out there. So it just happened that women perform just as well, I think, as men, as long as you have the right background and the right caliber and the right business plan that you're executing on. And I think part of our SPAC, the point I'm trying to make here is that women just as competent, just as accomplished, and as men, and I think can bring very different perspective all around. So women, I think, deserve just the same look as men. So for us, we didn't really, like I said, we focus on quality, and they were all super accomplished in their own right.
And Victoria, you said having gone through the process, you kind of see how the market now is reacting to SPACs and see the appetite that's out there. I mean, I know you guys only set up the vehicle about a month ago, so it's sort of silly on the one hand to ask this, but if you thought about creating a series of sponsorship SPAC groups, because you mentioned there are so many targets out there, and certainly there's an appetite among investors to get behind SPACs, especially SPACs with a clear mission that have a clear set of objectives. And I think what you guys have outlined in your prospectus is pretty black and white for investors.
No, that's a great point. And I think, for us, for me, it's always focus on one thing, do it exceptionally well, show the market that you do know how to identify and deliver results. And I think that's what we're going to focus on right now. I can't predict what future holds, but we were very, very fortunate to have a lot of blue chip investors very interested in our product, very interested in the background and experience that we bring to the table. So, number one goal for me is to find that exceptionally deserving target and target that has sustainability and core focus and has a growth objectives that we can deliver on, and then we'll see what the future holds.
Victoria, about 30 seconds left. How close are you to your first acquisition?
We just launched. I mean, we've been trading for 5 days, I believe. So it's a little bit early, but we're working really hard, and we have a lot of things we're looking at, and we're very excited about prospects. And we believe we're going to get something done in a short period of time.
Well, we're going to stay in touch. Victoria Grace, thank you so much for being here. Look forward to talking to you again soon. Queen's Gambit Growth Capital Chief Executive Officer. Thank you, Victoria. We'll be right back.
NBA great Ray Allen was always known as a deep thinker on and off the court. Nowadays, the retired Allen shares his thoughts on politics and social justice to his 2.3 million Instagram followers. I caught up with Allen to get his thoughts on where he thinks the country is right now.
Well, it's a systemic issue. If you think about, the past administration, I think it was someone in the Trump administration that said that there was no systemic racism in this country. And to me, that was astounding because all the issues that pervade through the inner city, it requires policies to change. It requires money to be spent in these cities. For example, if you think about most inner cities, they're food deserts where, black and brown people don't have access to clean and healthier foods. And even furthermore, when you talk about medicine, having access to medicine, there are some communities in inner city and in black, neighborhoods throughout this country that are pharmacy deserts, so even when you talk about this vaccine, there are some people, elderly in this community, in this country, black and brown elderly people that don't have the access to go to a pharmacy in their neighborhood to get the vaccine. So traveling across town to another community where one might not be able to drive or have access to transportation, this is why, one of the reasons why, this pandemic has affected minorities so much more than other people.
Yeah, I was telling you before we came on here, you have one of the most thoughtful Instagram accounts that I in fact follow. And one of these comments that you made recently really stood out to me. You said, quote, "We cannot let America be a country of two narratives." How do you see it? What are those two narratives? And what's your hope for the country now that we do, in fact, have a new administration in the White House?
Well, I mean, I think it was evident the day of I think it was January 6th, the day of the Capitol siege, when you see white people storm the Capitol and, police officers almost let them walk in there and there was nothing done to them. And, it was a terrorist attack, but yet when there were peaceful protests, the peaceful protests over the years, over this past year, due to police brutality and the killing of George Floyd and Breonna Taylor and the shooting of Jacob Blake, people wanted to express their displeasure and ultimately were met with, National Guard, with police. They talked about, Trump even said it himself, when the looting starts, the shooting starts. But yet he encouraged this into the Capitol on January 6th. So you see the two differences in America and how there's governing done differently over the black people when they protest. And protesting is the American way. This is how our country was built. When there's been situations that have arisen over the course of this country, the people have to step up and speak their piece in order to change the status quo and to make this America a better America for all people.
How do you think President Biden has talked a lot about healing the country? How does that healing happen?
First off, people have to listen. People have to be willing to understand that, in a compromise, this compromise, you have to give something up. You don't get everything that you want. This country is not Democrat, Republican. We are far too embroiled in political parties right now, where we want people from our party, from the other party, to either win or lose. And this country, we've played this game, and it starts with the people in elected positions. They only care about winning. It's about making this country a better place. And it's important that our politicians put their insignificant beefs and immaturities aside, so we can actually see them work together. You're calling for unity in the Congress, in the Senate. They're calling for, in the House and the Senate, they're calling for unity amongst the American people, but yet they don't get along in government. You're setting an example of how people should live, how people should behave, how people should get along. And for the longest time, the vitriol, the dissension, the misinformation that Trump spewed over the past couple of years, that trickled down to the American people and the people who were passing laws for us. And now it is time for us to use language that accepts and brings all people together.
All right, welcome back to Yahoo Finance Live on this Monday morning. All three majors are higher right now. All of the action remains in those heavily shorted names. One name we're seeing under a bit of pressure this morning, GameStop. The stock has already been halted for trade at least once during today's trading session. Right now it's off about 30%. But Brian Sazi, let's talk about a little levity within this situation. Popeyes, your friends over at QSR, getting into the mix here. We like to see this kind of crossover promotion.
Yeah, news you can use. And you got to give a shout out to Restaurant Brand CEO Jose Sil, longtime friend of the show. So opened my email box about 15 minutes ago, and Popeyes is launching a promo called Tendies for All. Now, obviously, tendies is the word that these Reddit traders use to describe money or financial gains, which certainly fits well with chicken tenders. And that's what this promotion is. You spend $5 and you get a free three-piece chicken tender. So I wouldn't be surprised if you see more promos like this out of the fast food space. It makes sense. But Restaurant Brands for the win, Julie.
I guess so. The question that we keep asking, sorry to bring it away from levity once again, is who's going to be caught holding the bag on all of this? And I come back in my mind to something that, sorry to be the bummer here. Something Steve Sosnick said keeps coming back into my mind, which is this is a poor way to stick it to the man, he said. And that's because you got the man, Wall Street, I guess, on both sides of these trades. And so inevitably they're going to be winning. And some of those fellow retail traders that are the fellow Reddit warriors, they're inevitably going to be losing here. So I don't know that everyone's going to get what they wished for in this situation, except maybe some chicken tenders.
What's that, Seth?
Get those tendies.
Look, I think that's the only thing that matters is that we're finally seeing a little cross promotion here. People are getting creative with how to market a memed event. Don't worry about trading stocks. Worry about selling chicken sandwiches. All right, that's going to do it for us here on Yahoo Finance Live on this Monday morning. Got to say, maybe a little too much snow right now. You know, some snow is fine, but maybe a little bit too much as we move into the midday here in the New York City area. So hopefully we'll dig ourselves out. We'll see you guys back here tomorrow at 9 o'clock Eastern. Zach Guzman and Kiko Fujita have you for the next couple of hours.
Welcome into Yahoo Finance Live. Happy Monday, everybody. I'm Zach Guzman alongside Akiko Fujita as we have stocks in the green here to kick off the month of February as the broader market comes off the weakest week that we've seen since October of last year. You can see here the Dow up by about 0.25% right now as we see green across the board. Plus, let's take an obligatory look here at those popular retail names and short squeeze targets, showing a bit of a mixed bag today with GameStop well off more than a quarter here, 27% declines as AMC remains in the green, up by about 10%. GameStop giving back a bit of that parabolic gain, but the attention of Reddit's Wall Street Bets forum seems to have shifted over to silver, the commodity seeing its biggest one-day price spike since 2008, back when Lehman went bust. Take a look at BlackRock's iShares Silver Trust seeing a big pop today after reporting nearly $1 billion in net inflows on Friday. We'll highlight what that means for the market in just a bit. Plus, a Republican counterproposal coming through to President Biden's $1.9 trillion plan, why Republicans are pushing back for a relief bill that's just about a third of that $1.9 billion level. The ranking member of the House Financial Services Committee, Patrick McHenry, will break that down for us. And pent-up demand in travel, just how big will that recovery be? We're going to be chatting with the CEO of Booking Holdings later on in the show. But Akiko, want to kick things off with a closer look at that move in silver, because if Reddit's Wall Street Bets is driving the majority of that move here, it would seem to support the idea that this retail interest is a force to be reckoned with, even beyond GameStop. And I'm not sure how the market's going to look at that.
Yeah, I mean, this goes down to what we were talking about last week, which is where is that contagion risk? And it seems like we've seen a shift, at least in the attention of these Reddit traders, if we want to call it that, when you look at where silver is trading today at an 8-year high as a result of what appears to be a silver squeeze. Zach, what's going to be interesting to me to look at is, while we keep our eye on the markets, of course, to see what kind of spillover effect there will be from the retail trade, we're also going to keeping a close watch on what is playing out in Washington. We've seen a number of lawmakers already come forward talking about a hearing on this issue. The SEC, of course, last week saying that they will be looking into this. They're launching an investigation. I had a chance to speak with a number of lawyers over the weekend who are much more well-versed in SEC regulation than I am. One of the law firms I spoke to said there's a lot of anger out there. His firm alone contacted by 25,000 people roughly, and that was by Saturday morning. So that tells you how much anger there is on Robinhood's move to restrict trade as a result of the volatile trading last week. But the bottom line here really is going to be whether there was anything illegal that happened, and at least on the surface, of course, the investigations are coming, but as it appears right now, it doesn't seem like there was a whole lot that these lawyers would argue that happened that was illegal. Part of the argument is that Robinhood is largely protected by the user agreement that's already in place that says explicitly that the platform can at any time, in its sole discretion without prior notice, prohibit or restrict ability to trade securities. And of course, we've heard much more from Vlad Tenev since then about what exactly prompted that trade and why they had to put down now, we know, $3 billion because of those margin requirements going up significantly as a result of the volatility last week.
Yeah, and that's one thing that, we've been hearing him make the rounds here. Latest last night on Clubhouse, he was talking with Elon Musk. And Akiko, he was really highlighting the points that we raised in our Friday interview with him, in the 1 p.m. hour, kind of highlighting and pushing back on that thesis that was floated around that Robinhood caved and cut off buy orders because of pressure from outside hedge funds. He basically reiterated the fact, and the same thing we heard from Webull, another platform that had to suffer through this as well, that it came down to regulations and capital requirements in regards to clearing. Here's what he had to say.
It's not true. Our decision to temporarily restrict customers from buying certain securities had nothing to do with a market maker or a market participant or anyone like that putting pressure on us or asking us to do that. It was entirely about market dynamics and clearinghouse deposit requirements as per regulation.
I mean, that's what we heard. Again, Vlad Tenev, the CEO of Robinhood. And this is kind of something that, Akiko, we've been discussing how it's a broader issue here, considering the fact that it wasn't just Robinhood who ran into that. It was Webull. We also know Robinhood has gotten a lot of heat here for kind of being the pioneer in payment for order flow, taking, money in from market makers to route customer orders to places like Citadel Securities. But of course, the rest of the industry has adopted that too. TD Ameritrade does it, E-Trade does it, Schwab. Basically, this has become industry practice to make those trades free for customers. So that's another big question mark about what regulators want to do here.
Yeah, no question about that. And the question at that point then becomes, are there concerns with the ease at which these new traders who are coming into the market can buy and sell stocks on a Robinhood, because they have all been about sort of, in their words, democratizing Wall Street. And then, on the other side, whether in fact there is any kind of manipulation that you can point to that's happening on these Reddit feeds. And of course, I would add, Zach, that we're talking about these Reddit users as if they are monolithic. At the end of the day, all we know are their usernames. We don't know if they are in fact individual investors, whether there are hedge funds who are also on these Reddit feeds. So it's certainly important to add that caution as we move forward with this conversation.
Yeah, no, it's a very good point, and it's not that simple to even just say that, the only people betting against GameStop might be hedge funds too. We've seen this all play out, and still questions around even today's silver move to get into. But let's broaden that discussion out with our next guest here. I want to welcome into the show Congressman Patrick McHenry, a Republican from North Carolina, joins us now, also ranking member of the House Financial Services Committee, alongside Yahoo Finance's Jessica Smith here with us. And Congressman, I guess we'll kick off here, since we were just discussing kind of that big push here among politicians right now to kind of weigh in on the issue of Robinhood and what we've seen play out this week and last week with Wall Street bets and retail investors. What have you made of it as you've seen this play out in terms of what regulations or strength might need to be put into the system now?
Well, first, this isn't about a single company or any or two companies. This is about a broader move in the marketplace, where individuals want to have greater access to our capital markets and greater participation in our capital markets. So when we're talking about democratizing finance, which is what I've spent the last decade of working on in terms of policy, I think that movement is really in the people's hands. I think it is broadly the interest of the American people to get into more interesting, more sophisticated products rather than the narrow scope that's currently permitted under securities regulations and the laws here in the United States. We need to widen that scope so we can have a deeper, more fulsome investment from average everyday investors, not just the privileged few.
Congressman, this is a very complicated issue that, of course, that will be examined from many sides. But as it stands right now, what's the bigger concern for you? Is it about these financial apps that have allowed trading to be executed at such a low barrier? Or is it about social media platforms like a Reddit, for example, that allows information to spread at such a rapid rate, such a scale that actually moves the market?
Well, first, technology is here to stay. Innovation is here to stay. We either embrace it or it moves on without us. And so what I would tell you is to simply to put technology back in the box or say that we can constrain it in some way, I think is irresponsible. What we have to do is adapt to this new world where people have very easy access to the movement of money. We need to make it more. We need to make it easier. We need to make it more available, and we need to have wider options so you don't have to have a narrow play against a single stock. And so that's what I think of broadly here. We also have the governmental regulation piece. We have regulations right now that force, for instance, DoorDash to offer equity compensation to their employees, but not to the folks that are actually DoorDashers making their business work. We've got to broaden that equity option and equity grant to those adopters of apps and gig workers too. We have to broaden this. We also have the accredited investor standard that narrows out who can get early stage investment opportunities. We need to broaden that. So rather than saying we're going to put apps back into a box or trying to roll back technology, I think we have to be forward looking. We have to broaden things out, open things up, and I think we'll get better results with broader, more fulsome access to our capital markets.
Hi, Congressman. Jessica Smith here. One of the proposals that I've seen from some of your progressive colleagues in light of this situation is a financial transaction tax. They're saying that this illustrates why that is necessary. What do you think about that argument?
Well, first, a financial transaction tax as proposed would mean that you have to work 2 additional years to save for your retirement. That's the average person who have to work 2 additional years to save for their retirement. That's not a good thing. We need people to be able to save tax-free. We need to be able to save long-term for retirement savings. We need more of that in our society. Second, I would raise the question of this. If you're taxing people on both ends of the trade, which is what a financial transaction tax does, how are people better off? First of all, if you're on both ends of the action here, you're taxing the average user and the complex trades that happen thereafter. I don't think anybody nets out well other than government coffers from a financial transaction tax. Every regime that's been tried around the globe that has a financial transaction tax has put it back away because it doesn't work and it doesn't function. And I don't want us to destroy our capital markets in the name of going after some Reddit users, which is really what I see with these folks proposing this in Washington.
Yeah, when we look at kind of the larger issue here, as you said, it's not just one company. A lot of questions out there have been made about this idea of payment for order flow, the idea that some of these brokers would get paid by market makers to kind of pass their trades onto them, and questions about whether or not they're going to be executing those trades at the best prices for their customers, since it does seem like there's a maybe potential conflict of interest. We've heard that raised from the SEC before. We've seen the SEC go after Robinhood with a $65 million fine for potentially not being as clear as they could have been with customers. So in your estimation here, Congressman, do you think the SEC's perhaps been asleep at the wheel on the issue and should be, taking a stronger look at brokerages writ large for that practice?
So what we've seen over the last 50 years since Schwab came into the marketplace nearly 50 years ago is that we've seen trade fees go down and the access to our capital markets go up. Right now, you can get on any number of whether it's Charles Schwab to Robinhood and everything in between, and pay no commission for trades. I think the average everyday investor gets enormous benefit from that. The second issue is one of regulation, the Securities and Exchange Commission, and that is making sure that the best price is what is given. We have regulations around that. Third, payment for order flow is what enables those fees to be crashed to zero for average everyday investors. And I think there is still net good from that system that has been created over the last 10, 20, 30, 40 years. And so I don't think as a governmental official, I need to step into that business decision. I think average investors have that option and opportunity to go different routes.
Congressman, I wanted to switch gears a bit and talk about stimulus. We've seen this new proposal out today from 10 Republican senators. They're pitching it to President Biden tonight. What do you make of this new plan?
Well, we've already spent $3.5 trillion in response to the COVID crisis from February of last year until major bipartisan agreement we had in December. We had a major bipartisan agreement back in March. So we have in total 5 different government funding bills that have helped with the COVID response. We've seen the unemployment rate come down dramatically as a result of that, though we have particular industry segments that are very, very hard hit, hospitality in particular, restaurants in particular. And so rather than having a broad-based focus, we need to do what other countries around the world, including countries in Asia, that have focused their relief on those that are most hard hit. So simply having a $2 trillion price tag, like President Biden and congressional Democrats have come forward with, doesn't actually meet the needs of our economy and our people as it stands today. We see vaccines being distributed at over 1 million shots in arms on a daily basis, which was the Trump administration pledge, and the Biden administration is pledged that as well. And so I think we need to focus on getting the vaccines distributed and focused on targeted relief rather than broad-based relief like we had back in March.
On the issue of targeted relief, there are significant differences, at least in how much should be set aside for schools. When you look at what the Republican lawmakers are proposing versus the Biden plan, $20 billion versus $170 billion. How do you reconcile that? Yes, the CDC has said there's no sign of widespread exposure at schools, but they also said that's only if the proper measures are taken. How do you do that with $20 billion?
Well, it turns out that the teachers' unions that have largely supported President Biden, almost entirely supported President Biden, don't want to reopen schools in a number of school districts across the country. We're seeing this in protests and things of that sort, and strikes from teachers. So I think the main focus should be on getting schools open in a safe and healthy way. Only a small percentage of our primary education system dollars come from the federal government. And so what is being proposed and what has actually been given since March of last year is a more than doubling of federal education dollars going to local school systems. That's already been done. What the Biden administration wants to do is increase that again by 50%. So I think rather than getting into the question of dollars and cents, I want to hear from teachers' unions why they won't reopen and how they intend to get our children back into the classroom so they can have the healthiest, both in terms of physical and mental and social welfare, the best results for our children. So if they come up with a price tag connected with reopening the schools, I'm all ears as a policymaker. And whether it's 20 or 170, the point is opening the schools is going to be the best result. Rather than just pouring money out and saying, I hope you reopen, let's get a real plan. Let's get a national plan to make that happen rather than dragging along like we have been over the last couple of months, which is completely absurd given the size of our country, the wealth of our country, and the importance of education in our system.
Yeah, and Congressman, just one last for me before we go to kind of returning to your point on what we've seen from the Wall Street bets crowd and Reddit traders here, because there's a lot of interest in this on both sides of the aisle. It's interesting because, some people could look at the power that we've now seen here with the GameStop moves and today's silver moves and say these traders are Democratic heroes, little guys banding together using public info, fair and square, to move markets. And there's other people who are watching this play out and say, look, this is more power than we've ever seen in some instances to move individual securities and could have broader implications on the market. So where do you look at it in terms of some people saying they're heroes, some saying financial anarchists? What about your take?
Power to the people. Look, that's my key takeaway here. You're not gonna stop people from talking to one another. You're not going to stop the use of technology. Look, going back to the initial securities regulation in the United States, the first thing they responded to was the advent of the telephone, and they had to regulate around that. Now we're having message boards. Reddit's been around for a long time. That's not even a new piece of technology. So what I would tell you is the opening of finance is here to stay. We need to embrace it. We need to be more permissive of it. We need to open up our regulations and our laws to make it more equitable and available for everyone. Small and large need to have the same access to our markets so they can make decisions for themselves, not government mandating it or a centralized approach mandating it, but individuals making choices for themselves. And we don't know how it's going to play out. We don't know how any market's going to play out. So buyer beware, but let's allow the people to make the decisions for themselves.
I like ending interviews on power to the people. Appreciate the time. Congressman Patrick McHenry joining us from North Carolina alongside Yahoo Finance's Jessica Smith. Appreciate you both. Want to shift it back over here to the market as we are seeing, again, all three major indices here in the green, but still a lot of question marks about today's moves in silver and what it could mean for the broader market. So let's bring on our next guest here. Leighton Spar is SS&C Alps Advisors president, and he joins us now. Leighton, appreciate you taking the time here to chat. I mean, you just heard from Congressman McHenry there as we look at the market moves around this retail investor trade. What do you make of what we've seen so far and the strength of that move and what it means for the broader market?
Yeah, that conversation you just had was fascinating. And, I love hearing the perspective around diversity and transparency for financial markets. I think a lot of what we're seeing in silver and what we saw, last week with GameStop and, some of these volatile moves in what I would call narrowly defined stocks or assets in the case of silver is that this move towards democratization is, something that I think is all good, right? I mean, over the last couple of weeks, there's a debate about, anarchy and, who's lost money, who's making money, who the good guys are, who the bad guys are. Really what happens, markets are these complex adaptive systems. And when you lose diversity and then all of a sudden some new idea comes into the market, prices move a lot. And that's what's happening with silver. It's what happened with GameStop. But what we're seeing is more diversity, more transparency, new ways of communicating. And I think that's all good for markets. It's also enhancing financial literacy across the board. I've had more conversations from people that are not typically engaged in markets over the last week who want to learn about options. They want to learn about volatility. They want to, open accounts and learn this stuff firsthand. So, it's fascinating. I don't think the moves are signs of, any corruption or, negativity in that regard. So, I think power to the people, as you ended the prior interview, is a great theme for the month.
Having said that, we have had a number of guests on who sort of highlighted their concern about whether, in fact, this trade could spill over into the broader markets. It's one thing to have a lot of volatility around a stock like GameStop. What about a stock that has a heavier weight on the S&P 500, for example? How real is the contagion risk? Do you think it's a bit overstated?
I definitely think it's overstated. When I look at what causes risk in the markets, it's whenever there's some crowded opinion by a relatively small group of investors that is proven wrong or is challenged by a new perspective of diversity. And when you look at the largest market cap names, there's so much diversity of opinion that's in a Microsoft or that's in a Caterpillar that names like that just are less vulnerable. Now, there are themes around them that can take really any stock or any theme to extremes. But that's something we've seen forever. I mean, it's fun to talk about silver today and then put it in the context of 1980 when the Hunt brothers first tried to when they tried to corner the silver market. And you think of what technologies existed then and the financial vehicles that they tried to use. There isn't anything new about this. And I think the idea that it's a contagion risk and that financial regulation really has no beat on this is it's a fairly narrow perspective of something that just took the oxygen out of the headlines last week. But there isn't anything new here other than the technology, and the technology is just improving the way that we can bring diversity and transparency to markets. And when you have opinions change, prices move.
Yeah, and Leighton too. I mean, when we're backing up, and before we were really talking about GameStop every day, we were talking about earnings, and those had been strong relatively across the board, but the stock reactions have been pretty weak to those. So that was kind of the story before we got sidetracked into this. But what do you make of that? Because a lot of people are pointing at the fact that if you are seeing a weak post-earnings pop, it doesn't look good for the market.
Yeah, so I mean, we ended last year on a very high note, right? The fourth quarter returns were among the best fourth quarters we've seen. The euphoria around equities was, at technical highs. You look at different indicators of options and optimism from a behavioral standpoint, and we were at very, very optimistic levels coming into this year. And as you go through earnings season, I mean, we've seen this over the last several years, that in between earnings seasons, the market tends to consolidate around big macro themes. And then we hear from all of these companies and we realize that the recovery or the nuances of the fundamentals are much more complex. And you can't just make big, broad brushed assumptions about where markets are going. And I think over the last 4 weeks, we've heard from banks and industrial companies and technology companies, consumer companies. It's not all just roses, right? We're still in a really difficult recovery from this COVID recession, and it's not a straight line up. And then you add in the headline risks and the volatility that we've seen from the GameStops and from silver, and it's just caused people to take a little profit, take some money off the table. But we do think that the stimulus story is still in place, the cyclical recovery story is still in place, and we've been talking about buying the dips, and that's exactly what last week was. We still think there's a lack of inflation that's going to motivate more stimulus. And we think, the gradual improvement from vaccinations and from policy opening back up, it's still the theme for 2021. And, weeks like last week are great opportunities to step back, look at exposures and understand, what's been missed. And there are still opportunities in this market to add exposure.
Leighton Spar, SSNC ALPS Advisors President. It's good to talk to you. Appreciate your time.
Thank you. Take care.
Coming up, we're turning our attention to the fight against the coronavirus. The number of cases in the U.S. topping 26 million people. A closer look around the confusion around the vaccine rollout as medical experts race ahead or attempt to get ahead of these new COVID variants. We'll have that on the other side. More than 25 million Americans have received at least one dose of the coronavirus vaccine so far. But the lack of supply and resistance to getting the vaccine is threatening to decelerate that pace. Let's bring in Dr. Ali Raja. He is Harvard Medical School professor and co-founder of Get Us PPE. Dr. Raja, it's good to talk to you on this Monday. It feels like the race to get people vaccinated has become even more urgent in light of these new variants that have emerged, what more we're learning about them because they're much more infectious. What do you think needs to change in the vaccine process to pick up the pace?
Akiko, that's the main question that I think we're all focusing on right now. The vaccine data that we've all seen, including the data that we just got last week from J&J, is very promising. These vaccines have been shown in all the studies that have been published to keep people out of the hospital and to prevent deaths from COVID. But getting them into arms is turning into more of an operational challenge than, quite honestly, than it should have. We've had months to plan this, and the fact that we don't have, in many situations, streamlined methods of getting vaccinations done for mass populations, not just a little bit here and a little bit there, is concerning. I think a lot of that has to do with the fact that the states don't have a reliable supply of vaccine just yet. And I'm starting to see some really good plans from states around the country about how they're going to start vaccinating mass amounts of people. But we do have some good examples. West Virginia has done a great job. Maine has done a really good job, but they're not as populous as some of these larger states. So the big focus has to be operationalization of the vaccination process.
Yeah, and doctor, I mean, obviously we want our process to go as smoothly as we're seeing in some other countries around the world. People are pointing at Israel right now for really doing a great job in getting their population vaccinated, but they also instituted some pretty strict lockdown measurements a couple weeks before, starting at the end of the year, that included, not traveling 1,000 meters beyond their homes, not going to other people's homes, also not traveling in or out of the country to protect against some of these variants. So, I mean, how do you square away our upside? Because they've seen cases drop there. What's our upside look like if we do roll out the vaccine as successfully, but also don't impose as strict measures on the lockdown side?
Zach, you're right. It's definitely both things. It's the vaccination process is what's going to get us to the end of this pandemic. But realistically, we're not going to see the full effects of that until much more of the population is vaccinated. And that's not going to happen until the late spring or early summer. What's going to help us now are travel mandates, our mask mandates, and the CDC just announced a mask mandate that I hope we can talk about in just a few minutes. But Israel has done an amazing job because of the fact that they didn't just vaccinate people, but they prevented this post-holiday surge that we've all been wrestling with for the past month. Predictably, 2 weeks after Christmas and 2 weeks after New Year's, we saw surges of patients, and we've just started to see that decline over the past week or so. I'm afraid to see what happens as people continue to gather, as we see Valentine's Day get-togethers, as we see more gatherings in the spring of people who aren't yet vaccinated. We'll continue to see those surges unless we can control the spread, in addition to just vaccinating people.
Doctor, there's also some debate about whether, in fact, the right people are being prioritized for this vaccine. Of course, it's shifted a bit since the initial rollout under the previous administration. Initially, it was about healthcare workers. That didn't change, but also essential workers. And there's certainly a lot of essential workers out there who are saying we are the ones that are being exposed to this on a daily basis, and yet we're not getting access to it. The elderly are being prioritized. Should that shift?
It's a tough call, Akiko. The fact is that elderly patients make up the majority of patients who get sick, and especially the majority of patients who die from COVID. And I hear the essential workers out there. I hear the teachers. I hear the grocery store workers. I hear everybody. And their pleas for vaccination should not fall on deaf ears. We should be vaccinating as many of them as possible. But I think the priority of getting our older patients, many of whom I've seen in the hospital and unfortunately die from this, vaccinated really has to be a big push before we go much broader, although we need to go broad quickly.
And doctor, we can't overlook masking too. It sounds like you really want to talk about that. We saw those rules strengthened here. That's been an issue that President Biden has raised multiple times. So what's your take on maybe how those rules are changing now?
I think masking still, in addition to the vaccination, in addition to the hand washing, the not going out and traveling, vaccination is still the most important. I'm sorry, you've got me thinking about vaccination. Masking is still the most important thing that we can all be doing. And the fact that the CDC just announced some regulation about the fact that there needs to be masks worn on all travel, so airplanes, trains, subway, starting at midnight tonight, this is such a great move. Now, there's some caveats here. Obviously, you don't have to wear a mask if you've got your child doesn't have to wear a mask if he or she is under 2 years of age. And if you've got a medical condition that prevents the mask from having to be worn, that doesn't have to be worn. That medical condition bit was really tricky when the airlines tried to do it. And eventually, the airlines actually said, no, you know what? If you just say you have a medical condition, that's not enough. And so what the CDC has said is that transportation companies may require medical documentation. They also may require COVID testing, which, as we all know, is already required when you're flying into the US from outside of the country. So I really like the fact that the mask mandate has started and is going to start at midnight tonight. I'm worried about some of the nuts and bolts, especially for people who have a medical condition but don't have medical documentation of it. But this is the right direction. And quite honestly, this is what we should have done many months ago.
All right, Dr. Ali Raja, appreciate you coming on here. GetUs PPE co-founder and Harvard Medical School professor. Thanks again for joining us. Appreciate it. Going to take a quick break here on Yahoo Finance Live, but when we return, discussing how some of those changes might impact the demand for travel. We'll chat with the CEO of Booking.com and Booking Holdings here, Glenn Fogel, joins us on the other side of the break. Stay with us. Welcome back to Yahoo Finance Live. Traveler data still down sharply relative to pre-pandemic levels. The latest numbers from the TSA still showing that we are about 50% below those traveler numbers at airports since before the pandemic. But how many people are looking forward to a resumption of travel here once we get those vaccines rolled out? Here to discuss what travel plans look like for the rest of the year, we're joined by the CEO of Booking.com and Booking Holdings, Glenn Fogel, on the show with us. Glenn, good to see you here. Thanks for joining us. I mean, obviously, everyone's looking forward to traveling again once this all gets over. But what are you seeing in terms of bookings for when people expect to get back out there?
Well, thanks for having me. And right now, people are still booking for a very short period of time. And so people are saying maybe next week, next weekend. They're not really surging to say, I want to start planning for the summer yet. We call that a short booking window. But I am very confident that as things start getting better, as these vaccines start getting rolled out, as people feel safer, I do believe people will be thinking more and more about their summer holidays and will start booking.
You may still be in a lull in terms of where things stand in comparison to pre-COVID times, but I wonder if you have seen a sentiment shift at all that has come along with the rollout of the vaccine.
I think people are generally becoming more optimistic about the future. I think we all feel that with these new vaccines, that people feel that we're going to get over that mountain at some point and start getting into that beautiful valley where things are safe and we get to live like we used to. But we all know it's going to take time. We know it's not overnight. It's not like flicking a switch. And we know it'll gradually, things will get better. And I think the thing that's going to be slowest is going to be the international travel, because governments are still going to be a little bit leery about letting those restrictions go and letting people just flow in and potentially raise up those infection rates. So I think that's going to be the last thing to come back.
Yeah, and Glenn, I mean, we were looking at this last year. Air travel took a hit, but more people were driving and taking road trips out there. I know that you guys operate through the hotel side, through Priceline, Kayak. and Booking.com. But what are you seeing in maybe that hotel booking resumption there when you think about that becoming a big piece of this?
Well, you're absolutely right. And we saw that in the summer, how people were looking very, very local. They wanted to get in the car where they felt safe and go to someplace. And whether it was a hotel or they wanted to rent a home in our homes department, we saw people did want to travel still. I think over time, people will want to go further or far. Now, look, people want to travel. They always want to travel, and they want to get on that plane and go someplace different. And we think what we really just need is safety. Once people feel safe, they'll start getting on those planes again.
What does all of this mean from your company standpoint? When you look at Booking.com, of course, you had to close some offices last year. You announced some layoffs as well as a result of the significant slowdown you saw. Do you anticipate more coming, given that things haven't bounced back to the levels you expected?
Well, we took a very long view of the future. We knew that this thing was not going to turn around right away. And unfortunately, sadly, 2020 was a terrible year for our business. And unfortunately, we had to let go about 25% of our employees. And it was very sad about that. But we think that's done. We think things are going to start getting better, and we are not expecting any further cuts. In fact, we're hoping that things do get better sooner rather than later, but we know it'll take time. And that's something that we'll all be very happy about.
Yeah, 2020 was a terrible year for a lot of people, and also terrible for the customers of some of your services too. OpenTable is in your guys' umbrella of brands. When we spoke to them earlier last year, it was kind of shocking to hear the expectation that 1 in 4 restaurants would permanently close because of the pandemic. Is that still what you're seeing when you look into that OpenTable data?
Well, the fact is, let's face it, restaurants generally have a very tough time anyway. Margins are low, and a lot of them go out of business a lot. Absolutely, the pandemic, though, really threw a loop into that industry. And it's going to take time for people to come back and feel safe going to restaurants and dining indoors. But that absolutely will happen. Again, it all comes down to how fast do we get these vaccines rolled out? How fast do people start taking those vaccinations and start feeling safe so they can then travel and go to dining and do everything they used to do? That's why it's so important that our government continues to work so hard at getting this rolled out as fast as possible, using all the powers of the federal government in the U.S. and around the world to make sure that these vaccines are put into people's arms as quickly as possible so we can get back to a normal life.
Realistically, though, that we're talking months to come in order for enough vaccinations to be out there to achieve some kind of herd immunity. In the meantime, I mean, I'm looking outside my window here in New York at the snow and thinking, this is not the time people want to be eating outdoors. Yes, New York City, for example, is resuming indoor dining as well. But how significant has the drop-off been during the winter when you compare it to where things were in September or October, particularly in the cities where cold weather is a significant factor?
Yeah, you're absolutely right. And the fact is, this has been a terrible hardship on restaurants that are in the northern parts of our country where it's cold and people don't want to eat outside. It is very hard for them. That's why, thankfully, the federal government right now looking at a new stimulus package. Hopefully that'll be put through quickly, and hopefully that will help some of these very hard-pressed restaurateurs to be able to maintain their businesses going forward. Look, we're all looking forward to spring. Warmer weathers will allow people to dine outside, feel safer, et cetera. But it can't happen soon enough for me.
Yeah, no question about that. Although I should point out over the weekend, I saw plenty of people who were sitting outside with no heater, eating outdoors here in New York City. So you're certainly right about that demand still being out there. People just want to get outside their homes. Glenn Fogel, the CEO of Booking.com, it's good to talk to you today.
Thank you very much.
Coming up, silver prices jumping more than 7.5% in this session. We're seeing the kind of spike we haven't seen since March of 2009. Are Reddit traders to blame? Jared Blickery is going to break down the technicals for us on the other side. Welcome back to Yahoo Finance Live. We're seeing a rebound in the broader markets on this Monday trading day. The Dow up 266 points. The Nasdaq seeing the biggest gains so far, up 261 right now. Let's bring in Jared Blickery for the very latest on the broader market moves, as well as the moves we're seeing in precious metals. Jared.
Yes, we will definitely get to those moves in silver in a second here. Let's check out the general market because we saw Europe settle in the green here. DAX is up nearly 1.5%, CAC 40 up over 1, FTSE in London up just a little bit less than that. But the standout today is the NASDAQ. That's up 2%. You can see clawing back now Friday's losses. So let's take a look inside the NASDAQ 100 quickly first because the mega cap names really popping today. We got Alphabet, Tesla, Amazon, and Microsoft, each up over 3%. Here is the sector action for the day. Tech and discretionary, loaded with those FANG names. Those are the outperformers, each up more than 2%. To the downside, everything is in the green, but energy and staples and materials, the biggest laggards here. Well, here are these shorted names, and we can see a little bit more red than we saw last week, notably GameStop down 15%. Let's take a 1 month look, still holding on to 1,300% over the trailing month here. But the big story of the day is silver. We can see some of the top performers here. We have Avino, Silver and Gold Mines. That's up 30% or 37%, had been up over 100% on the open. And silver futures, this is typically not a market that you would think would be identified by Wall Street Bets or on Reddit forums. And there is some pushback going back on some of these forums, and I'll get into that in a second. But I just want to point out that over the last 6 months, silver has simply been trading sideways. And here's another look over the last year. You can see after these tremendous gains it had, nearly touching $30, it just kind of went sideways here, and it finally broke to the upside. And the point I want to make is this was already a market that was technically poised for a breakout. It just needed a catalyst. Whether it was Wall Street Bets, we don't know. But the silver future, SLV, is having its biggest gain today in years. And you can see still up over 60% over the trailing years. So we're going to keep an eye on this market and everything from cost to GME going forward. But quite an interesting development here with the silver and general precious markets here.
Yeah, that's one of the points being raised by a few of our viewers, that it's tricky to say exactly who's behind the moves, considering some people, even in Reddit's Wall Street Bets, highlighting that it could be hedge funds trying to get them involved in this trade as well. But we'll see what happens. Jared Blickery, appreciate you highlighting that for us. We're going to take a quick break here, but when we return, the attention in D.C. turning to the issues facing the market, as we do see Wall Street Bets go at it with hedge funds here over some particular securities. What they're saying might need to change around taxing some of those trades. Stay with us. Breaking news out about Robinhood raising an additional $2.4 billion from shareholders, according to the Wall Street Journal. That comes on top of the $1 billion that the trading platform raised last week to shore up what has been, it seems like, a boost in necessary collateral to protect themselves against that surge in trades. Again, Akiko, that was something we heard from CEO Vlad Tenev when we spoke with him about the need to raise capital here to really make sure they had enough to back those trades through the clearing process, through that two-day settlement. I'm not sure if some of this $2.4 billion that Wall Street Journal is reporting on would get returned eventually once we get past this area of volatility. But that is more money now that they've raised, $3.4 billion in total, than they've raised in their entire existence, according to the Journal.
Yes, so $2.4 billion in fresh capital is what the Wall Street Journal is reporting. You combine that with the $1 billion last week that Robinhood raised from its investors, and we're talking $3.4 billion. It's interesting to look at that number when you consider this conversation that CEO and co-founder Vlad Tenev had with Elon Musk, out of all people, yesterday on Clubhouse, saying essentially that with the clearinghouses, there was a requirement of $3 billion. When talking about margin requirements that increased significantly, he said essentially Robinhood had to pay down $3 billion. So this would be pretty much in line with that. You know, the question on the other end is the same question we asked Vlad Tenev, which we did not get an answer to, which is what are investors on the other side being promised in exchange for this significant capital raise? The Wall Street Journal, as well as the New York Times last week, reporting that in exchange for that $1 billion at the time, investors were given equity at a discounted valuation that would be tied to the price of shares in the case of Robinhood's IPO. So that's something that we'll be looking forward to as well. But I mean, $3.4 billion in a span of less than a week, that shows you the position that Robinhood is in right now. And that feels like it's clearly over their head.
Yeah, it's a lot of money. And again, it kind of points back to why we were asking him, and I tried to get an answer out of Vlad around, their operation decision in 2018 to bring that clearinghouse operation internally. We heard from Webull's CEO talking about how it's very capital intensive to do that. And that's why they at Webull did not do that. They still use Apex because it requires so much money to settle these trades. And that's something that I think is contributing to the cash need here at Robinhood. But we'll continue to track that and see what happens. But $3.4 billion, as you said, Akiko, a lot of money. Obviously, the attention has been swirling around what changes might come through on the regulation front. And it's catching the eyes of politicians in D.C. who are potentially returning to calls to tax individual trades here in the system. For more on that, I want to bring on Yahoo Finance's Jessica Smith, who's taking a look at that for us today. Jess?
Yeah, Zach, we saw bipartisan backlash to this situation last week, especially after some brokerages restricted trading. The House and Senate both announced hearings. Democrats called for more regulations, and some progressives are now renewing their call for a financial transaction tax. We saw Congressman Ro Khanna and Congresswoman Ilhan Omar tweet about this. Omar saying Wall Street has fought to deregulate finance to pre-2008 levels, and the moment regular folks beat them at their own rigged game, it's shut it down. How about this? Financial transaction tax now. Omar and Senator Bernie Sanders did propose legislation that would tax transactions last year, and Omar told Yahoo Finance that that would help cover the cost of canceling student debt or making college tuition free. She also makes the case that this would reduce high-frequency trading. And there is new legislation. Just a couple of weeks ago, Congressman Peter DeFazio reintroduced his bill that would put a tax of 10 basis points on the sale of stocks, bonds, and derivatives. He says that this should raise $777 billion over the next decade. He told Yahoo Finance that the GameStop situation illustrated that Wall Street is, quote, completely broken. He went on to say in a statement that it is clear that comprehensive reform must be undertaken to repair the damage. Any reform must include my financial transaction tax legislation. The FTT would rein in the worst behaviors of Wall Street and help create a more level playing field for Main Street. Now, opponents of this tax, like Congressman Patrick McHenry, who we just heard from earlier in this hour, say that this would hurt everyday people who are saving for retirement. Zach and Akiko.
Okay, thanks so much for that update, Jess. We will, of course, be following any reports of that hearing as talks move ahead. Coming up, rumors of a potential merger in the energy space. Is a future marriage between Exxon and Chevron in the cards? Inez Ferre will explain on the other side. Shares of ExxonMobil and Chevron in focus in the session today on the back of a Wall Street Journal report that the CEOs of Chevron and ExxonMobil discussed the possibility of a merger last year. And you see these two stocks moving in opposite directions. Chevron up about 0.7%, ExxonMobil down 0.5%. The Wall Street Journal saying the talks are not ongoing and that the discussions were simply preliminary. Let's bring in Inez Ferre for the very latest on the broader markets. And as this is, despite the Wall Street Journal saying that this is not an ongoing discussion, it's certainly got a lot of people thinking about the energy space and whether, in fact, any merger would actually go through because of antitrust concerns.
Yeah, that's right. And the energy space, which we saw last quarter, which really was rallying the last quarter. Right now, today, as we look at the broader markets, the S&P 500, the 11 sectors of the S&P 500 being in the green, but energy gaining the least, so to speak, for the day. Today, you're looking at technology, consumer discretionary, which are leading the gains. Of course, we've also been taking a look at the heavily shorted stocks. We've been taking a look also at silver, which has been up today. We're looking at Silver Trust, the ETF, up more than 6%. Pan Am Silver, that is a mining company, that's also up today. I have been on that forum, Wall Street Bets, just to look at sort of the divide on there, because there are some Wall Street Bets members that are saying that they're not shorting silver, that this is not a thing. But you have Wall Street Silver, that's a subreddit forum, whereby over the weekend you saw a lot of activity as far as Twitter's concerned, as far as trending silver squeeze, and we saw silver today being up. Taking a look at GameStop, that is down 20% today. The short interest ratio is at about a third of its previous highs. Short interest actually plunged some to 39% of the free floating shares. That's from 114% in mid-January. That's according to IHS Market. If we also take a look at the EV space, I just wanted to show you some of the stocks that have been moving here. We've got a Tesla that's up more than 4%. This is after a price target increase over at Piper Sandler to $1,200 from $515. So Tesla today seeing a nice bump. NIO is down about 1%, despite the fact that NIO reported deliveries for December, which increased 352% year over year, Akiko.
Okay, thanks so much for that, Inez. We've got much more coming up here on Yahoo Finance Live, including the discussion about the Reddit traders and how that's affecting the markets. Also a conversation with the Lieutenant Governor of Hawaii. We'll be right back. Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Zach Guzman. Turning our attention to the broader markets right now, we are seeing green across the board. A bit of a rebound happening after the week we saw last week. We're looking at the Nasdaq seeing the biggest gains so far, up 276 points, the Dow up 236. From GameStop to the silver squeeze, Reddit investors potentially setting their eyes on a new target as we see the precious metal hitting an 8-year high. State budgets in limbo. Local leaders wait for federal aid as lawmakers debate the future of President Biden's stimulus plan at the White House. We'll speak to the Lieutenant Governor of Hawaii about his state's economic recovery. And big tech earnings on tap. We look ahead to quarterly reports from Amazon and Alphabet out later this week. Let's begin, though, with the bigger or broader economic picture with those non-farm payroll numbers expected out later this week. A lot of people looking at that data after we've seen a slowdown, at least in the broader economic recovery. Let's bring in Emily McCormick, who is tracking that for us. And Emily, what is the expectation going into Friday?
Well, Akiko, just taking a look here at the labor market, we are starting off February with a job market still heavily pressured by the coronavirus pandemic. We also have seasonal factors and tough winter weather weighing on employment in many parts of the country as well. But looking at where things stand right now, about 18.2 million Americans are still claiming unemployment benefits of some form. And the majority of these claimants of federal crisis era programs like pandemic unemployment assistance and pandemic emergency the unemployment compensation, which lasts until mid-March. Now, as of last week's data, we saw that 847,000 Americans filed for first-time unemployment benefits. It's about 4 times the 2019 weekly average of new claims. So still a very elevated number of Americans becoming newly unemployed, even nearly a year into the coronavirus pandemic here in the US. Now, this said, we are going to be getting the Labor Department's January jobs report on Friday. We closed out 2020 with an unemployment rate of 6.7% and net payroll losses of 140,000 in December. That had been the first decline since April. And economists are looking for that jobless rate to stay the same in January, although they are expecting the economy to return to adding back jobs on net, but only by about 60,000 according to that median estimate. Now, all of that is at the national level. I do want to highlight that we have seen some individual states harder hit than these national numbers suggest. As of December, we had Hawaii with the worst state unemployment rate in the nation at 9.3%, followed closely by Nevada with a 9.2% jobless rate and California with a 9.0% unemployment rate. So really seeing these states that rely heavily on the service portion of the economy getting the hardest hit here, and likely something we'll continue to see heading into January. Akiko and Zach.
Thanks so much for that, Emily. And let's turn our attention to the economy over in the state of Hawaii. As Emily pointed out, hardest hit by the pandemic, the unemployment rate hovering just about 9%. The state is optimistic, though, about a big bounce back. At least one local agency pointing to a 6.5% growth this year. Let's bring in the Lieutenant Governor of Hawaii, Josh Green. He joins us today. It is great to have you on today. That's a pretty optimistic number. It feels like things have started to pick up over the last several months, at least with tourism. How much of the broader recovery do you think is contingent on getting the federal aid that has been laid out by President Biden's plan?
Well, thank you for having me. It's contingent on federal aid and our ability to reopen the state. Those are the two largest factors. You have to realize not only are we at 9.3% unemployment now, we spiked to 23% unemployment when our state shut down, and we decreased travel to Hawaii by 99.6% when the pandemic began to surge and crush our country. Now it's dropping very quickly because we're doing a good job with vaccinations. We're also really expecting a huge year for travelers once it can be done safely. And travel will be defined by our ability to vaccinate ourselves. So it's those two factors that will help Hawaii recovery. And we'll recover like we did after 9/11, which was a crisis different, but also affected travel.
Yeah, it's kind of shocking to look at how Hawaii's unemployment rate has fallen. I mean, we're talking about the Bureau of Labor Statistics data, but when you look at the weekly insured unemployment claims, just to see that percent fall when you go from having about 1/5 of Hawaii's citizens on unemployment insurance to where it's at now, it's a steep decline here. And I know you guys put a lot into testing. You guys were one of the first states. I know you're on an island. I know you have the benefit of maybe screening people a little bit better than what we have back on the mainland. But how much of that really goes to show what you can do when you do put effort into testing and focusing on the pandemic?
A lot. Thank you for that. It was a proof of concept that actually worked. We created a safe travels program, which we launched on October 15th. And we went from a disastrous situation to, well, let's just say a less disastrous situation, improving every week. We were able to do it with a pretest. So if people travel to Hawaii, they must get a pretest from one of our trusted partners within 72 hours. It's a nucleic acid amplification test, super accurate. That's the PCR test. If you get that test, you can come here. And all of a sudden our numbers went from like nothing to 10 or even 15,000 per day, which was somewhere between 35 and 50% of our baseline. I've proposed a new way to go, which is as we track vaccination status in our state and on the mainland, we begin to let people come here if they can demonstrate they've been fully vaccinated, plus 2 weeks, which gives them immunity. My other life is as a physician, and that's why I'm focused very much on immunity and then travel.
Let me ask you, sort of building on that question, though, there's been a lot of talk about potentially having sort of a second passport for travelers that would determine whether, in fact, the travelers, number one, have been tested and tested negative for the virus, but also whether they, in fact, have the vaccination to sort of ensure that they are, in fact, immune in some way. Where do you stand on that, and how much of that do you think will help in at least boosting confidence for travelers to get out there to places like Hawaii?
It'll be an absolute game changer. We're in discussions with Health Pass and Clear. These are companies that do very good work. There will be others, I'm sure, in the industry and in this market. A simple, protected set of information which shows that you're immune. I had COVID over 9/11, and then I've been vaccinated as a doctor. And so to be able to show that on an app on my iPhone will be very, very helpful. And it's not just for travel. It'll also be for events. For instance, if you want to hold a marathon in your city, it might be good to demonstrate that you've got immune runners. If you want to hold concerts again, or you want to have a Super Bowl, though I do hate both teams in the Super Bowl, you can have that Super Bowl and have people be in the stadium safely. So this is going to be important for us through 2021, 2022. It will drive economic growth and recovery. And for Hawaii, where we will need to get back to some larger portion of our travelers. We used to get 30,000 a day or 900,000 a month. We'll have to be safer, and that will be one way to do it.
I should note here, too, I mean, you're also a doctor, as you said. You still practice there. You're the only lieutenant governor that I know of that's also a medical doctor. So when you look at kind of the response you've seen in Hawaii and what could be applied to the U.S. as a nation, we've seen other nations kind of lock out international travel. We know more of that now kind of coming through here as we try and protect ourselves from the variants that seem to be already here in the country. But when you apply what Hawaii did to the nation, does it kind of show that maybe some earlier protections, if they were put in place, that perhaps the nation as a whole would be in a better spot?
Yes, if we had done essentially a safe travels program nationally, we could have decreased the cases coming in by about 80%. Also, variants, of course, track very closely because you just have to do the genetic analysis of the cases that you get. And it's good because when you have these safe travels program, you can isolate where people came from and then test those samples if they happen to be positive. So you can get a quick idea about the variants. Obviously, we're very worried about the B117 variant out of Great Britain. So there's lots of this that has to be done. We should apply all of this. And it was nice to see that the federal government did kind of emulate a little something from Hawaii, which was a derivative of the Safe Travels program. But also to have travel passports will be very helpful. We will still let people come here, even if they don't get vaccinated. We're fair. We don't expect people to all get vaccinated. We don't force anyone. But then they would have to do the Safe Travels program. So multiple layers of safety gets you there. And that's how you expand your economic footprint again. We were devastated, but we will be back down to 4 or maybe even lower % unemployment again as soon as we get through this vaccination process and get into a place where our elders are safe.
Let's talk about the impact of small businesses. No question, a lot of the small businesses in your state certainly very reliant on dollars coming in from tourism. I'm looking at the data from the previous Paycheck Protection Program early on in the pandemic, $2.5 billion from roughly 25,000 companies in Hawaii. What's your expectation this time around? And what are you hearing in terms of how significant that support has been, especially for small businesses in your state?
Well, I'll say it's critical. It's critical support for the many small businesses. The small business community was hit the hardest in our state, harder than our public workers who we did not have to furlough. The gov has considered furloughs, but it hasn't happened yet. The small businesses just totally got crushed. And of those loans that they got, a very small percentage of people have been able to get forgiveness so far, though we're ramping that up going forward. I expect a lot more PPP loans. That's how we're going to get through the kind of edgiest part of this crisis. But I think Hawaii will be open pretty well before Labor Day. I think that we will be the most open, most safe state in the country. And there's a clear idea that a lot of people have pent up desire to come back to paradise because our case counts are lowest in the nation. Our mortality rates are lowest in the nation. We just want to do it based on analytics and safely. But the small businesses have to recover. We have so many friends that hire 5, 10, 15 people, and that's why we do that to lower our unemployment.
Yeah, and it's shocking. I'll just hit it one more time because you're right. You went from being the highest unemployment rate in the country for any state in 2020 to dropping out of the top 10 entirely. So, I mean, just to kind of put a nail in it here, it was surprising to see the approval rating of your guys' governor, the lowest in the nation, perhaps due to that surge earlier on in the year. But as you've dropped it down, I'm sure that approval rating might catch a boost. But when you kind of talk to citizens there on the island, what do you make of that and how people there are feeling about the response now?
Well, people are feeling a lot better. Our gov is a very good guy. He doesn't get out there like me as a big mouth and talk a lot. So it's harder for him to celebrate some of the successes. But he's doing what he can. And as you can imagine, when you shut down travel that much, like 99+%, it really hurts. But on the other hand, we've only had, and I say only, please don't take this callously, 410 fatalities, lowest in the nation. When you match for the population on the mainland, we should have had 1,600 fatalities. We've had 25,000 cases. We should have had 125,000 cases. So the successes are evident about keeping people healthy and safe, but the economic fallout was heavy. Everyone understands that Hawaii will come back fast. We went from the lowest unemployment to the highest, and we will be back lowest again. It's going to really probably blow your minds, but that's how valuable the brand is for Hawaii and why we had to make sure people were safe.
Yeah, so much you guys got right over there, and we're seeing what could have potentially gone right here at a federal level too in the aftermath. But appreciate you coming on here to talk about that. Josh Green, a doctor and also Lieutenant Governor of Hawaii. Thanks again for coming on. I want to switch gears here over as we talk about the impact here, of course, not just different on a state-by-state basis, but also, as we've been highlighting, the hits to female employees quite a bit more felt here in the pandemic. That was the focus of an interview from Yahoo Finance's Jen Rogers, catching up with Martine Furlan, the CEO of Mercer, one of the world's largest HR companies, to chat about the disproportionate impact the pandemic has had on female workers. Take a listen.
You can see in the U.S., for example, the jobs that were lost, about 55% of them were women jobs, and they make up less than 50% of the workforce. You can see that they've been disproportionately impacted, and it's on account of two main things. I mean, women are very engaged in frontline work, essential working, healthcare work, etc., hospitality, retail. So these are industries that have been very impacted by COVID, and also just the sheer amount of extra work that was on carers. And it just happens in our societies that women tend to be the one who take on these responsibilities in greater proportion. So we have evidence that some women have just decided that it was too much and they needed to withdraw from the workforce, at least hopefully just temporarily.
Are those jobs, because we talk about big changes here with automation and technology, is there any concern that those jobs aren't coming back? Like, are these women going to have the opportunity, if they want to go back to work?
Well, clearly, and that was a trend that was there before COVID. I would say that automation is impacting many of these jobs, and therefore what we've seen, and it's a particular characteristic of this crisis, whereby we've seen actually an accelerant of some trends rather than slow down. So this is something that we saw before, and we need to continue to upskill, reskill people so that they can bring what humans bring to jobs like these and utilize technology to augment the impact of these jobs. So it's a question of shift that indeed I think has been accelerated through the crisis.
At the beginning of the pandemic, I think many women were not excited, is the wrong word, but thought maybe this will be better. Like, I won't have a commute. I'll be able to work from home. Does that, on the other side of this, actually come to fruition? Is there a silver lining for white-collar women to be able to have flexibility?
Yeah, well, this has all been done in such exceptional circumstances, with kids not being at school, for example, everybody being at home, sometimes in spaces that were not designed to give everybody their space to do the homeschooling or the work, etc. So I think when well managed in normal circumstances where the usual infrastructure is working, it is something that can really help people who have extra non-work responsibility to manage better. But we've also seen that for everyone, not only women, working from home, or actually we said sometimes living at work, has created a different stress as well, where people think or see that it's difficult to detach from work. We've started to measure the impact of the extra time, and we were talking about 20 hours a week more that needed to be done because the support system, which is not operating. So I think that as we think about the new normal and the returning to to a society that functions as it should. Flexible working, if well managed, can certainly be an advantage for women that have these duties.
Welcome back. From GameStop to what looks like potentially silver, we are seeing at least some part, of course it's not all monolithic, at least a piece of Reddit's Wall Street Bets forum maybe shifting their attention to silver. And take a look at this. You're looking at BlackRock's iShares Silver Trust, the largest exchange-traded product tracking the metal, seeing a big pop today on that interest in silver as it enjoys its biggest one-day boost since 2008. And for more on what all this means, I want to bring on our next guest. Phil Strabel is Blue Line Futures Chief Market Strategist. He joins us now. And Phil, you were just talking to us in break that this move isn't necessarily all triggered or wasn't just out of nowhere. Talk to me about how much of this came before even maybe Reddit took an interest.
Yeah, we've been positioning ourselves for a long-term play on silver, especially for the first half of 2021. We had looked at the reopening process and the growth in electric vehicles, the growth in solar, and we were positioning ourselves for a gradual move higher. We did have a price target of $30 to $35 for the first half of 2021. It just happened that we had an army of individuals that had got done being tired of being long Bitcoin and Tesla. They rolled into high short interest, high beta plays. They squeezed hedge funds higher, and now they're looking for other targets. And silver is a likely target just based upon some of the dynamics that they've got limited supply of silver, increasing demand, high short interest, and it's a high beta play. So why not, go into it?
So let's talk about your thesis, because at this point, I think there's some debate about who's actually behind the big jump that we have seen. When you talk about positioning on that front, at least in this particular precious metal, how much of that do you think, how much of that for you has extended beyond the metal itself, looking at miners, for example? I mean, what are you anticipating in terms of upside on that front?
Well, on the miners, I mean, you really need to break down as to like the miner that you're getting involved with, because we've seen 3 or 4 targeted that they've done a great job. They're well-run mines, but when you get into other ones, the mines themselves, they might not be producing the metal that you're looking for. A lot of them produce several different metals. You got to look at the countries they're in. You also have to look at, energy costs, labor costs, and rising interest rates. They're all going to weigh in on these underlying junior miners. So the pop in those might not be an extension, and it might just be a short-lived event, where if you look at the futures and some of the ETFs that are backed by, the physical, those have a better potential to continue to move up and hold and progress forward. A company could also issue more shares. You always got to remember that.
Yeah, and Phil, I mean, when we look into it, it's been interesting because some people have pushed back and said, look, maybe hedge funds or bots could be driving the interest in Wall Street Bets, the forum on Reddit here. When you look at the move, though, talk to me about what you're seeing, because the extreme of today, whenever you go back and say silver's having its best one-day move since 2008, a lot of people will look at that and say, what's really going on here? So what kind of volatility does that maybe trigger in the commodities market when you see a move like that?
So we did see implied volatility premium. It just went through the roof, which means that the second that the market did open, everyone tried to buy at any all costs. And like I told people, this is something you should have been building for a long period of time on silver based upon classic supply demand fundamentals. You don't want to be the guy who's buying fire insurance while your house is on fire. And that's kind of what we saw this morning. So naturally, silver gave back some of its early gains. We're really looking to see if it can close over 30 and extend from there. A lot of these markets, like what we saw in GameStop and even what we saw in Bitcoin, when Bitcoin broke out over 11,500, had an next resistance point at 20,000. Once it broke out through there, it seemed like it was really, game on. And the same thing with GameStop. There's no telling how high they can push these. How much are they going to trigger as far as, some of those shorts buying back? And, the commercials, they could always lift some of their shorts. A lot of, airlines and a lot of producers, when it came to oil, they lifted some of their shorts and some of their hedges, especially when prices were either dropping too fast or they were rising too fast.
And Phil, you said that you see it pushing above $30. We're already at $28.74 right now. Walk me through the fundamentals and specifically what you think that says that supports the case for this to move even more to the upside.
Well, we would really anticipate that, once we get the close over $30, you're going to see another rush to come in. And based on a technical chart pattern, it's going to validate a breakout over it's a bull flag that you have if you pull up a chart. So that's going to attract a whole nother level of people out there that are just specifically trend following investors. The other thing that's an interesting dynamic is that you always had this differential between the gold and silver people, the people that are true believers in it. That was a particular generation. And it seems like there was a gap between those people and the people that buy into Bitcoin and new technology. And what we're having is an emergence of those two parties together. So I think it is even a bigger event than, say, Bitcoin rallying up. So I don't want to put out like specific price targets on it or how high it could go, but it really could gain some momentum and track higher.
Yeah, it's probably smart because we had a few analysts on in the midst of that GameStop bubble, and no one knew where that was going to go. But Phil, when we look at what you said there on hedge funds or whoever being able to take their short position off, that is an interesting piece of what was talked about in Wall Street Bets. Kind of why this was focused on is because some banks out there have positions and might not want to deal with the physical silver itself. So how much truth is behind that, and maybe the thesis that's being discussed around pressuring institutions and causing these problems around silver?
Silver is a very heavy metal. I mean, one of those contracts, like a 1,000-ounce contract, that's going to be like 66 pounds of it. So for them to go through this whole physical, supply squeeze and everything else, for people to actually try and remove this and break some of the banks that might hold it or might be on the paper shorts, they're really going to have to get that price up there quite a bit. And they're really going to have to remove the silver from the exchanges by taking delivery to create some kind of like force majeure. That's how you would seriously break, the exchange dynamics, and you'd break some of these banks. So they're going to need to get prices a lot higher. They're going to need to remove from the exchanges by going through the delivery and loadout process.
Well, we would love to have you back on the show if we do see it pop in a significant way. Phil Strebel, Blue Line Futures Chief Market Strategist. Appreciate your time today.
Thank you.
Coming up, the impact of the Reddit trade on corporate bonds. We'll discuss potential contagion risks. That's coming up after the break. The Reddit trade has helped protect the debt positions of a number of cash-strapped companies, including GameStop and AMC. AMC's bonds were the most actively traded debt from a list of stocks in the Russell 3000 index that was caught up in the short squeeze. Let's bring in Chris White. He is the CEO of BondClick. And Chris, while so much of the talk last week was about the surge in GameStop, you say the bond story is really about AMC. What specifically did you see in the corporate bond moves coming on the back of the Reddit trade last week?
Yeah, the story is really in the price action that we're seeing on AMC. The GameStop bonds have really traded around par during most of this time and are coming from a place where they were trading at par. But when you're looking at AMC, going back to October of last year, their 5-year bonds, or one of their 5-year issues, was trading at around $7.50. And now that same bond is trading at close to $75. So a 10 times increase in the value of that bond. And that's definitely due to a lot of the action on Reddit and a couple of other factors.
Yeah, what are those other factors too? Because when we talked about bonds earlier in the pandemic, obviously that market was hit pretty hard with the fears about where this was going to go. But what have you seen in the way that maybe AMC ties back to those bankruptcy fears kind of being reduced through some of the money they were able to raise?
Well, we always have to remember that bonds sit up higher on the cap structure. So if AMC were to go bankrupt, there are still some assets that could be liquidated and paid back to bondholders. Obviously, if you hold AMC equity, you're sort of out of luck. You're probably not going to, AMC will basically go to zero and your stock will be worthless. So it's a little bit of a different approach in terms of trying to value the bonds as opposed to the equity. But one of the major things that happened with AMC is they had a private placement deal with a hedge fund called Silver Lake, in which basically they had borrowed $600 million in the form of a convertible note, which would convert into equity, or a convertible bond effectively. And I think that going into it before the Reddit rally, I don't think anyone imagined that the debt would be able to convert into actual equity, but that actually happened on Wednesday, where 44 million shares were basically issued in exchange for the 600 million in debt. Silver Lake made a nice profit of 281 million, and effectively you took that debt off of AMC's books. So that's one of the things that I think changed the perception of whether AMC can be solvent going forward, which is basically what controls a price action in a bond.
Chris, the big question, of course, is how much of this rally that we have attributed to Reddit is here to stay. As it relates to AMC specifically, you've said that the debt market is really the one that's going to be indicating whether the short squeeze rally is over. What's the number that you're going to be watching on that front? And what have you seen, at least just in the trading session today?
Well, we're still seeing a lot of activity in AMC. We're still seeing it move to the higher side of where it's been trading for the past 6 months. I think a couple of things to look out for. One of the most important things to look out for is, can AMC actually tap the debt markets again for capital? And can they do it at lower interest rates than what they were doing earlier in 2020? If they can, it actually bodes well for AMC to kind of get through this in a way that someone might get through a troubling personal financial issue if they could refinance their home and do it at a lower interest rate. So that's what we're really looking for in terms of the long-term health of AMC. The difference in the stock and the bond market is when you're investing in that bond market, you're taking a long-term, let's say 5-year view on a company, because just trading in and out of the debt can get quite expensive. So it's not a sort of buy and flip like you might do in the stock market.
Yeah, it's interesting to hear you talk about kind of, the nitty gritty of what went behind this move, because we obviously saw #SaveAMC trending on Twitter when retail investors caught attention to this. But we knew that they had kind of, addressed that question before it took off, because we had seen the CEO come out and say, look, bankruptcy at least is not going to be on the table for this year. But how much truth was kind of behind, the share pop coming from the retail side with that attention around SaveAMC that allowed them to kind of offer equity, offer shares to pay down that debt that you're discussing? I mean, how true is it that retail investors did come in here to play a part in that rebound?
No question about it, because when you have convertible bonds, the bonds are pegged to a strike price. So if the stock, just like a call option, so if the equity hits a certain level, then converting the bonds actually into equity makes sense. And so when Silver Lake converted, I think they converted at a price of $13.51. The close for that day, this was last Wednesday, was something like, I think it was $19, almost $20. So instantly, there's a six point profit to the bondholders to convert out of debt into the equity. To the company, though, they don't have to pay off that debt. They've obviously issued more shares in order to handle the convert. And that's really, really great for their cap table, to not have to pay off this high coupon debt and instead just issue more shares and then be able to tap the debt markets again, potentially at lower interest rates. These are all positives for AMC. So they definitely have the Reddit users to thank for that.
And Chris, while I know you're focused on AMC, of course, a number of other companies that were caught up in the short squeeze, if we're talking about the impact from the Reddit trade, what are some other names that you're watching that you think could benefit on the back of this?
I think that any company that has had issues with tapping the debt markets, whether it's getting more and more expensive, where maybe you're seeing a lot of short interest in the marketplace from an equity standpoint. I think if the Reddit rally starts to hit those companies, it starts to change the conversation around that company's solvency going forward. The interesting thing about the debt markets is people aren't really trading the fundamentals of today as much as they're trading the fundamentals of tomorrow. Everything that we're doing in the debt markets is we're trading based on whether or not we believe a company will be able to pay off their debt. Now, not every company is going to have a private placement convertible bond issue like AMC had and get a windfall from the uptick in their stock. But it is interesting to me that GameStop, their price has really stayed around par throughout this turmoil. It basically tells you that what the bondholders are saying is, regardless of what's happening in the equity market, we think the probability of GameStop paying off their debt has pretty much remained the same.
All right, Chris White, appreciate you coming on here to talk about that. Fascinating to hear you walk through how all these things trade together. Appreciate you taking the time.
Thanks for having me on, and Happy New Year.
Happy New Year. We're going to take a quick break here on Yahoo Finance Live, but when we return, breaking down what to expect in another week of busy tech earnings on the docket. Dane Halley will break that down for us right after this. Welcome back. We got a busy slate of earnings again this week, including some big tech names that you may have heard of before, including Amazon and Google, set to report tomorrow. For more on that, I want to bring on Yahoo Finance's Dan Halley with a look ahead. Dan?
Yeah, so let's start off with Google here, rather. What we're expecting out of them from revenue is $44.55 billion and EPS of, 15.57. So they obviously are going to be coming into this quarter. I think one of the big things people are going to be looking at is the breakdown of its cloud business. They right now report cloud revenue, but it's not broken down as far as G Suite and its other services or Google Work, which is what G Suite was. And so they're going to be breaking that down. We'll get a better understanding of how their cloud business is doing. There's expected to be year-over-year growth there. Obviously, the big moneymaker for Google is advertising, and YouTube is supposed to be up there on that list of big advertising wins for this past quarter. But I think really the main focus is going to be on where the money goes to as far as Google's cloud offerings are and what that means going forward, what the forward-looking projections are, and what the year-over-year increases are there. Because don't forget, Google Cloud still not as big as Microsoft. It's closing in, but Microsoft still number 2, followed by Amazon. And as far as Amazon, let's talk about them. They are expected to show revenue of $119 billion for the quarter, an EPS of 7.34. And one of the big things that we're going to talk about out of Amazon is obviously the revenue from the holiday shopping season. So many different stores were closed. They've been a big beneficiary of the pandemic, people shopping more online there, but also the navigation to the cloud. AWS, again, the largest cloud provider out there. And because so many people have been forced to work from home, a lot of businesses have had to ramp up their cloud spending. So we could see some commentary on that. And going forward, and what we're going to expect as far as the comparison from last year.
Doesn't matter which company we're talking about, right? The headline's always around the cloud and the growth on that front. Dan, some headlines coming out for Google and their cloud with a partnership with Ford, naming Google as a preferred cloud provider for all of their vehicles. How significant is that?
I think it's a very big move on their part. Look, we just had the announcement from Microsoft and GM and Honda as part of the Cruise initiative that Honda and GM have. Microsoft's the preferred cloud provider for them. But this is a little bit different for Ford. Essentially, what Ford is going to do is make Google its preferred cloud provider, but then also power all of its Ford and Lincoln vehicles with Android, the infotainment system, not the vehicles themselves. So you're going to get rid of the sync system that they have now, which has always been kind of clunky. They're on sync 4 now. Never been a huge fan of it. And now they're just going to rely on Google for the interface. That means that your base mapping software is going to be Google Maps rather than a proprietary offering from Ford. And it'll offer you Google Play Store, so you'll be able to download apps like Spotify, podcast apps, things along those lines. Interestingly, I reached out to Ford, and they did say that they were still going to offer CarPlay capabilities. That's Apple's in-car infotainment solution where you connect your iPhone. So they still are going to offer that despite it running Android. And obviously, that's a smart decision on their part because they don't want to alienate half the smartphone users in the U.S.
Okay, Dan Halley breaking down all the tech moves for us today. Thanks so much for that. Much more coming up ahead here on Yahoo Finance Live. Jared Blickery on the other side walking us through the day's moves so far. He'll also be joined by veteran trader Kathy Donnelly. That's coming up after the break. Welcome back to Yahoo Finance Live. The NASDAQ leading the gains in the afternoon session, up just over 2%. The Dow up about 0.7%, while the S&P 500 is up 1.5%. Let's bring in Jared Blickery for the very latest. And Jared, your focus here on SPAC and IPO issuance at record highs, along with a special guest there, Kathy Donnelly, veteran trader and IPO expert.
That's right. You wrote the book on IPOs, Kathy. And well, before we begin, because I know we got a couple of tickers that you're looking at today, I just want to address the elephant in the room here. We have this incredible situation with GameStop and these heavily shorted names. Report from the Wall Street Journal today that a lot of these SPACs that are coming out have been influenced by Wall Street bets. What's your take on the situation here?
Yeah, I feel like we're in unprecedented times, Jared. When we did the research, we weren't even looking at SPACs, and now that's all we're talking about. I feel like they're very similar to the IPO advance phase that we studied. They're going straight up, and you need fast rules, and you need to be able to withstand the volatility. So if that's your style, then I say go for it.
All right, go for it. Well, let's take a look at Airbnb first. This is an IPO launched last year, first began trading. What are you seeing in this stock right now as we pull it up here?
Yeah, I wanted to talk about this stock because I feel like it has a lot of potential. It's just recently broken out of an IPO base. So it could have an IPO advance phase that I was just talking about. Perhaps it goes up 20, 30% or more from this recent buy point, that consolidation that it created after basing shortly after. But I feel like if traveling is going to be picking up this year, this is going to be a great one, hopefully 6 months from now. As you know, I'm a longer-term trader, and I like to wait for that institutional due diligence phase that we've talked about and waiting for that first mature base. So it's tradable now for sure for those fast traders that we talked about, but I'm really hoping for a nice consolidation, good due diligence phase, like I mentioned, and then maybe 6 months from now, really have a lucrative run where it's able to start an institutional advance phase.
Yeah, and I love the way you map out, and scientifically and with statistics, these different phases that the stocks go through. And indeed, it takes a while for institutions to kind of wrap their head around the business model. You need maybe a quarter, 2 quarters of financial statements into the business after it's traded. And then Palantir is another name you're looking at. We're pulling up a chart here. This goes back to inception of trading. What do you see in Palantir right now?
Palantir, I really like. I actually did trade it from that IPO base. And unlike Airbnb, it broke out from that IPO base and just had a great run. And, one of the rules we talk about in our book is the Ascender rule. And I did a quick calculation. If you had traded the Ascender rule, which actually takes gains on the way up at breaks of the 21 EMA and the 50-day, you'd be sitting on about 160% gain right now and could still be holding it. What I'd really like to see with Palantir is maybe we get a stair-stepper pattern where it continues basing here or breaking out like it did last week during that volatile week that we had. But if it keeps going, maybe it turns into a stair-stepper and we don't get the due diligence phase. And this is one that we could hold on for a while. It'll be really exciting because, as you know, Palantir's got a great story. The liquidity is just amazing.
Yeah, and definitely we see so many IPOs coming to market today after they're already well-established companies. Like Airbnb has been in business since what, 2008? Have you found that kind of affects the trading at all, just because they are such a larger company coming to market, with a capitalization of a few $1 billion? Has that changed the game?
Yeah, I think it has. We always say, oh, well, if it come out now, it'd be do much better. But really, when you look at all this, when we looked at all the stocks from 1982 to 2017, they all still went through the same patterns. And even like Uber, for example, had been around for a long time. It's, just now it looks like it's creating an institutional advance phase and finally breaking out into all-time highs from when it first IPO'd. So, you think that, but ultimately it's psychology. The patterns still appear.
Yeah, and I think it's important to note too that it takes a while for some of these issues to really get off the ground. I remember Amazon had several 80 to 90% corrections in the 90s, and as it was going into the new decade, the new century. Well, Kathy, you're going to be joining me on Wednesday for a special webinar. We're going to be talking about SPACs, IPOs, outlining the methods of your book, and also the influence of this incredible GameStop phenomenon that we've been witnessing here. So you can sign up at our website, yahoofinance.com. Also go to my Twitter feed. I'll have a pinned tweet at the top there so everybody can get that free registration. Again, 2 p.m. Wednesday, go in for 45 minutes with Kathy Donnelly here. Thanks, guys.
Okay, Jared, looking forward to that webinar. Thanks so much for that. And our thanks to Kathy as well for joining. Zach, before we go, looking at some updates here coming in from Robinhood right now. The platform has increased the maximum number of shares and options contracts that users can add to their positions. A number of restricted stocks that we talked about last week when they were limited, these are the names that Robinhood is now saying you can add a little more to your position, like AMC, like Express. GameStop, I'm looking at still just 4 shares for individual users in terms of additions. But this does seem to make sense in light of that news that we got from the Wall Street Journal saying the company raised an additional $2.4 billion from its investors.
Yeah, and they've now confirmed that in a blog post on their, on the Robinhood blog. So we have seen them, kind of explain what went on behind the scenes, and it does match up. You're right. I mean, it's all looking like these pieces are falling into place from what we learned in our interview with Robinhood co-founder Vlad Tenev on Friday in our line of questioning. And there's some, particular sense of vindication that comes through that when we were talking to him about clearinghouse issues and the fact that they would need more capital to kind of settle these trades in periods of volatility. But I think the big questions still go back to those that he did not want to answer, which is why they chose to go this path back in 2018 to internalize the clearinghouse operations. Obviously, if you're not prepared for that volatility, that is a problem, and customers do have a right to be angry around that. But looking beyond Robinhood, Akiko, I don't know about you, but after our interview, I still get tweets at Zgoos on Twitter, self-plug there, from people who are complaining about trades on E-Trade, Schwab, TD Ameritrade. Even though those brokerages said they didn't restrict buys, there were complaints from customers saying that they couldn't trade, settle trades, and did see losses, material losses around, trying to trade on Thursday when we saw these big pops. So I think that there's still a lot of questions to get answered, not just with Robinhood, but with brokerages across the board for what went wrong. And again, those lawsuits we're going to see from customers, where those go.
Yeah, always finding an opportunity to plug your Twitter feed, Zach. But to that point, I mean, there are certainly going to be a lot of questions, some more valid than others. And let's start with what you just pointed out, because I certainly have gotten messages as well from those who were trading on Robinhood saying, why, in fact, the company did restrict trade last week. I think Vlad Tenev has pretty much laid it out, not just in the multiple interviews he's given, including us, but also in the blog post. It appears that at least right now, on the surface, the company is in some ways protected from the user agreement that essentially says the company can restrict trade at any moment. He's put forward that explanation. But what's going to be interesting to me to watch, in addition to all of the other threads we've been watching, whether it's the regulatory investigation, the lawmakers investigating on the Hill, is also how many users stay on the Robinhood platform. And this is something we highlighted last week. They may have popularized this zero commission model, but we've seen E-Trade, so many other brokerages adapt that as well. So you don't necessarily have to be on Robinhood anymore to be able to trade in the way that you could years ago. So that's going to be an interesting one to watch. And then I think there's still questions about the cash position for this company. What does the balance sheet look like if they had to raise more than $3 billion in less than a week? And are investors going to stick by them, at least according to what we saw today, more than $2 billion raised. So it certainly looks like they are backing them, even in the face of all of this volatility.
Yeah, and we asked Congressman, Peter McHenry about the larger issue of pay for order flow and what that means for brokerages and what they're going to want to do about that issue. We've already seen one, public.com, saying they're going to break from that model. I wonder if other brokerages might follow in that, because more people are learning about maybe potential conflicts of interest around routing those trades to some of these market makers and kickbacks around that. It's kind of exciting to see everyone get involved and interested in the nitty-gritty behind the scenes. We'll see what reforms come from it, but no doubt our eyes will stay on Reddit's Wall Street Bets to see where this goes next. Stay with us, though. We got much more coverage coming your way here on Yahoo Finance Live after the break.
Welcome into Yahoo Finance Live and happy Black History Month to everyone at home. Let's take a look at the market action right now. Stocks are in the green. The NASDAQ up about 2.5% right now to kick off this month. Markets are rallying after we did see a sell-off frenzy last week as we saw those Reddit-fueled surges in the market. So let's talk about them. Let's take a look at some of those short squeezes that we had been seeing over the last week. As you can see there, GameStop right now in the red, down about 24%. AMC, however, is popping over 6%. So there's a mixed bag going on here with some of those Reddit-fueled trades that we have been talking about over the last week. Some other stocks, as you can see there, Express, Bed Bath & Beyond, and BlackBerry, Express and Bed Bath & Beyond, both in the red. BlackBerry getting a slight boost there, up over 5%. Now, these Redditors have actually turned their eyes to a new target, which I want to look at next, which is silver. Silver is soaring right now as Redditors have been piling into this trade. As you can see there, up over 8% right now. We had seen silver touch highs, the largest highs in over a decade. Right now, we're at about an 8-year high in silver. Now, lastly, I want to take a look over at Moderna. Moderna is in the red, down about 10% right now. Now, this is coming after Bank of America actually downgraded the stock to underperform from neutral. That's taking a huge hit there. The concerns were largely around Moderna's valuation. But I want to start the show with what's happening in the markets right now. There's a short squeeze surge frenzies I've just been talking about has now set its sights on silver, as we were just looking at, up over 8% right now. So I want to bring on Yahoo Finance's Inez Ferre now to tell us what's been happening. So first GameStop, now silver. I have no idea what's next. I never thought I would be talking to you about this, Inez. What's been going on?
Yeah, Kristen. Well, over the weekend, we saw trending on Twitter, silver squeeze. We saw silver futures being pushed higher. So you're seeing a boost in silver because of these Redditors that have been pushing for this short squeeze on the precious metal. I will get to one point, though, of a bit of a divide when it comes to this. But first, let's take a look at some of the silver-related stocks that we've been watching. We've been watching Silver Trust, which today is up more than 7%. I also want to mention some silver mining companies, Avino Silver and Gold Mines, up 43%. As to that divide on the Wall Street Bets forum on Reddit, there's people who are saying, or traders who are saying, buy silver, silver short squeeze. That's been trending on Twitter. But then there are those who are saying there is no short squeeze. And this is specifically on the Wall Street Bets forum, because you also have a Wall Street Silver subreddit as well. And on that Wall Street Bets forum, you've got users that are saying there's no short squeeze. This is only to distract us from GameStop. And they believe that this will actually help hedge funds if these traders are pushing up silver, specifically Citadel, which has an investment in Silver Trust. So that's what's been happening behind the scenes here when you take a look at the forums. Now, when we talk about some of the heavily shorted stocks that we saw surging last week, GameStop down 24%. I do want to mention that the short interest ratio on GameStop is about a third of its previous high. So you have short interest, which plunged to 39% of free floating shares. That's from 114% around mid-January, and that's according to IHS market data. And also, Robinhood has loosened some of the restrictions when it comes to some of these stocks, to buying some of these stocks, and also option contracts. So users can now add a little bit more than they could before. When it comes to GameStop, when it comes to AMC, excuse me, when it comes to cost, Express. So you're seeing some of these stocks, though, that are under pressure, the ones that we've seen over the last week surging on that short squeeze, Kristen.
Now, Inez, I know that you've been following this over the course of the last week, been diving into some of those Reddit threads. I guess the main question here for you is perhaps either what's next after silver? If it was first GameStop, now we have silver, of course, moving on to AMC. So what could possibly be next? Or perhaps how long do you think that this is really going to be dominating the narrative that we have going on in the markets? How long do you think these Reddit-based traders are really going to keep this up, so to speak?
Well, if you look at the forums, I mean, the ones that are really gung ho for this short squeeze are saying, hold, we can take this to the moon. I mean, that's one of their phrases, GameStop to the moon, right? But if you take a look at some of the short interest, which has decreased, there are some experts out there that are saying that when you don't have as much short interest, then you don't see, of course, that much of a short squeeze if you've got investors that are pushing up the stock. But certainly, it's anyone's guess as to how long this will hold. I mean, you did have GameStop being the focus last week. Now you seem to have this sort of shift towards silver, and there is a divide there among the forum as to whether or not it's really shifting towards silver or whether this is a push from hedge funds, et cetera. So it's anyone's guess. But I would say that talking to people on both sides of this issue, I would say that they believe that GameStop can't be at these high levels given the fundamentals for that long, and there will be somebody that will be left holding the bag at the end. So that's a warning that's definitely come from the experts and from both sides, really.
All right, Yahoo Finance's Inez Ferre, thank you for bringing us all of those updates. Who knows how long we'll be continuing this conversation, how long we're going to be seeing this surge in silver, but thanks as always for bringing us that information. I want to continue on with this conversation, and now I want to bring on Robert Dye, Chief Economist with Comerica Bank. So Robert, we have this frenzy in the markets lately. Its target, as we were just talking about, was GameStop and then AMC, and now it's on silver. I'm curious to know what this does to companies like GameStop or AMC or Express or some of the others in terms of their stability as you see their stock prices surge and then completely drop again in just a matter of hours.
Well, as you see, it's like the Wild West out there. There's a huge amount of liquidity floating around in the system, Kristen. And if you're an executive in one of these companies, you're watching these the ticker just go in with incredible velocity. And certainly when you compound that with all the economic uncertainty out there and coronavirus and everything else, it's the understatement of the year to say this is a highly uncertain environment, and it's very difficult to plan through this. So I don't envy those executives who are dealing with this.
So as you just mentioned, this is piling more uncertainty in already uncertain times. So as we look then more broadly, how do you see this at all possibly impacting the economy or even economic recovery?
Well, we've got some huge issues that we're dealing with right now, Chris. And of course, the coronavirus and the efficacy of the vaccine and the potential for mutant strains of the virus. Huge amounts of fiscal stimulus in the system, $900 billion coming at the end of last year, right at the beginning of this year. And now we have the Biden administration proposing a $1.9 trillion program, and a group of Senate Republicans, of course, coming back with a counterproposal of about a third of that. So there's a long way to go here before we reach some consensus about what we need to do for the remainder of this year in terms of some of these sources of uncertainty.
Now, keeping on that, because in your notes you talk about how economic risk factors are already complex and how they are becoming even more complex as this time has been going on. I'm hoping you can talk us through that, how you see some of these economic risk factors becoming even more complicated.
Well, like I said, we've already got some stimulus coming into the system. We've got a proposal for more. We have the uncertainty of the vaccine distribution system. We don't really know exactly when that break-even date is that we start to put coronavirus behind us. Maybe it's around Labor Day, maybe it's a little bit earlier, maybe it's a little bit later. So what's emerging right now is this consensus forecast for a rebound in the second half of this year. But there's a lot of wiggle room around that. In the second half of this year, we're talking anything from July through November, December. And on a day-by-day basis, we tend to sort of get pushed back to the end of that or pull it up. And so that's a very big window now. And I get concerned about that because I am concerned about the vaccines. I am concerned about the hybridization of it and the efficacy of the vaccines. And we can't take any of this for granted right now.
When we were talking about, those complex risk factors, in your notes, you actually spelled complex with a K. Obviously, a shout out to that K-shaped recovery that we have going on. I'm wondering if there's a fear that perhaps that this recovery could become that K being even more exacerbated, especially if we don't get stimulus.
Well, all recessions and recoveries are K-shaped in that they're winners and losers, but we just see that in every way you can slice and dice the economy right now. Certainly in the housing market, if you're upper income households, you're driving a very hot single family housing market. If you're caught up in the closures due to the coronavirus and perhaps working in the service economy, you might be falling behind on your rent. You might be very concerned about a possible eviction at the end of this. So again, vastly different worlds that we as a society are living in right now. And it's making this very complex because as the Biden administration and Congress negotiate the next fiscal package, they're really having to do a lot of guessing and a lot of fine tuning about who gets what money, where do they need to support. And that process is getting very, very difficult right now.
All right. So I want one really, really quickly with you here, because the Congressional Budget Office actually sees, and you were mentioning that GDP rebounding by mid-2021, the labor force returning by 2022. What did you make of that estimate? It seemed so much of a rosier forecast than I would have anticipated, especially given some of those things that you were just mentioning a moment ago.
Well, the big caveat here is coronavirus. So let's say we get the vaccine out there, we start to put coronavirus in the rearview mirror. We look at the second half of this year with very low interest rates, a huge amount of liquidity out there, improving consumer and business confidence, and then we have the spend out of all this pent up demand. I'm confident that every one of us listening now can think of about 10 or more things that they want to do once coronavirus ends or the world normalizes in some way. So a huge spent out of pent up demand fortified by all the liquidity sloshing around in the system. And that's what's boosting those second half GDP forecasts.
All right. Robert Dye, Chief Economist with Comerica Bank. Thanks so much for joining us today.
Thank you.
And coming up, Amazon continuing to encourage other retailers to raise their minimum wage. We're going to be talking to Amazon next. Welcome back to Yahoo Finance Live. Now, in an open letter, Amazon has voiced their support of the Raise the Wage Act and reiterated its call, or perhaps you can even call it a challenge, for other retailers to join it in raising their minimum wage to $15 an hour. We're joined now by Brian Huseman, Amazon Vice President of Public Policy. So, Brian, I'm wondering if you can mention or talk about the added importance of raising the minimum wage given the economic impact of 2020 and that we see continuing to linger now into 2021.
Well, Kristen, thank you for having me. The federal minimum wage has been stuck at $7.25 for over the past decade. And Amazon, as you mentioned, raised our minimum wage 2 years ago. And we've seen positive benefits from our employees and from the economy. We think, especially in this time of pandemic, that increasing wages of Americans is important to get the economy back up and running.
Now, as you mentioned, Amazon, has been making this call for some time, since 2018, when Amazon raised its minimum wage. But some economists are still saying that, frankly, many businesses, and especially after 2020, really can't afford to make this step to pay all of their employees $15 an hour. What do you say to that criticism that something like this just isn't economically feasible for everyone?
Well, the Raise the Wage Act will phase in the $15 per hour over the next 5 years, giving businesses time to adjust. But in our experience, we've seen the ability of $15 per hour to retain and to recruit the top talent, reduced employee turnover, increased productivity. We think those are the things that are important for businesses, important for the economy, and the federal minimum wage is just too low for workers in this country.
So I want to read a quick quote from that letter. It says, "We were thrilled when several other major companies, including Target, Best Buy, and Costco, also increased wages to at least $15 an hour for their employees. We are hopeful that more follow suit." I just want to ask you bluntly, are you guys calling out Amazon, or Walmart specifically here in this call? What other retailers do you think are some of the most egregious offenders?
Well, the company you mentioned, of course, is one that does not pay $15 per hour. We think all businesses should, which is why we're supporting the federal legislation that would require it. We think it's the right thing to do for our customers and our employees.
Walmart is the new Voldemort. I see you won't even say their name right now. So, Brian, what about what companies might do on the back end in order to afford this pay increase for some of their employees and their salaries? I'm wondering if you think that might be a concern from other retailers, that perhaps employees are going to see things like reduced hours or even reduced benefits in order to fund this.
Well, we think paying at least $15 an hour is the basic that companies should do. From Amazon's perspective, in addition to that pay, and many of our employees earn more than $15 per hour in different parts of the country, we also provide strong healthcare benefits and worker retraining and generous paternity and maternity leave. Those are the types of things that workers and employees are looking for when they choose to work for a company. We're proud to offer all of those benefits, and we think many other companies are offering similar benefits as well.
So to that point, because wage is just a small part of, an employee's income, right? Their salary, as you were just mentioning, some of those additional benefits. I'm wondering where you think either Amazon or even other retailers could make more progress in terms of, paying their employees what a lot of them say they feel they are worth.
Well, as I mentioned, many of our employees make more than $15 per hour in many parts of the country. And our jobs at Amazon are good jobs that offer opportunities for career training and advancement and promotion and movement throughout the workplace. They also offer the flexibility for those who want to work part-time, seasonally, or, of course, full-time. So in our perspective, we offer good jobs, and we think that other companies, as you mentioned, should pay at least $15 per hour in addition to these other benefits that we offer.
Now, Amazon, no stranger to criticism. Even when you made this move back in 2018, Amazon also announced that it was going to be eliminating monthly bonuses and stock grants. I find it a little bit hard to believe, especially given how well the markets have been doing, that the minimum wage that people are going to be getting in replace of that is actually going to make up for what they are losing in some of those incentives and some of those benefits. What do you say to that criticism that, hey, great, I'm making $15 an hour now, but I'm losing some of those restricted stock units that are worth thousands?
Every employee received in 2018 received a pay raise when we went to $15 per hour. That's no question. What we heard from our employees was that they would rather have the additional salary in cash and as opposed to RSUs. So we listened to our employees about making those change. But everyone received a pay increase.
And another one for you here, Brian, is some allegations about warehouse conditions, especially throughout this pandemic. I know that Amazon talks pretty openly about testing and vaccinations, especially also among your workers. But what do you make of some of those criticisms that have been levied that despite the fact that the pay has increased, and some conditions, some working conditions have not, especially in the midst of a pandemic where we have seen thousands of Amazon workers contracting this virus?
Well, Amazon's top priority is the safety of our employees, and it's been challenging for us and for everyone else during the pandemic. But we've made over 150 process changes to make sure that our workers are safe. So we now have temperature checks. So of course, we have a strong PPE. We have sanitizing. And as you've mentioned, we've created our own COVID-19 testing program, and we offer tens of thousands of tests per week to our employees. We created these labs from scratch to ensure that our workers are safe. While the situation is completely challenging, safety is our top priority, and our workplaces are safe.
All right, Brian Huseman, Amazon Vice President of Public Policy, thank you so much for joining us to talk again about this continued fight for 15.
Great. Thank you so much for having me, Kristen. We look forward to continuing to advocate for the Raise the Wage Act.
Absolutely. And coming up, we are going to be bringing you the latest in the coronavirus pandemic. That's next. Welcome back to Yahoo Finance Live. The coronavirus pandemic has now grown to more than 26 million cases in the United States, while in encouraging news, vaccinations are speeding up. We're joined now by Dr. Summer Johnson McGee, PhD, Dean of the School of Health Sciences, at the University of New Haven. So let's talk about these vaccinations. The pace has been steadily increasing since President Biden took office. We've got more than 1.3 million doses a week now. We were at less than a million just a couple of weeks ago. So huge progress is being made there. Wondering if you think we'll be able to hit that target of 2 million doses a week anytime soon.
I think we absolutely can. I think that the key there is a couple of things, and most importantly, making sure that we have adequate supply chain to make sure that those doses can be manufactured and delivered to the sites. What we're hearing at the local level is that states and counties have the vaccination sites ready to go, these large venues. But I think the other piece is making sure that we also have enough vaccinators, that personnel, to be able to get those shots in the arms. So between those two things, if we can figure that out, we're going to be able to hit that 2 million a week goal pretty easily.
I'm wondering how much these new mutations that we've continuously kept hearing about, South Africa, Brazil, the UK, how much these new strains kind of change the game, so to speak, in this fight against COVID.
Well, really, we're in an arms race now against this virus to see, can we get people vaccinated enough, quickly enough, before these new, more contagious, more transmissible strains really take hold and become the dominant strains. And so vaccination is one key component of that. The faster we can get people to have even some kind of immunity, even though we've seen some of these vaccines now that are being studied and being tested against these new strains aren't quite as effective as they are against some of those original strains, they are still effective. So it's going to slow the spread of those more aggressive mutants, which will mean ultimately we're going to be able to get control of the spread overall of the virus.
So the U.S. isn't alone in this, and we've seen other countries, around the world, some doing incredibly well when it comes to vaccinating. I think of Israel, but then we have other countries that are not doing so well. The pace is not as great as we would like it to be, and obviously this pandemic is a global fight. So then what you're just mentioning, is there a chance or a possibility that some of these new strains might take hold? And because these vaccinations are not as effective, that we might have to, I don't want to say go back to the drawing board, but that we might have to kind of start this whole process all over again with different vaccinations or different vaccines that have been, retooled to be able to fight these new mutations.
I think that's very likely. I think just like we do with the flu vaccine every year, we have to do our best guess and our predictions about what are the dominant strains in any given year or in any given country likely to be, and to include those strains, that mRNA, into those vaccines if we're talking about Pfizer or Moderna. So I think we can do that. I think we're likely to see, for those who got vaccinations very early on, the need for some booster shots or additional vaccination to come forward. But I think we are likely to see the continual need for updating and honing which strains are in these vaccines and people getting vaccinated, hopefully not more than once a year, but maybe initially at least a few times until we figure out what strains are really going to dominate in what parts of the world.
Wait a minute. So I have definitely seen headlines that, a lot of experts are saying coronavirus is here to stay. We're going to have to be dealing with this for a while. But what you are saying sounds as if we are going to have to get vaccinated against coronavirus every single year, the same way people go out and get their flu shot. And if they don't, that the opportunity lies for people like they do with the flu, for a couple 100,000 people every year to die from the flu, that we're going to also have a couple 100,000 people a year dying from coronavirus each year. Is that what you're saying right now?
I think that's a scenario that we seriously have to plan for. I think that the reality is that the way we're seeing and how quickly this virus is mutating as it spreads around the globe in new hosts, unless we're really able to slow down the spread and to give this virus less opportunity to mutate, maybe once we have, 7 billion people on the planet vaccinated, we won't see that kind of mutation and spread. But we need to get to a very high level of vaccination compliance across the planet before we can really slow this virus down. So I do think what most governments are planning on is that this vaccination scheme is going to be something that we're going to be doing for the foreseeable future until we really get control and we don't see spread happening on a global scale.
I feel incredibly naive right now. I totally thought that coronavirus was going to be like polio. Sure, it does exist out there, but really no one gets it and everyone gets vaccinated against it. It's a little bit depressing to hear that that might not be the case, at least for the next couple of years. I want to talk now about the hospitalizations and the case counts that we are seeing. Let's give some good news for the folks at home, because cases are on the decline, hospitalizations are on the decline. Do you think that we've turned the corner?
I think that we're on our way to turning that corner. I think there is very good news out there. I think that the consistent messaging that we've been getting from the federal government about the importance of masking, the importance of getting tested, that is going to continue to help us see reduced case numbers and reduce serious cases and hospitalizations. I think vaccination is, of course, going to help that tremendously. What we've seen, even with some of these strains that our current vaccines are a little less effective against, they prevent serious hospitalizations and deaths. So even though people may still get sick with COVID-19, even after they're vaccinated, these vaccines are certainly likely to decrease the severity of disease that people are experiencing as well. And I think it's important to remember we're very early on in this experiment with vaccination and really understanding this virus. So it is possible that we could see coronavirus go to near zero in some communities with very high levels of compliance with vaccination and where we truly have herd immunity. I just don't think we're going to get there this year, 2021. I think we're going to be at least a few years away before we see this virus not having an impact on our daily lives.
Okay, so then a question on behalf of many of my colleagues with children who have been doing a lot of homeschooling themselves, which is the question of summer camps. We are a ways away yet before we send off any children to any sleepaway camps or day camps. Wondering what your thoughts are on that. Is it safe? Is that something that would be okay for parents to do?
Well, I think it's really going to depend on what we see coming out of these clinical trials that we're doing related to vaccines in children. Are we able to get children vaccinated to go to summer camps this summer, to go back to school in the fall, and to be able to do on-ground learning and other in-person experiences? I think those trials are really going to be critical to know whether or not those younger children, it's safe to have them vaccinated. If we can, and we can get the doses out there, I see no reason why children shouldn't be able to go to summer camps and go back to full in-person school by the fall. And I think that is a goal of everyone, not just parents who are homeschooling their children, but also a goal at the federal level as well, to be able to get back to full in-person school by fall of 2021.
All right, a lot of positive news there for some of the parents who are watching and at least want their children to go take 2-week break from them over the summer. Dr. Summer Johnson McGee, PhD from the University of New Haven, thanks so much for joining us today.
Thank you for having me.
Coming up, we'll be chatting with South Carolina Congresswoman Nancy Mace. That's next. Welcome back to Yahoo Finance Live. Checking market action right now. All three major indices are in the green, rallying after we had seen a sell-off last week amid those Reddit-fueled trades that had been going on. And speaking about them, you can see them there. A pretty mixed bag. GameStop right now in the red, down over 25%. AMC, however, and BlackBerry receiving pops. AMC right now up over 6% as some of those Reddit-fueled trades continue. So we're joined now by South Carolina Republican Congresswoman Nancy Mace, along with our chief political correspondent, Jessica Smith. Thank you both for joining us. So, Congresswoman, I want to start with those Reddit-fueled surges that we've seen in the market. You issued a statement calling for an investigation into what's going on. I'm wondering if you think that there should be some changes in the way the market operates. What's some of your biggest concerns that you have here with some of the news that we've seen last week?
Well, last week was certainly concerning because we had just normal everyday Americans trying to trade, and they were blocked from trading, whether it was the Reddit app or the Robinhood app or other apps that were out there. What we want to make sure is that Wall Street isn't manipulating the market. People should be free to lose money in the market or get earnings in the market, just like anybody else, like any institutional investor.
Do you think that there needs to be more of a clear definition of what market manipulation actually is? We did see Senator Elizabeth Warren asking the SEC to make that clarification. Do you think that's necessary?
Well, I do think that there need to be hearings and an investigation. I know that in the House of Representatives, there have been calls for an investigation in the Financial Services Committee. I've called for an investigation in the Government Oversight Committee. I want to learn more about the problems. One of the things I learned after the debacle last week with GameStop and Reddit is that there were capital issues with Robinhood. I want to learn more about that process and what actually happened and what did not, so we can address the issue in the future.
You know, we have heard so much from Republicans, from Democrats on this. Where are the areas that you think can get the most bipartisan support, where lawmakers can find the most common ground here?
Ironically, after the events of early January, this is an issue that brought folks together from both sides of the aisle, where you had Ted Cruz retweeting AOC. And trying to work together. I actually reached out to her office on Friday because she sits on oversight with me. And I think this is a place where we can show some unity to the American people to make sure that everyday Americans have the rights of big investors. It shouldn't be so super rich versus those who are just working hard to get by. It needs to be a fair and free market for everybody.
So, Congresswoman, speaking about this area of bipartisanship, I want to pivot the conversation now a little bit to stimulus. What you see is going on right now, at least in terms of those negotiations, I think the main question that most Americans have is, when can I expect some sort of economic aid or relief?
Yeah, right now, because we've been distracted by so many other events, we've not been able to get to the work of the people right away. With impeachment on the horizon in the U.S. Senate, it will prevent us having that impeachment trial from getting to that work, whether it's vaccination distribution, whether it's addressing the stimulus package. That is slowing us down. The American people are hurting. People are out of work. They're out of jobs. Small businesses are having trouble keeping their doors open. People can't get vaccinated. I mean, we have real issues facing our country right now across the board. And if we want to have any real economic recovery in the short or long term for this fiscal year, we've got to get back to the business of the people.
So, Congresswoman, you were just mentioning impeachment and the impeachment proceedings. Now, you've said that, the outgoing president, Trump, should be held accountable, but then you didn't vote in favor of impeachment. How then do you imagine that Trump should be held accountable, if not the impeachment process?
Well, I vote to certify the Electoral College. I'm a constitutional conservative. Our job was to certify the Electoral College on January 6th, for the same reasons that I voted against impeachment. There was no investigation open into impeachment. There were no hearings in either judiciary or a special committee. Literally, the Republicans had 1 hour to debate the issue on the floor. Democrats had 1 hour to debate the issue on the floor. And if we eliminate due process for a sitting president in an impeachment process, then we give the government the right to eliminate due process for every other American that's out there. And so we really have to look at the Constitution and use that as our guiding principle on both sides of the aisle. And that's the issue with the way that we handled impeachment. We've got to be consistent about how we utilize those efforts with any president, whether you like them or not.
Now, I know Jess has a question here for you, but I wanted to quickly ask you, what do you think was missing in these proceedings that would have been brought about? Or what new evidence do you think would have been, revealed in some sort of lengthy trial? I can understand, that assertion or that criticism being made about the first impeachment go around, but this second time around, essentially these impeachment proceedings were over what people say is a clear direct link between the president's actions and comments on the day of January 6th and then the ensuing riots. So what do you think was missing in any kind of proceedings? What do you think would have been revealed that were not revealed?
Well, the House, for starters, eliminated due process. I mean, there was no evidence, but you can't adjudicate an impeachment. You can't investigate an impeachment in 1 hour of debate on the floor of the House. You have to open up an investigation. You have to have committee hearings. All of that is important because as you learn more, investigate more, and have more questions answered, you'll learn more about what happened that day. And we didn't do that. And everyone deserves the right to due process, no matter how guilty you feel that they may be. I mean, that's why we have a constitution and we should respect the rights of every person, including the President of the United States.
Congresswoman, I wanted to go back to stimulus for a bit. We are seeing some Republican senators put forward a plan today. It's about a third of what the president has proposed, his $2 trillion plan. How do you bridge that gap here? What do you think the path forward is?
It is a huge gap. I haven't read what they're proposing right now. What I do know is we don't have $2 trillion spent. The American government doesn't. Some of the issues we've had in the past with stimulus is that we've had illegal citizens getting stimulus checks. We've had dead people getting stimulus checks. People whose income was not affected by COVID-19 have gotten stimulus checks. In fact, I qualified for a stimulus check because my salary, my wages were down last year, but that's because I was running for Congress, not because of COVID-19. And so we really ought to focus on targeted relief to businesses who've been shut down and people who are out of work. And in that case, if we're able to do that, then I think we have a much better opportunity to serve those who need it most. We can do so at less expense to the taxpayers as well. There are people who are hurting right and left right now in this country. Kids can't go to school, people are having trouble getting vaccinated, and people are out of work. And we've got to have bipartisanship on the stimulus package, or it's just not going to work.
I mean, what do you say to the argument that we're hearing from many economists and that we're hearing from the White House that the risk of doing too little is so much greater than the risk of doing too much?
Well, I mean, it's certainly a challenge, but if you look at the past and how we've handled stimulus, we could have done it a lot more efficiently and more targeted, which is why we're in this predicament that we are today. There are some states like South Carolina, we've done a very good job of balancing health and safety with getting people back to work. Our unemployment rate right now is just over 4%. And there are other states that have done the same thing like ours, but others haven't been quite as lucky. And so we really have to focus on targeted relief to those who need it most right now, more than anybody.
All right, South Carolina Congresswoman Nancy Mace, Chief Political Correspondent Jessica Smith, thank you both for joining us for this discussion today.
Thank you, ladies. Have a great afternoon. Thank you.
And coming up, Black History Month starts today, and our next guest is leading a charge to increase diversity in the legal profession. That conversation is next. Welcome back to Yahoo Finance Live. Coca-Cola is making a step to demand and help increase diversity in the legal profession. So let's chat that now. We're joined now by Bradley Gayton, General Counsel at the Coca-Cola Company. So Bradley, Coca-Cola making steps to increase diversity in the legal profession by placing these diversity demands on your outside legal counsel. And we have them for everyone to see at home if we can put those up on the screen. Now, I'm curious to know how important it is for big corporations like Coca-Cola to make these steps. What kind of impact do you think it can make?
Yeah. Well, first of all, thanks for having me this afternoon. It's great to be with you. Listen, this is it's fundamentally important. Primarily because of the clock speed at which business innovation is moving. General disruption of classic business models is just moving at an unprecedented pace. And it's just clear that it's important to increase diversity of the teams that are serving us, because there's been plenty of data that shows that diverse teams produce better results. And we want to assemble those winning teams to help us achieve our business aspirations. And so to the question of, what can we do here and what impact will we have? I think if we band together and focus on this imperative, I think we can achieve great results in this space.
So Black folks aren't just underrepresented in the legal profession, they're underrepresented in many professions. We don't see too many Black Americans at the C-suite level. Can this and should this, be expanded to general diversity requirements of all the firms that you do business with, not just the legal firms, perhaps with distributors or other companies along Coca-Cola's supply chain?
Yeah, so it's a really fair question, and what I would tell you is this issue, in terms of being able to put together diverse, competitive teams that serve us, it exists across the board. You're right, and as we think about this diversity issue, it's going to be really important that for all of our suppliers and us, that we look representative of the communities that we serve. People need to feel like they belong. They not only belong, but feel like it's a place where their unique capabilities are sought after. And so it's going to be important that I think we attack this issue just across the board.
I want to highlight something in your note where I really kind of feel like you hit the nail on the head. You wrote, "The hard truth is that our profession is not treating the issue of diversity and inclusion as a business imperative. We are too quick to celebrate stagnant progress and reward intention." You go on to say, "We have a crisis on our hands and we need to commit ourselves to specific actions that will accelerate the diversity of the legal profession." How much of a fear do you have that at this time, where we've seen so many companies make pledges, give money, hire, D&I folks, to work within their ranks, that frankly, these companies next year, this year, perhaps 2025, you and I are still going to have this conversation because a lot of those companies are going to do just that, celebrate stagnant progress and just reward the intention of increasing diversity?
Well, and that's why we're here today. So what became clear to me is all the work that we put in, it was important, it was necessary, but it was just woefully inadequate and not sufficient enough. And, we had diversity summits for associates, diversity summits for managing partners. We participated in the development of associates on our account. But the truth of the matter is a year ago, I saw two firms who participated in all those programs with us publish headshot collages of new partners, no diversity at all. And then in September, I saw one of those firms produce yet one more of these collages, announcing the opening of a new office, no diversity at all. So that, coupled with what I'm seeing as an impact of the pandemic on women and people of color, it causes me a concern that whatever little ground we made, we'll start to lose. And so it's really important that we take it to the next level, move up the maturity curve, and really start to insist that there's consequences associated with not putting together these winning diverse teams for us.
I'm wondering why you think other companies aren't making, a bold step like you guys are doing over here at Coca-Cola. As you just mentioned, we have heard company after company publish white paper after white paper talking about how diversity isn't just a good thing to do, but it frankly just makes good business sense. As you were saying, establish winning teams. So why don't you think that this has been trickled down and some of these, actions have actually been made. Why do you think that Coca-Cola is really the first one to say, hey, we're not only going to just be diverse internally, but we're also going to demand that you be diverse if you want to do business with us?
Yeah. What I would tell you is that I'm hoping that the Coca-Cola company in our legal office lead here and make it perfectly clear that there's unequivocal demand for diverse teams, and we're going to celebrate and reward the firms that produce those diverse teams for us. And I am really hopeful that other people sort of join us in this effort, because when we step back and ask the question, what do we need to do here to make a difference? It was create demand and make it clear that there is a demand for these kind of teams. And so I'm just hoping that others will join us. And then to your earlier point, not just join us in the legal profession, but just imagine the impact we could have if throughout the supply chain, people took similar approaches and the impact we could have on diversity throughout the supply chain.
All right, Bradley Gayton, General Counsel at the Coca-Cola Company. Absolutely fascinating conversation. Would love to chat with you more about it again in the future. Thanks so much for joining us today.
You bet. Thank you so much.
And coming up, Yahoo Finance's Rick Newman is here to talk with us about how many Redditors are targeting the wrong people with their anger. We'll be chatting that next. Welcome back to Yahoo Finance Live. One last quick check of the markets. All three major indices are in the green, rallying after that sell-off we had seen last week of a frenzy fueled by Reddit-based trades. So I want to talk more about that because we talk a lot about how beneath the Reddit-fueled surges and what happened in the market, there is that classic class and wealth struggle that is ongoing. So we have Yahoo Finance's Rick Newman here, who says that their anger is a little bit misplaced. So Rick, what do you mean by that?
Well, they're going after two groups of people, at least if you read the, the comments about what's kind of animating these trades. They're going after short sellers, and they want to punish hedge funds. And there's a connection on Wall Street Bets, the Reddit, the subreddit, and other forums where people are talking about this. People are still angry about the 2008 financial crash. The thing is, of all the groups that contributed to the financial crash, hedge funds really didn't, and short sellers really didn't. I covered the crash, and I've gone back and started rereading some of the history. And look, a lot of the investment banks, we all remember the names: Merrill Lynch, Bear Stearns, Lehman Brothers, Citigroup, many others. They fueled the crisis. The rating agencies, Moody's and Standard & Poor's, they had a role. Fannie Mae, Freddie Mac, they had a role. Many others did, but hedge funds did not. And there was even some research by the Rand Corporation in 2012 that looked at this exact question. Did hedge funds and short sellers play a role in the financial crash? And for the most part, they did not. Now, I'm not an apologist for hedge funds and short sellers. I'm just trying to get the history right here.
Okay, so then who should they be angry at? Or perhaps should they be angry at them, but have nothing to do with the 2008 financial crisis? Because I think that there could be a lot of folks that say, hey, my anger isn't misplaced. Perhaps I got the history wrong, but my anger is absolutely well-founded. I'm tired of being the little guy and seeing the wealthy continue to get richer, especially throughout the pandemic.
That's fine. Yeah, you could. I mean, you can be angry at Wall Street writ large. I mean, it's clear that. I mean, we have massive wealth and income inequality in the United States, and it's probably getting worse. I mean, I can understand why people don't like short sellers. They do play an important role in the market. They often uncover fraud and mismanagement, but some people think they're just trying to force companies to fail, and I get that. I just think it's important to get the history right. So let's know who we're talking about. You can be angry at hedge funds and short sellers, but guess what company got the biggest bailout that was not paid back from those big bailouts? It wasn't even a bank. It was General Motors, which ended up settling with the government at an $11 billion loss to the government. All the big banks that didn't fail, that got bailouts, they paid that money back with interest. And those bailouts ended up being profitable for the government. The government made $110 billion on those bailouts. But people are still angry about the bailouts and just angry at Wall Street in general. So I'm not going to tell people don't be angry. I'm just going to say, let's get the history right.
I was going to say, you can't tell anyone not to be angry, Rick. You're like our you're like our chief anger correspondent. GM up over 1% right now. Thanks so much, Rick. All right, Alexis Christophers will be picking up in the 2 p.m. hour next.
Hello, everyone, and welcome to Yahoo Finance Live on this Monday, February 1st, a snowy Monday here in New York City. I'm Alexis Christophers. Wall Street is kicking off a new week and a new month with more volatility in those popular stocks, while the overall market, as you can see there, is bouncing back from its worst weekly loss since October. The Dow Industrial is now up more than 230 points. We have got the S&P up 59. The NASDAQ, the big winner today, on a percentage basis, it's up more than 2.5% right now, or up 300 30 points. We have got information technology and consumer discretionary sectors leading the way higher today. Energy and consumer staples are lagging. And those heavily shorted stocks that legions of online traders initially targeted last week, well, they're trading mixed today. We've got shares of GameStop falling hard, taking a pause after last week's 400% rally, and was briefly halted intraday, we might add. AMC and BlackBerry, though, mostly trading higher right now. Meantime, Robinhood raised another $2.4 billion from investors. That's after the billion it had to raise on Friday, as the online broker tries to cope with unprecedented demand on its popular trading platform. And of course, getting back to the fundamentals here, traders are gearing up for another packed week of earnings. We've got Google's parent company, Alphabet, and Amazon out with earnings. That's going to happen after tomorrow's closing bell. Of the 37% of the S&P 500 companies that have already reported fourth quarter results, 82% beat estimates. And if that holds, it would mark the second highest percentage of S&P companies beating earnings estimates in more than a decade. Now, that GameStop phenomenon appears to have spilled over into the silver market. We have got silver futures near an 8-year high right now. Reddit users discussing executing a short squeeze similar to the one that propelled GameStop's shares higher. Jared Blickery is here with more on that. And Jared, there's already talk that, I don't know, maybe this is not the small investor doing this on Reddit. Perhaps hedge funds have taken to that Wall Street forum and are pushing the price of silver higher.
Yeah, it could be. And that's where I'm tending right now. You look at the situation with silver. First of all, the move in silver futures, and futures are really not traded by the Wall Street bets crowd. Silver futures were up 10%, 11% earlier. This was a huge move, the largest in years. So I look at it this way. I think silver was already poised for a breakout. There's a strong fundamental case to be made for it. Now let's take a look at some charts here on the Wi-Fi Interactive. Now this is the iShares Silver Trust. This is how a retail stock investor would play silver. And we talked about silver breaking to the upside on Friday because it had, although it gave back some of those gains. But you take a look at what it's done over the last couple of years. We've had some really impressive moves here, but largely trading sideways for the back half of 2020. So we had a market that was set up for a potential squeeze to the upside or along to the upside or movement to the upside there. And we finally got it. And we do have a catalyst potentially with the Wall Street bets. There's some chatter that maybe hedge funds have infiltrated the Reddit message boards. And we know that a lot of those posts there are simply bots, and there's a huge amount of spam. So it's a fluid situation. Do we know exactly what's going on right now? No, but I will add to that some of the larger movers in our heavily shorted basket now are silver miners and gold miners, as we can see here. Avino, that's up 44% today, 191% over the last 2 years, much of that coming since that big run up in silver that began last year, Alexis.
And we also have to talk about biotech stocks, Jared, because it looks like the smaller investors, in cahoots there on Reddit are now having an all-out war on these biotech shares that have been shorted by the hedge funds. What can you tell us there?
That's right. Hashtag BioWar. So put that in your arsenal, something to look out for. Wall Street Bets forum posters are calling it the most undervalued stock in the market. And this would be HCMC, Healthier Choices Management. Now, this is up 125% today. We'll get a 5-day look just to underscore the moves here. And you see how strange this chart looks. This is an extremely illiquid, thinly traded stock. And you got to imagine it's easy to move this thing up 750% over the last 5 days. Plus, look at the price here. It's a fraction of a penny. So lots of interesting things going on here. This is a company in particular that just gave up on its COVID vaccine. So maybe it is undervalued, only a fraction of a penny away from zero. But this does seem to be, unlike silver, an area where the Wall Street bettors are really moving today.
Yeah, we should mention also that silver and silver-related companies are trending on the Yahoo Finance website right now. Want to talk about Tesla, though. It's already trading at over $800 a share, and at least one Wall Street analyst raising the price target there, saying that Tesla could be looking at a multi-trillion-dollar market valuation.
Yeah, so you got to wonder what the TAM on that industry is. Well, Piper Sandler has doubled their price target, more than double it, from $515 to $1,200. And they're saying with Tesla's target industry still embracing outdated business models, it may be decades before this company runs out of new opportunities to pursue. And we've been talking about General Motors really pivoting to EV here, and their stock has benefited from this move over the last few months. You take a look at that, 48% over 3 months. Tesla had a little bit of a breather week, let's call it, and for the month of January really hasn't done much, but still notable that it's holding above 800, and especially over its price at which it was included in the S&P 500 late last year. Just one more nugget here from the firm on Tesla as they're writing today. They expect them to deliver 894,000 vehicles in 2021, eventually increasing to more than 9 million units in 2030, making it among the top three automakers globally. They also see a steady ramp up in the adoption of Tesla's full self-driving FSD software starting in 2030, with more than half of all Tesla owners using the FSD package by the end of 2040. I think this underscores how far away from autonomous driving we truly are, Alexis.
Yeah, I want to stick with Tesla because I know that CEO Elon Musk is moving cryptocurrencies once again with his tweets. What can you tell us about that?
Well, last week it was Bitcoin. Now it's Dogecoin. And if you take a look at our Wi-Fi interactive heat map on cryptocurrencies, you can see what a wild ride it's been for this coin lately. Now, let's scale down to a 5-day look. This is going to take us back to last week. And Friday was when we saw a huge pop. Now, we have given back some of those gains, but still holding on to 381%. Another example of the power of Musk and Twitter put together.
The power of Musk. Yeah, don't underestimate it, I guess, is the takeaway. All right, Jared, we'll see you a little bit later on. I want to stay with the markets now and bring in Liz Ann Saunders. She is Senior Vice President and Chief Investment Strategist at Charles Schwab. Liz Ann, always good to see you. It's been a while. And boy, do we have a lot
Nice to be here.
We have a lot to talk about. As a Wall Street professional, as you see what's been unfolding with GameStop, with AMC, today with silver and some of the activity we're seeing in biotech, what would your message be to the average investor watching all of this unfold?
Well, for one thing, I think it's really important in an environment like this, especially over the last week or two, to differentiate and educate with regard to the difference between speculating and investing, two entirely different things. And I think a lot of the moves that we're seeing in some of these individual stocks, heavily shorted stocks, non-profitable tech companies, penny stocks, now out into the commodity sphere, is pure speculation. It's not driven off of fundamentals. That doesn't mean it can't be profitable for some period of time, but it does make me think of games maybe a lot of us played when we were younger, whether it's pin the tail on the donkey or musical chairs. And I fear that it doesn't end well in many cases for some of the holders. But I also think we've seen a morphing in the past week where it's hard to really differentiate or segment out what portion of this are retail day traders and what portion of it are quants and algos and other hedge funds that either by virtue of their quant methodology kind of taps into wherever the momentum is, or they want to sort of play the retail crowd at their own game. But so far the good news is unlike say 1999, 2000, the most heightened speculative activity is not in the big major stocks driving the S&P 500. So maybe that's one saving grace.
I think you're right that we could probably look at some of these individual stocks and say those are stock stories. Like you look at GameStop, right? Up 400, 500% in a week. That's sort of undeniably a bubble. But when you look at the broader market, Liz Ann, are you seeing a little too much frothiness there? I mean, are some of these stocks just getting too far away from their fundamentals? And are you concerned about that?
So I would certainly apply the term bubble to a lot of areas that we've already touched on. So there's no question there's a lot of micro bubbles. I'm not sure we're quite yet there in terms of the broad overall market. There are frothy sentiment conditions, even in traditional sentiment metrics. Certainly things like fund flows, recent ETF flows, you're seeing it in other behavioral measures, certainly in the options market with an incredibly low put call ratio. In terms of valuations, I think the one important difference between now and say circa 99, 2000 is that we know heading into what were excessive valuations then, it was a function of stock prices and earnings going up. It's just prices were going up faster than earnings. We know with the benefit of hindsight that earnings were rising into a peak and falling down. What caused, at least initially, the spike in the PE ratio in this environment was the collapse in earnings driven by COVID, and the fact that we're now on an accelerating path for earnings. And so far, anyway, what we're getting in the fourth quarter signals that 2021's estimates may be too low. I think the action of the denominator, meaning E, is so far anyway, probably the most important differentiator between now and 2000, even if there are still excesses that may need to correct a bit.
So to your mind, high valuations don't necessarily mean that the end of the rally is near. Do you think that we have further to go and that the market is going to continue to climb higher here in Q1?
I mean, the honest answer is I don't know. I think we often think of valuations as this quantifiable fundamental indicator, which it is. You've got the quantifiable denominator and numerator. The problem is that valuation can sometimes be ignored or really end up becoming an indicator of sentiment, not so much a sentiment indicator, but an indicator of sentiment. And I think a lot of the money that's most aggressively in the market on the buy side in this environment isn't doing it based on some unique explanation for lofty valuations. So I don't think this has really been a valuation story in terms of why we've seen the momentum that we have. As to how long we can go on, we all remember, Greenspan's irrational exuberance comment, which was at the end of '96. And we still had 3.25 years left of the bull market. So I don't know how long this momentum kind of frenzy continues, other than at least we have the good news of an accelerating E in front of us, which was not the case back in 2000.
So you're thinking that perhaps these high valuations are rooted in something a little more fundamental, shall we say? The fact that
that's not what I'm saying. I'm just saying that given where we are right now, if you are a fundamentalist and you're looking at valuations, yes, you get the bulls that will justify valuations based on a very low level of interest rates. So that discount rate has basically been promised by the Fed to stay low. So on equity risk premium type valuation analysis, you can argue the market isn't as expensive. I'm just saying that I just don't think valuation has been a dominant factor driving the market. I don't think it's not that most of the momentum-driven investors are simply finding a way to justify valuation. They just have put it aside as a factor they're not focused on. It's very momentum-driven right now. And that can last for an extended period of time. I'm just saying if you are a fundamentalist and you're not one to say, okay, let's use equity risk premium instead of PE ratio, at least looking ahead, if you're wondering, okay, is there any hope for improvement in lofty valuations? The hope is that estimates may actually have to continue to go up for 2021. So those fundamentalists at least can rest to some degree on the direction of the E.
You mentioned the Fed. How much do you think the Fed is going to play into market sentiment this year? I mean, the latest FOMC meeting, we saw Powell come out again and basically say they're going to keep rates low for long, even if inflation starts to creep up. So how much is the Fed really a part of the conversation this year?
I think, staying relatively easy with their policy is a given and an expectation, the consensus. I think where a potential risk comes into play, especially if we maintain these incredibly elevated sort of sentiment environment and speculation continues to be rampant, I think a potential catalyst for maybe a difficult period in the market is as we get through the vaccine period of time and we see the economy open back up, if we start to see some signs of inflation more than just supply demand imbalance driven price shocks, and there's a concern that starts to build that either the Fed's getting behind the curve or they may have to start to telegraph a tapering at some point, probably less on the rate side, more on the balance sheet side. The question is, what is the stomach that the market has for dealing with that, especially if it is in an environment where that sentiment level is still sort of in the highly complacent, excessive optimism territory. So that I would put that near the top of my list of risks that we might need to contend with this year.
All right, we're going to leave it there. Liz Ann Saunders of Charles Schwab, always good to see you. Thanks so much.
My pleasure.
Coming up next, we're going to take a look at some of the companies that might be benefiting from the crisis, the confidence crisis that Robinhood is going through right now. We're back right after this. Well, welcome back. We've got some breaking news on Robinhood now and how they're starting to ease some more restrictions on how you can trade particular stocks on their platform. Jared Blickery has got the latest for us. What do you know, Jared?
That's right. Let's go to the Wi-Fi Interactive because I just tweeted this list of names here. Now, here's the two-day price action for GameStop. By the way, we got this negative trend line in place, but still holding above 200. Very impressive given what's happened recently. But Robinhood has now further eased the limits on some stocks, including GameStop, and other names include AMC, BlackBerry, Express, Genius Brands, COS, Naked Brands, and also Nokia. Now, looking at GME, you could have bought only one of these at one point on Friday. Now you can buy as many as 20, but it does indicate that that pressure on the system is being relieved. And as I pointed out before, the fact that GameStop is still holding over 200 right now, extremely impressive given the fact that there are a lot of investors who could be selling right now or even shorting again.
And they're not. All right, Jared, thanks for that. We know that Robinhood angered a lot of small investors last week when it temporarily restricted how they could trade these heavily shorted stocks. Some investors reacted by fleeing Robinhood and flocking to other mobile trading apps, including Acorns. That's the micro investing app that rounds up your everyday purchases to the nearest dollar, and then it invests that spare change in low-cost ETFs. Joining me now is the CEO of Acorns, Noah Kerner. Noah, good to have you on the show again. So tell us what business has been like at Acorns just over the past few days since that whole GameStop trading frenzy.
So we're approaching about 9 million accounts. And what we saw was from Tuesday to Wednesday, new user counts doubled. And from Wednesday to Thursday, new user counts doubled again.
So when you say doubled, give us an idea of numbers if you can. I mean, I know that going into all of this, I think you had 8.6 million customers. You say now it's closer to 9 million. Can you just give us an idea of how rapidly these numbers have been growing for you over the past few days?
Yeah, January is historically a big month anyway, but we went from about 10,000 to 20,000 to 40,000 and then sustaining at that near or around that level.
You know, I know that part of your business model is you charge a fee. It's tiered, right? $1, $3, $5, I believe, for certain kinds of accounts that you would open up. I know that Robinhood was a pioneer in commission-free trading online. Many others have followed suit, including the big guys like Fidelity and Charles Schwab. Have you considered doing away with these fees, especially given the fact that you are trying to attract first-time investors who may not have a lot of resources?
So it's a great question. And by the way, we don't offer trading on Acorns. So the way Acorns works, we have a core investment account where you can automatically round up the spare change or make recurring investments. We have a retirement account. We have a kids investment account. We have a full bank account that allows you to save and invest when you spend. We have a product called Acorns Earn that has tons of brands that invest in you when you shop with them. So the way Acorns is architected is we've got $1 a month, $3 a month, and $5 a month tiers. And each one of those tiers come with a bundle of products that work together to help you save and invest more money. So that's really the business model. And we believe in subscription pricing and also believe that when the product is free, somehow the customer ends up being the product.
So why do you think then that people are fleeing Robinhood, according to you, here in droves, because your numbers have really gone up quite dramatically? And how do you know that these are folks coming from Robinhood to you?
I don't, and not clear at all sort of what the data on Robinhood is. But at Acorns, really what we focus on is helping you save and invest for the long term, for the future. And, our belief is take 90% of your money and put it into diversified portfolios that help you build a better future. And 10% of your money, if you want to make bets, invest in individual stocks, take risks, do some crypto, that kind of thing, that makes a lot of sense. But it's really important to have that balance, right? And Acorns is where we want people to put their money for the long term.
Last week, we had Robinhood CEO Vlad Tenev on Yahoo Finance, and we asked him, among other things, why he had to restrict trading in these particular stocks for their customers. And I just want you to listen to what he had to say.
I understand, obviously, that people want to not be restricted from investing, and we're all about that. We want people to have access to the markets, and Robinhood stands for that. And we're going to do our best to do that in the future and serve these customers.
Do you think when you hear that, I mean, he is in the same space, Robinhood is in the same space you're playing in, Noah. Do you think that the anger is misplaced here on the part of small investors? And might the demise of Robinhood, be greatly exaggerated?
Yeah, I mean, like I said, I think we're in a different space in the sense that Acorns is really about saving and investing for the long term, diversification, compounding, that sort of thing. So I try to encourage people. We try to encourage our customers. And by the way, same thing for me. I have a money manager, and I'll call my money manager when I'm interested in buying this stock or this sort of making this bet or investing in this company. And the feedback I'll always get and the advice I'll always get is, great. But remember, less than 10% of your money, right? The 90% we want to put into diversified portfolios. We want to put into long-term oriented bets and bet on the broad entire U.S. economy rather than a fragment of it in terms of how you're building your future.
We know that Robinhood had to raise another $2.5 billion today. I mean, do you think that Robinhood is going to be a part of the conversation going forward, or are they going to be an entity going forward? I mean, I know you don't know what their books look like, but just do you think that Robinhood is going to be able to survive this?
I'm not a prognosticator, and one of the things I try not to do is predict the future because nobody can. So that's I try to bring it back to like what we're about and what we do, because you can't predict the future, and because buying individual equities or making short-term bets is risky. It is essentially gambling. You should do it with a small percentage of your money. And when you're thinking about longer term or building wealth or trying to build wealth, when you look back, investing in a diversified portfolio and keeping your money there and letting it sit, that's what works for the long term. So I don't know what the future holds for any particular company, but I do know the best way to invest your money is diversifying it.
Let's talk about the future of Acorns for a moment. You guys really have been growing nicely, steadily over the past few years. The company was founded in 2012. We had to ask Robinhood's CEO, given everything, are they still going to go public this year? Because they've been talking about going public. He said, we can't even think about that right now. But what about you at Acorns? Are you considering a trip to the public markets?
It's a good question. And by the way, we launched at the end of 2014. And sort of slow and steady they go. We've grown really nicely in the scheme of things, and we're continuing really strong growth rates across all areas of our business. But we do have a very similar mentality to building a sustainable, durable company as we do to the products we offer our customers, which is like, think long term. I want Acorns to be around 100 years from now, and the things we decide to do for the business, whether it's go public or whatever, are going to be oriented around setting us up for that kind of durability and making sure we can service our customers effectively over the long term. That's really it.
All right. Yeah, I misspoke. I think I said 2012. I meant to say 2014. Noah Kerner, CEO of Acorns, thanks so much for being with us.
Thanks, Alexis.
All right, coming up next, App Harvest goes public today via a SPAC. We're going to talk to the CEO right after this. AppHarvest is the latest company to go public through a SPAC reverse merger. The deal with the blank check company Novus values the startup greenhouse farming company at more than $1 billion. And early investors include Martha Stewart and author J.D. Vance. The stock is trading on the NASDAQ under the symbol APPH. It's being well received by investors hungry for corporate stories that include any hint of sustainability. And there you see the stock up 16% right now. Joining us for more is the founder and CEO of AppHarvest, Jonathan Webb, who is standing there in the middle of an indoor greenhouse there in Moorhead, Kentucky. Jonathan, good to see you. We had you on just a couple of weeks ago when you had your first harvest of beefsteak tomatoes and you were shipping them to some of your retailers, including Walmart and Kroger. You raised more than $475 million from this transaction. What are you going to use that money for?
We're using to build. My background is building some of the largest solar projects in the U.S. And I'm moving from the energy world to agriculture. And AppHarvest is founded to build some of the world's largest controlled environment agriculture facilities. And we're doing it right here in Central Appalachia. I mentioned to you last time, this region, we can get to 70% of the U.S. in a one-day drive. And we have an abundant rainfall. So if you look at a fruit and vegetable, 95% of it is water. We're able to package that rainwater up here, run completely on recycled rainwater, and then send the fruit and vegetable out to major markets here in the East Coast, Midwest, and Southeast. So we're excited to hit the NASDAQ today, but it's just the start for us. We have a couple decades ahead of us to help rebuild the food system, not only in the U.S., but around the world.
Talk to me about the cost of ramping up and bringing the business to scale. You've certainly got a nice chunk of money now to do that, but what are your costs like going forward?
Yeah, so we're going to be spending a tremendous amount of capital on building. So I'm standing in this facility. It's not a backdrop. This is where we grow our fruits and vegetables. And we're building a lot. We've set out to build nearly 12 facilities by 2025. And to give the scale of this, we built this first facility in the middle of the global pandemic. We had 600 semi-trucks of materials that had to be delivered to us in Moorhead, Kentucky, in the 2.8 million square foot structure. That's one of the largest structures in the world. So we're building big stuff and building fast in order to be able to grow a fruit and vegetable where you look where the grocer demand is. The grocers want U.S. supply. They want it in a controlled environment so they don't have to worry about climate disruption. Consumers don't want the harsh chemical pesticides. We don't use any harsh chemicals, and we can do it with 90% less water and get 30 times more yield per acre. So my job here on the ground is to build the big stuff fast, and we're going to be pushing out this capital here on the ground to get the infrastructure and technology up around our region.
So, Jonathan, that's clearly where the focus is right now. Any focus on when you're going to turn a profit, and can you offer up any kind of a timeline to investors?
Well, every facility, we've modeled it out to island to be able to be profitable, based on its own operating needs. We're focused on getting each facility to profitability, but we're competing, with agriculture products that are being shipped in from out of the U.S. You look at tomatoes, 4 billion pounds of tomatoes were shipped into the U.S. from Mexico last year. And we want to make sure we're getting the fruit and vegetable, the consumer at or around the same price. So we've built a model that gets us to profitability while competing with dirty agriculture products that are being shipped, 2 weeks on a truck. They're laden in heavy chemical pesticides. You look at the USDA, who recently did a study on cherry tomatoes, said 80% of tomatoes had at least one harsh chemical, and up to 20% of tomatoes had up to 5 harsh chemicals. So it's a premium product at conventional pricing. And you mentioned some of our early investors. We're very fortunate. We've tried to say not all SPAC deals are equal, and we're one of those where the SPAC was only $100 million. We did a road show and raised $375 million with private investors. Fidelity led the pipe, was our largest investor. Very sophisticated investors that have invested in this company with us and are in it for the long run. So again, we're excited to hit the NASDAQ today, but for us, this is just the start and the beginning of a very long journey.
And, the cost of organic produce was quite high when it first hit the market. I think that spread between organic and non-organic has narrowed a bit, but it is still a premium product. What is the cost analysis for the consumer? How much more are we going to spend for your tomato or eventually your pepper or cucumber than we do for regular?
Well, so Martha Stewart's on our board. I'll be talking to Martha again later today. She's been very active with our company. We have a mission to create a much better product that doesn't have the harsh chemicals, better flavor, higher nutrient density, but at the same price. We understand that the average American consumer cannot afford to pay more at the grocery, and we can do that simply with a couple of reasons. One, economies of scale. We're building really big, which allows our operating costs to be lower. We're operating in a region where we can run completely on recycled rainwater. So when I mentioned 95% of a fruit and vegetable is water, we control those costs by running completely on recycled rainwater. And then lastly, distribution. Again, getting that trucking time down from 2 weeks to 1 day. And you look in the U.S. right now, almost 40% of fresh fruit and vegetables end up in a landfill. It's unacceptable. So by us being able to grow closer to markets, we get that food waste number down. All of this transfers into a price per pound on the fruit and vegetable. And we very much want to be competitive with current pricing so that we're not raising prices for consumers at the grocery store.
Okay, we're going to watch as you continue to build out the business there. Jonathan Webb, founder and CEO of App Harvest. Congratulations on the SPAC IPO today.
Thank you for having me.
Coming up next, we're going to wrap up the day in oil with Jared Blickery. Welcome back to Yahoo Finance Live. There have been reports over the past 24 hours or so that ExxonMobil and Chevron were actually in talks to merge last year. And already we have got politicians weighing in on the rumor. Jared Blickery is here with that and a wrap up of the day in oil. Jared?
Wouldn't be politicians if they weren't weighing in. So let's talk about this. Yeah, seems like the talks were preliminary. They didn't really go anywhere, but it is fascinating. These are two of the biggest oil companies in the world. Worth highlighting that Exxon used to be the biggest company, the biggest public company in the world as late as 2013. Now, you take a look at the Wi-Fi Interactive. I want to point something out for the performance. You can see energy is getting a little bit of a bid today, but we changed this to a one-year look, and you look at all the red in the space. Haven't had a new high, record high in XLE, the energy sector ETF, since 2014, and these names continue to be under pressure, just really shells of what they formerly were in terms of market cap and no pun intended there. And you mentioned the regulatory response. Now, Amy Klobuchar, she's a Minnesota senator, also a ranking member of the Senate Antitrust Subcommittee. Now, she's weighing in on this and saying, quote, mergers like this are being considered for one obvious reason. The lawmakers, regulators, and courts have allowed increased consolidation in industry after industry. And yes, that is true. Maybe it makes sense in this industry since it's shrinking so much. Well, related news here, we just got the settlement in oil futures, $53.55 a barrel. That's up over 2.5% on the day. Notable because we are also seeing an increase in the US dollar. So look at this chart here. This is what oil has done since it's opened Sunday afternoon. And over the last month or two, we've seen it consolidating between 52 and about 53.50 here, maybe finally poised for a break to the upside if the strength can continue, especially in the face of that strengthening dollar.
All right, Jared, thanks a lot for that wrap up. Want to stick with the markets now, the broader markets, and bring in Paul Schatz, president of Heritage Capital. Good to see you as always, Paul. Before we get to the action today and the outlook, I wanted to talk about the phenomenon we saw last week with GameStop and Robinhood. And I know that you wrote a lot about it. Do you think that it is fair, the anger that we're seeing coming from small investors, or is this the market doing what it's supposed to do with its checks and balances to make sure things go smoothly?
The answer to both is yes. So first of all, clearly the populist movement by small investors against Goliath is certainly well-founded and warranted, but it always has been. There's nothing new to this. I would say I was skeptical that it was only mom and pop investors on Reddit that was causing this monumental epic move. Clearly, we don't know who's who on Reddit, and I would be a little skeptical and say there's probably some big money with a unique handle and acting as some 100-share small mom and pop investor, but it's certainly well-founded. And on the flip side, that this is the market functioning normally. Well, I'm so terrified that politicians are going to use this as an opportunity. I hear people talking about taxes. I mean, taxing transactions, short sales only. What needs to happen is the playing field has to get leveled. We know who owns stock, but we don't know who's shorting shares. So why shouldn't the playing field be level? We don't need politicians to put taxes in and to put up gates. You need the markets to function fairly and orderly. That's the key. It's got to be a fair and order flow in the markets. So, and they were. People may not like what happened, especially if you were Melvin Capital, but it's certainly fair.
So tell me how you start to level the playing field. I had a bunch of guests on last week. Some of them said, it's about restricting the small investor more. But shouldn't it be about restricting the Wall Street pros so everybody has the same rights? Or maybe you give more rights to the small investor. I mean, how do both coexist happily?
So the easiest thing to do is the playing field and the rules should be the same for everybody. We all know this. Shame on Robinhood and shame on Interactive Brokers for, quote unquote, protecting people from themselves. Who protected Lehman from itself, and who protected Bear Stearns from itself, or long-term capital from itself? They almost took down the market. So give me a break on Robinhood and Interactive Brokers. If I had money there, which I don't, I couldn't wait to leave. Frankly, that's shameful and wrong. And it certainly leaves me with some curiosity as to what was going on behind the scenes. And if you follow the trail of the money, perhaps you'd find out what really went on. But we need a level. The rules have to be the same for all parties. Let's find out, if I buy 10% of a company's stock, I disclose it publicly. Therefore, if I short a company stock, I should disclose that publicly as well. But shame on the platforms for treating individuals like morons, because frankly, the individuals have done better than the pros, certainly in the last year and possibly longer. And frankly, I don't hear about individuals taking down markets.
All good stuff there. I want to talk a little bit about what we're seeing today, though, because we're seeing this bounce back. The market had its worst week since October. Do you believe this is the beginning of the market, on this upward trajectory, or is this just sort of like a dead cat bounce?
I would probably say neither. I'd say this. We came into the year with epic and historic greed and euphoria. And I wasn't making a prescient call. I just said at some point in the first quarter, you'll get a minimum of 4 to 8% down. So over a 12-week period, it isn't that hard to say because that happens normally. But when you've got all that greed and euphoria, it pretty much almost always happens. So I think this is that 4 to 8% pullback. Was Friday the low? The odds don't favor that Friday's the low, but I'm not going to be arrogant enough or dumb enough to outguess the market. I think you're in that period for at least, so Friday we had an ugly day. We closed the week, the day of the week, and the month poorly. That usually leads to a bounce the next day, which we're seeing today. I would not expect this bounce to go right to new highs. I would expect one more run. If you're looking at the Dow, one more run below 29.8, and maybe the S&P gives back today's gain plus, another 40 handles. I don't think this is the beginning of a double-digit decline. Young bull markets typically do not pull back more than 10% in their first year. This bull market began March 23rd, so a 4 to 8% pullback in the first year is pretty much normal. It's a gift, and it's one you should buy. I'd be much more concerned, frankly, Alexis, on the next run to new highs if we don't have broad participation, if the credit markets don't continue higher with the market, if we don't have this amazingly strong leadership. That's when I'd be more concerned. But I think if you're an individual investor, at least for me, I wouldn't run to AMC and GameStop. It's certainly way too scary for me. And I admit I'm a chicken when it comes to that. But certainly there's just a cornucopia of companies for another run higher in cyclicals and in small caps.
As you put it, this, the days that we have the down markets, they're a gift. They're a gift to buy. All right, Paul Schatz of Heritage Capital, thanks for being with us.
Good seeing you.
Coming up, we're going to speak to the author of The Hype Machine about social media's role in the stock market and beyond. for more on the Robinhood GameStop saga, I want to bring in Sinan Aral. He's a professor at MIT and author of The Hype Machine. Sinan, good to have you here. You wrote a great op-ed in the Washington Post. I'd encourage people to check it out about the herd mentality of social media and how it's bleeding over into the real world like never before. What are some of the long-term implications of that, do you think?
Well, I think what we're seeing is the rise of the crowd's power in a number of different spheres in our society simultaneously. We saw it in the election, the aftermath of the election, where information flowing over social media was able to coordinate an insurrection, a riot on the Capitol. And this was after we even had warning signs when there was a plot to kidnap and kill the governor of Michigan. Now we see crowds that are raising, again, a coordinated effort to drive up the price of a stock. And let me be absolutely clear. I do not mean to draw an analogy between the GameStop stock price and the Capitol riot to say that there's even anything nefarious going on in the GameStop situation. It may be that nothing illegal was done at all in the GameStop situation. But the similarity is that when information moves so quickly and can coordinate so many people so fast, it scales the crowd's power like we've never seen before. And that is the similarity between the two.
You know, this isn't the first time, though, right, Sinan, that we've seen social media sort of inflate stock prices, create bubbles. We've seen pump and dump schemes happen on social media with misinformation and fake tweets and fake posts on Facebook. So why was the GameStop situation different?
Well, I think a couple of things. So certainly in the past, when we've had misinformation used to pump stocks and then dump them, the SEC investigated and actually brought charges in those cases back in 2017, back in 2013 and 14. There were companies like Ledingo and DreamWorks that were indicted by the SEC based on pump and dump schemes over social media. I think the difference here is that the large short position of several major hedge funds made it enticing to see the stock price go up dramatically. And there was this narrative of the David and Goliath that made the story interesting. And there was a bandwagon effect that you might not have seen with sort of, pump and dump penny stocks or it's easy to coordinate when there's a narrative that appeals to the human heart and when there's a short position that is vulnerable on the very dramatic rise of a stock price. I think that was a big difference here.
What do you think might come of all of this in terms of regulation? Is the answer going to be, you think, to put more restraints on small investors, or will it be that there should be restraints on all investors and perhaps different restraints on short selling and buying on margin?
Well, I mean, I think that we need a thorough SEC investigation first. We're actually watching a plane crash, but the plane is still at 30,000 feet. It's not over yet. And I saw a tweet that said, I'm confused. Is it hashtag hold the line or hashtag hold the bag? Because, all of the holders can't sell their stocks simultaneously. And it's very likely that the price is going to go down and many people could be hurt in that process. I don't think that we should jump to conclusions and create more restrictions in a knee-jerk fashion. We need to start with an investigation that understands who was in this crowd. Were there institutional investors that had ties to institutions? What were their positions? Was there any misinformation that was being spread in this process? Because that would potentially run afoul of the SEC. I think there are two big risks here. When you untether the prices of stocks from the underlying economic reality of companies, there is the tremendous potential for instability. The second big threat is manipulation. If you thought Russia thought it might be productive to interfere in our elections through social media, imagine what they're thinking that they might be able to do now, given that you can change stock price outcomes by manipulating or talking on social media. And we know that there are automated trading algorithms that are linked to social media that trade based on the sentiment. So you might not even have to get somebody to buy the stock as long as there was talk about it It could trigger algorithms that would trade algorithmically on the stock. I think eventually what we'll need to do is we'll need to examine, after an investigation, the relationship between communication about a stock and trading about that stock. We need guidelines on how we can communicate in ways that maintain stability. I agreed with your last caller, your last guest, who said transparency is important. That's probably an important part of it, but we need an investigation first.
For sure. Lots for the SEC to consider. Sanana Rao, professor at MIT, author of The Hype Machine. Thanks for your insights.
Thank you.
Coming up here, how COVID-19 has people spending big on top shelf liquor. We're back after this. Sales of top shelf liquor, spirits such as tequila and whiskey, growing at the fastest pace in decades as more Americans drink at home. And Yahoo Finance's Sabeel Marcellus is joining us now to talk about what that all means for the distillers and their profits. Sabeel?
That's right. So under COVID-19 lockdown, Americans have been splurging on food and liquor, the name brand stuff, the great stuff, the expensive stuff to get through the cancellation of our social lives. So what the industry has noticed is that tequila and whiskey have just been flying off the shelves in 2020. And although bars are closed, distillers are posting their strongest sales in 4 decades. Just to give you an idea of the numbers, so revenue in the industry rose 7.7% in 2020 compared to the previous year to 31.2 billion in 2020. And what we're seeing is that consumers are buying the expensive stuff. So for instance, spirits that cost more than $40 per 750 milliliter bottle made up 40% of total sales for the industry's growth in 2020 compared to 34% in 2019. So high-end liquors obviously have been very profitable for the industry.
Yeah, go and pour yourself a cocktail after that one, Sabeel. Thanks for the update.
That's good.
All right, let's get another quick check of the markets for you. Stocks higher once again across the board with the tech stocks, the big winners today. We've got the NASDAQ Composite up now 2.5% or more than 300 points. Coming up here on Yahoo Finance Live, the original Wolf of Wall Street, Jordan Belfort, will join Adam Shapiro and Shauna Smith to discuss the Robinhood Reddit GameStop saga. We're back after this.
And shares of GameStop fell 25% in the first hour of trading, but shares are still a couple of $100 above the $2 low they hit within the past 52 weeks. Jordan Belfort, the Wolf of Wall Street and convicted felon, will join us with his assessment and if what's happening might actually be criminal. We're going to speak with the author of The Wolf of Wall Street in just a bit. President Biden will meet soon with Republican senators who proposed a $600 billion COVID relief plan to counter his $1.9 trillion proposal. On the table, more money for COVID-19 vaccines, but smaller stimulus checks. And the snow is falling at a rate between 1 to 3 inches an hour in New York City, and it's expected to continue through tomorrow. Temperatures may be falling to near zero, but the trading day is heating up as we cruise toward the closing bell. Hello, everybody. I'm Adam Shapiro, and we want to show you something because the weather is such a big story today. Sean and I are going to get to the market news in just a second, but take a look at what's happening. This is New York City, 18th floor, and I want you to see the snow outside the window. We've got about 2 feet of snow coming down in New York, and it's still coming down. The scotch is ready for after the show as we pass the bar. You can see right there, you got about 2 feet of snow. That's the benefit of TV journalism and live video. We can show you what's happening. And one person who's going to show us what's happening in real time is Chris Bruin from the Weather Channel. Chris?
Hey, Adam. Hey, Shauna. Thanks for having me. Let's show you an update from Central Park. Columbus Circle, popular spot, right? One thing I have noticing is, believe it or not, this is a lot lighter than what we've been seeing most of the day. The intensity of the snow has come down just a little bit. Not to say we're out of the woods, but it's certainly not nearly as heavy as what we've been seeing for probably 6 to 8 hours this morning and this afternoon. I want to paint this picture. Notice the police vehicles. I mean, they are just shrouded in snow. Snow really plastering even the sides of the skyscrapers, the subway stations. We even had word snow was getting into the George Washington Bridge, the tunnel. So you got to have a lot of wind and potent snow for that to happen. Take a look at the scene here high above. You're actually able to see the tops of the towers. That wasn't possible a couple of hours ago, and even making your way to some of these really big high rises, some of them still under construction here on the south end of Central Park. And the clouds really coming through. Winds are still going to be a problem. So here's where we stand at the moment. Official observations. Now, this was as of 1 p.m. this afternoon. National Weather Service, New York City, saying 13.3 inches has fallen officially in Central Park. That's well over a foot. And again, that was earlier this afternoon. So we may already have another couple of inches. And remember, that's just Central Park. Numerous areas probably have a lot more than that. We've had unofficial reports of over 20 inches already in parts of New Jersey. And so we're already on our way to 2 feet. And remember, we still have to get through the rest of the afternoon, this evening, overnight tonight, and then into the day tomorrow. Those winter storm warnings remain in effect until 6 a.m. local time. That's when the worst of the weather should be done. But snow stays in the forecast until Wednesday. Rather light. It's going to take a while to really clear out from this storm, and it's going to take a lot longer to clean up from this storm. So let's show you the overall snowfall forecast and where we stand. Additionally, on top of what we have already seen, on top of all of the snow that you see, in some cases it's hard to even walk around. Cars are buried. I saw video out of Queens. I mean, not only were they dealing with the snowstorm, but also coastal flooding on the order of 2 feet, and those gusty winds causing some major waves out towards the coast, especially in the Jersey Shore and Long Island, 40 to 50 miles per hour. An additional 4 to 6 inches can be expected over the next 24 hours, and I think that will be the bulk of the storm here for the greater New York City area. In fact, if we were to end up with 18.1 inches officially, that would make this into the top 10 largest snowstorms in recorded history for New York City. Now, in 2016, we had a really big winter storm. I think a lot of folks remember that, Winter Storm Jonas. This one rivals that. I don't think we'll quite see those totals, but I could be wrong, and I'm not going to say it's off the table completely. But if that heavy band sets up and shifts back over New York City like we had earlier this afternoon, we could very well be on our way for over 2 feet of snow. At the moment, that's not looking likely, but still not out of the realm of possibilities. So New York City Sanitation Department has been around the clock. They've got over 2,000 plows and men and women plowing hundreds of miles of streets here. And again, the New York City mayor urging everybody to essentially stay home. A lot of people walking, not a lot of people driving, and that's the way to go. But I will say there is an air just walking around. You've got people, kids and adults and pets, by the way, just loving the scene. They have to get it on the camera to let their friends and family know what's happening here in New York City.
Yeah.
It is quite the ride. And even though we didn't have in-person school, we had virtual learning here for a lot of the metro areas. It almost felt like a snow day. Even if you did have to go to work, it's hard to ignore what's happening outside your window. It really is quite the spectacle here in the biggest city in America, guys.
It certainly is, Chris. And I'm looking out the window right now. There's snow plows going. They've been going all night, started last night, going all day today. So certainly something to watch. And it's been quite some time since we've seen snowfall like this in the city. All right, Chris Bruin of the Weather Channel, thanks so much for giving us an update. We want to take a look at the markets today because we're seeing a big rebound after last week's sell-off. All three of the major averages are in the green, with the Dow up just over 300 points, less than 60 minutes to go until the closing bell. We see GameStop, so that was the name that has been front and center now for the last several trading days, in the red today after being halted earlier. The Reddit craze moving to something new. And we want to bring in Ines Ferre for a little bit more on that. And Ines, a lot of the focus today being placed on silver.
Oh, that's right. Silver seeing a boost today, and you can see silver futures up 7%. You've also got some mining companies around silver that are seeing a boost as well. Take a look at Avino Silver and Gold Mines up 43%. This is after some Redditors appear to have been pushing for a short squeeze on silver over the weekend, with silver squeeze trending on Twitter. I will mention, though, it does seem to be a divide on Wall Street Bets Forum on Reddit. You have some posts on Wall Street Silver, which is a subreddit, which says buy silver, silver short squeeze that was trending that we saw over the last couple of days. But then you have some other prominent posts from some members saying there is no short squeeze, and they're not behind this. They're not behind this push to take silver higher. There are bots on the forum, and they're saying that this is to distract everyone from shares like GameStop, like AMC, pushing these stocks higher. As you noted, GameStop down about 27% today. Shauna, Adam?
Inez, thank you very much. And want to remind everybody that we've got Jordan Belfort coming up in just a bit. But we're going to talk about these markets and where we're headed going forward. To do that, we invite into the stream Sonal Desai, Franklin Templeton Fixed Income CIO. Good to have you here. And want to switch our focus right now on fixed income and the kind of yield as investors. I mean, we always want to get yield, but where we should be looking. You're advising emerging market debt as well as municipal bonds. Why are you confident that's where we should look?
So it's also high yield, and it goes back to where you started, actually, Adam. When you think about where yields are right now, and you go back to first principles, why do people invest in fixed income? Because they want some income, and actually there is very little income in most parts of that asset class right now. So I think unless investors take a bit more risk, which is not a word which most people love, but without that little bit of risk, you're not going to get any income, you're not going to get much return. Munis are a different issue. Yes, there's income, either tax-free or taxable. Now, tax-free munis, the reason we think that that's probably a good place to be is we do think tax rates are going to go up in a variety of different states. That's pretty much a given as we go forward. And so that's one area that we are looking at. And emerging markets where we still think technicals are favorable. And also there is not all emerging markets, as always, not all emerging markets, not all high yield. You have to be very selective. But those are the areas where there's still a little bit left.
Well, a lot of the attention over the last week, I want to talk about this speculative buying that we've seen, this retail trading frenzy, because it doesn't necessarily stop with the stock market. And I think a lot of investors, when you think about that, you think the ripple effects would just be with equities. But I'm curious if you have any thoughts just on what it could potentially mean for the bond market here going forward.
I think for the bond market, chances are it's not quite the same thing. It could happen for high yield bonds, certainly, or investment grade bonds. But if I think about the largest asset classes like US Treasuries, for example, it's very difficult to imagine quite the same level of let's call it a feeding frenzy, because that's what it was. It is a fascinating episode. There's no doubt about it. We've never seen social media play a role like this, wearing both as an investor and as an economist. I find the entire episode absolutely fascinating, because when you strip away the issues of, it's the hedge funds who are shorting, who is at the heart of it. At the heart of it, you've got an enormous amount of buying that isn't necessarily focused on fundamentals, which in turn almost necessitates the type of volatility we've seen. I just heard that GameStop was down 27% today. It's not that surprising given how it builds up. If people pile into a stock and watch it go up like that, you're going to see it come down as well. On the fixed income side, I would like to think it would be harder to get to similar levels.
One of the things that an expert like you and a manager like you provides to a client is protection from someone who might say buy a bond ETF, because you could short a bond ETF, or for that matter, you could see the shorts go against index funds. I realize it's a stretch, but we're not seeing that kind of thing with bond ETFs. People, short interest in bond ETFs really rising dramatically, are we?
No, we are not. And I would be surprised if we did. And inherently, a bond ETF, you just said it, it's spread out over a huge number of bonds. It's not got that same concentrated power that was on display the whole of last week with these 2 or 3 stocks that were really impacted by what we saw. I don't think you'd really be able to see this on the bond front. Could you see it with single commodity ETFs? Potentially, it's not clear whether silver, in fact, was a part of one of these. Let's call it a flash mob, but it's not clear whether that was the case or it wasn't the case. But for an entire bond ETF, it's just much harder to see the same impact as we've seen. But we're not seeing it happen to equity ETFs, for example. You can short equity ETFs as well, but that's not what we're seeing. We're seeing individual names coming up, and that's what I think is harder to see in the bond universe.
So now we only have about a minute here, but I'm curious, there's that story. And then the other big story this week is happening with additional fiscal policy. President Biden is expected to meet with 10 GOP senators in just around 2 hours, talking about the plan that they're putting forward, $600 billion. I'm curious just what you think the market needs at this point, or what is necessary to get us on the right track, to get us past the pandemic.
So, it's very interesting. There's what the market needs and what the economy needs. The market would like to see a big package, because that's what the market wants to see. The economy, I think, probably could do with a somewhat smaller package, because we've got a lot of other tailwinds which are helping the economy. The vaccine, we've got the natural or whatever. We're seeing a reduction in the total caseload of COVID. We are seeing massively easy monetary policy, and we haven't yet fully deployed the last 900 billion. So, if we got the entire 1.9 trillion, which is currently being suggested, 1.9 trillion plus the 900 billion, which we already had, you're talking about close to $3 trillion of fiscal stimulus at a time the economy is actually working its way out quite well. So I would say what we will end up with, and I think what the market is prepared for, is something between 1.9 and the 600 billion. Nobody really anticipates that 600 billion will fly. But do we see the 1.9 trillion being whittled down a bit? Yes. And I don't think the market is going to be shocked if we are at somewhere between 1.2, 1.5 trillion in the end.
We always look forward to you joining us, Sonal Desai. Franklin Templeton, CIO Fixed Income, so good to see you. When we come back, a COVID update plus a new study shows children may actually be safer from the virus in school as opposed to being out of school. Dr. Daria Long has that report for us coming up.
priority of the Biden administration is to get more and more Americans vaccinated. The CDC out with new data saying that as of yesterday morning, more than 31 million shots have been administered. We want to bring in Anjali Khemlani for the latest on this, Anj.
Thanks, Shauna. We actually have updated numbers on that as well. Now we have more than 32 million administered of nearly 50 million shipped. And that's an important number because we're catching up to that pace that the Biden administration had hoped to get, which is about 1 million a day. On average, we've already reached that, but it does still fluctuate a little bit. We do know that we're also past that 50% mark, where at least more than 50% of the vaccines distributed have been administered. We also got a new report from the CDC today talking about those vaccinations, tracking the first month from December 14th to January 14th. 13 million vaccines were administered, and of those, 63% were women, 55% were older than 50 years, and 60% were non-Hispanic white. Now, that 55% of 50 and older, not surprising. We know that the makeup of the priority groups were first healthcare, and then long-term care staff, and then residents. So that was, that makes sense. We also know that the non-Hispanic white is of concern. It's a conversation happening right now. We heard it from experts and Biden administration officials this morning that the health disparities is front and center right now, noting that in addition to the disproportionate impact to the minority communities, we also know that vaccinations are following that trend right now. Back to you guys.
Anjali, very quickly, when we talk about vaccination disparity, we have so many different vaccines out there, and there's just disparity among which vaccines might be better than others. Is it even appropriate to ask that question, which is better than the others?
I'm glad you brought that up. There has been discussion about that, especially after we got Johnson & Johnson's efficacy rate last week. But experts are saying that the key metric to actually look at is which vaccines prevent hospitalization or a severe disease. And those are key metrics to look at. That is what all vaccines offer right now. So we have experts like Dr. Fauci emphasizing that, saying that that is the number to look at. So that's where the emphasis should be.
All right, Anj, thanks so much. Stick with us because we want to continue this conversation. For that, we want to bring in Dr. Daria Long. She's an ER physician and clinical assistant professor at University of Tennessee School of Medicine. And Dr. Long, great to have you on Yahoo Finance. Let's just start with the vaccine inequality, because I think that's been a topic we've been talking about a lot here at Yahoo Finance, the fear in terms of some of the numbers that we're seeing now that minorities are not getting the same access that whites are in this country to the vaccine. I'm curious just what you've seen in your hospital and if you've noticed similar trends.
Yeah, Shauna, I think this is a great question. And when we look at vaccine inequality, we're talking about vaccine inequality of access. And I think it's two things. I think it's one, it's accessibility of just being able to get the vaccine. Right now, it's difficult to be able to schedule online and the challenges there. And then I also think there's a trust issue and trust in the communities. So I think as we're looking at getting the vaccine to people, we need to make it easier to get to a variety of communities and also make sure that they trust it enough to be willing to and want to get this vaccine and seek it out.
Doctor, I'm curious because as we just heard from Anjali, some of the CDC data shows that African Americans received 5.4% of the shots, whereas African Americans are roughly 16% of healthcare employees in this country and 14% of nursing home residents. When we look at that kind of discrepancy, are we asking the question correctly to make sure we're seeing what's truly happening out there?
Well, I think we need to separate those. I truly hope that regardless of race, anybody who is a healthcare worker or working in a nursing facility, that they are getting the vaccine. And I think that needs to be established. And if there is truly a race discrepancy there, then we need to go and find out why. Is that a trust issue? Is it an accessibility issue? And then you need to look at the rest of the population, which I do think is going to be that combination of accessibility and trust. And how comfortable do they feel getting this vaccine? We can't understate that.
Doctor, I know that part of the caveat of that report was also that there is not a full detailed data coming in from all 50 states and additional jurisdictions and territories. So I wonder, is there any effort or should there be any effort on the federal government's part to collate this data, or are states doing anything, or should they be responsible for that?
I think this entire situation of COVID, we've seen many moments where states have been having to figure things out on their own. I think this is really a moment where the federal government needs to step in terms of protocols, in terms of delivery, in terms of dashboards of tracking who is getting the vaccine, as opposed to states having to figure it out.
Dr. Long, you're out with a new study. You conducted a study here. You looked at 2 independent schools with in-person learning during the pandemic to really determine the safety of this, whether or not this should be occurring at this time. I'm curious what you found, because this is an issue that has been so popular and has really been highly, I think, contested over the last several months of the pandemic.
Yes, Shauna, this has been a really divisive issue. And what we did is we tracked 2 schools and we tested the entire population, K through 12, 3,700 students and teachers and staff. And we tested them ongoing from August through the end of December. It's really the only data set that we know that's had that degree of completeness. And we found a number of different things. One, we found that 91% of cases of COVID who walked into the school never transmitted at all. There were 9% of cases that actually led to cluster of outbreaks or transmission, and we could almost invariably trace those back to violations of protocols. So that really emphasized for us the importance of adhering to protocols. And we're talking about universal masking and distancing and a number of other things. And that when you do not follow those, then that's when you see transmission. And that was one of the key, one of the most important parts.
Not taking sides in this case. We all have friends who are teachers, and we all have friends who have kids in school. But if you were advising the city of New York, the largest public school system in the country, to use your data, what would you say to them?
And well, first I would say there is no taking sides here. I think we all want our children to get back to school in a way that also keeps students and teachers and staff and community safe. There is no side at all. I think that's really important to note. I'd also say that since our schools were very clear that we are going to stick to these protocols and we're going to do testing available for teachers and staff, that had a huge value of confidence for our teachers. Our teachers for these schools were concerned going back to school. But once they saw the protocols and testing in place, we had huge buy-in. So it's really important so teachers don't feel that they're endangering their lives to go back. They understand that this is possible. I think there's 2 other things. And one is that it's very incumbent upon the government here to, one, create centralized guidelines. Our schools many times felt like we were being our own public health department. Every school can't do that. You have to have guidelines from the government. And secondly, to make testing available. We've heard so much about these $5 tests. We scoured the country to find cheaper tests. Those did not exist on a at-scale basis for K through 12. We need policymakers to help lean in on that.
Dr. Daria Long, great to have you on the program. You're a physician in Georgia and Tennessee and a clinical assistant professor at University of Tennessee School of Medicine. We really appreciate you taking time out of your busy day to join us. And of course, our thanks to our healthcare reporter, Anjali Kamlani, as well. Coming up next here on Yahoo Finance Live, GameStop shares, they're slipping today, but still high at the sky high. It's all relative. But we want to talk to Jordan Belfort. He's the Wolf of Wall Street, also convicted felon, on whether what's happening here might be criminal. We're back with that in just 2 minutes.
Welcome back to Yahoo Finance Live. We want to invite into the stream Jordan Belfort. He's the author of The Wolf of Wall Street. A lot of people know him for several reasons. I remember speaking to you when I worked at Fox Business many, many years ago, but we invited you in, and we don't want to glamorize you because of the past, but the past is in the past. But you have insight into Wall Street and what's going on with the GameStop phenomenon that could be useful to people. So what's the most important thing you want them to know, given what you've witnessed over the last 20 years?
Well, listen, it's amazing what these group of Robin Hooders and Wall Street bettors have been able to do. I mean, I used to battle with the shorts all the time. The shorts are usually right in the sense that they have the fundamental value, pretty much worked out, but they have a way also sometimes of getting overly aggressive. So there's different types of short players. There's short sellers that are healthy. They check the market. They bet against stocks. And that works. It's good. It creates liquidity, stops stocks from going up too fast. Then there's other types of shorts that actually conspire to drive stocks down. They will create press releases, investigations, and they will try to short a stock out of business almost. They often are so short, they have the potential to create a short squeeze, meaning if buyers come together on the other side, they can create a rally and literally wipe the shorts out. What the small investors have been able to do here is shocking. It deserves an applause, I think, by the way. I don't think it's illegal because most of them, by the way, if you actually go through the message boards, what they're saying, they love the stock. They're just having fun and they want to kind of stick it to the man more than anything. So it's a shocking thing, but they better be careful because when it's over, it's going to be like catching a falling knife and it's going to drop precipitously. So I just want people to be really careful when they're playing in this space.
So let me just follow up with you because there are some people who are saying what we might be witnessing is some kind of either social media pump and dump, and your history, you would know what a pump and dump looks like, or maybe a big money silent person in a different form has gotten onto that Reddit channel and is manipulating people. What would you say?
Listen, you might, at the latter point, you would never really know. That's a good question. I guess you'll find out in the end. I doubt that. I think what you have here is a groundswell from the masses. People are locked up. They're bored. There's a convergence right now of technology. People can trade immediately now. There's access to information. There's ways to exchange ideas. It's like the perfect storm. And I think it represents a paradigm shift in how stocks trade, how they'll have to be not shorted or shorted, depending on not just on, do you think it's a bad company? Can you get squeezed? Now, as far as, is there a crime going on? Listen, I wouldn't say it's a crime. When I first looked at it, I said, yeah, it's a modified pump and dump. Right? Because in some respects it is, the stock is being pumped up. But here's the deal. Most of these people, they know they have, if you actually go through the messages, when I even said pump up, no, we want to hold it. These people, they want to buy and hold. So, I guess you could argue they're probably, the stock's overvalued heavily. No one would deny that right now. It's massively overvalued. But then again, on any given day, the stock is worth whatever the market says it's worth. So when you have these short squeezes going on, there are these blips where you're going to have wildly inflated prices. We see it now happening with the silver market again. Because it doesn't take that much, especially when you're buying options, which magnifies the buying effect. So again, the issue I have is that when these things unwind, they will unwind really fast on the downside. And typically it's the last person on the deal team. For example, I had someone fixing my TV the other day, said, oh, my mom, who's 83, was talking about GameStop. That's when it starts, because, when those people, the last group starts getting in, that's when it gets very dangerous.
That is when you start to get very concerned. Jordan, I'm curious to get your thoughts just on the steps that Robinhood took last week and what they're doing today. They're still limiting trading on a lot of these heavily shorted names. It's a move that's been criticized by many out there. What do you think of it?
Originally, I understood it because they do have liability for sure, but what they did by completely eliminating buying, that was a bit of a red flag to me, that there might be some other more nefarious things involved, like getting pressure from the people who are short. I'll tell you why. They could have just as easily raised up the margin. That's a phrase, meaning to make it more expensive to borrow money, to actually not allow people to borrow as much money to buy. That certainly could have slowed down the buying without them to stop it cold. So that knee-jerk reaction to stop it cold is a bit troubling. And, at first I understood it, but now as I look more deeply, it is very strange they would just not raise the margin up, because that would have accomplished the same thing without shutting it down. And meanwhile, the bigger problem, I think, for Robinhood is that now they're going to be getting sued by everybody. And whatever, side you're on, you'll say, I lost money because of the decision Robinhood made. It's going to be very, very hard for them to stay in business, I believe.
Well, they're raising quite a bit of money from their investors, but how do you view that? Desperation or something else?
They're raising money right now probably for the purposes of margin, and you have to have certain amounts of money on reserve with your clearing brokers. Remember that when all these small investors are trading, when the stock drops precipitously, the likelihood is that there will be losses in the accounts that exceed the amount the people had on reserve for margin. There actually will be net losses in these people's accounts. So now you have all these small accounts that might have losses in there that Robinhood would have to make good on. That's why they're being forced to pledge more money. That's why I said the better move would have been to raise up the margin to eliminate that possibility versus to stop trading altogether. So they raised money because they probably had to raise money because they were almost out of ratio. I don't think that has anything to do with what's going to happen when so many lawsuits are pouring in. That's the bigger issue, I believe, because, we live in a world where people sue, they form classes to sue. So I think that is the biggest danger of all, the lawsuits that follow this, what's right now, a massive upswing, and eventually will, of course, be a downswing as well.
Jordan, we're getting some breaking news. There's reports that Robinhood CEO is going to be testifying in front of the House Financial Services Committee later on this month. I'm curious, just when we talk about potential regulation, because that, of course, is another aspect of this conversation. The SEC has said that they're monitoring this extreme volatility. But what do you think is going to happen on the regulation side as a result of this?
The SEC is great at doing stuff after the horse is already out of the barn. Then they're going to close the barn door. The market itself will be far swifter in closing what you could call either a loophole or an inefficiency in the market right now. So what you basically have right now is an inefficiency where people are able to get involved with certain stocks or commodities, and if they get behind them and it's on a message board and they all love a stock, they start talking about it, then this sort of loose group of, it's not really collusion, I don't know what to really call it, but you have this group of people and it spreads like wildfire because things go viral, and they get together and drive up these stocks that have large short interests and are just probably a bit on a more thinly traded. Wall Street will close that efficiency very quickly. In other words, you're starting to see already insiders selling at the higher price. I believe AMC, some funds blew out of all of their stock on Friday. You're going to start to see short sellers become much more conservative with allowing themselves to get that short. So I believe that eventually the SEC will do some things to try to stop this behavior. But before they even get around to it, I think Wall Street itself will have closed most of these gaps and loopholes and make it more difficult for people to find the right deals to do this with. They'll always find some people are smart too on the other side. So I think Wall Street will close the gap.
Jordan, the business model for Robinhood, we talk about order flow and selling that. And we had a discussion 2 years ago with Vlad Tenev about potential front running. But I want to ask you very simply, is Robinhood toast? Are they going to be forced out of business, do you think?
Toast, I think, but that's just my opinion. I think there's a couple of things. Number one, obviously this PR debacle there right now, that they were actually, selling themselves, democratizing investing, and actually they're selling order flow to the big guys who are using that to try to gather intelligence on what the market's going to do next. Bad PR, not illegal. I really believe the lawsuits are going to be very problematic. And we've seen this in the past with other brokerage firms when, they get sued, it gets to a certain point, they might not go out of business. They'll have to sell to someone else, and they'll have to sort of separate out the legal entity that got sued from the assets of the company. Something is going to have to happen here, I believe, because I can only imagine, think about it, there's all these small investors. On one day, they were not allowed to buy anymore, which theoretically could be said, well, they were manipulating the stock downward, Robinhood. And they have their reasons why, I'm sure. But maybe there's also some emails, and I bet there are, where the shorts are complaining to Robinhood, like, this is not right. What do you, like, any one of these emails will come out in discovery and be a so-called smoking gun. And wow, I mean, just imagine the number of lawsuits and what that will do to the ability of Robinhood to stay in business because of just that capital reserves. Forget public perception, just simply their balance sheet will be a disaster. So that's my opinion.
Jordan Belfort is the author of The Wolf of Wall Street. Thank you for joining us here on Yahoo Finance Live. We'll be right back.
Welcome back. We've got about 20 minutes to go until the closing bell, and you're seeing a bit of a rally here on Wall Street as we try to recoup some of last week's losses. Dow, S&P, and NASDAQ all in the green. The Dow up just around 275 points, S&P up over 1.7%, and the NASDAQ up. NASDAQ is the winner here, the clear outperformer of the three averages, up just over 2.5%. Sector-wise, all 11 of the S&P sectors are in the green. Technology, communication services, and consumer discretionary leading the way. Well, earlier today on Yahoo Finance, Yahoo Finance spoke with Glenn Fogel. He's the CEO of Booking.com about when he expects the travel industry to fully recover from the pandemic. Here's what he had to say.
Right now, people are still booking for a very short period of time. And so people are saying maybe next week, next weekend. They're not really surging to say, I want to start planning for the summer yet. We call that a short booking window. But I am very confident that as things start getting better, as these vaccines start getting rolled out, as people feel safer, I do believe people will be thinking more and more about their summer holidays and will start booking.
You may still be in a lull in terms of where things stand in comparison to pre-COVID times, but I wonder if you have seen a sentiment shift at all that has come along with the rollout of the vaccine.
I think people are generally becoming more optimistic about the future. I think we all feel that with these new vaccines, that people feel that we're going to get over that mountain at some point and start getting into that beautiful valley where things are safe and we get to live like we used to. But we all know it's going to take time. We know it's not overnight. It's not like flicking a switch. And we know gradually things will get better. And I think the thing that's going to be slowest is going to be the international travel, because governments are still going to be a little bit leery about letting those restrictions go and letting people just flow in and potentially raise up those infection rates. So I think that's going to be the last thing to come back.
Yeah, and Glenn, I mean, we were looking at this last year. Air travel took a hit, but more people were driving and taking road trips out there. I know that you guys operate through the hotel side, through Priceline, Kayak, and Booking.com. But what are you seeing in maybe that hotel booking resumption there when you think about that becoming a big piece of this?
Well, you're absolutely right. And we saw that in the summer, how people were looking very, very local. They wanted to get in the car where they felt safe and go to someplace. And whether it was a hotel or they wanted to rent a home in our homes department, we saw people did want to travel still. I think over time, people will want to go further or far. Now, look, people want to travel. They always want to travel, and they want to get on that plane and go someplace different. And we think what we really just need is safety. Once people feel safe, they'll start getting on those planes again.
What does all of this mean from your company standpoint? When you look at Booking.com, of course, you had to close some offices last year. You announced some layoffs as well as a result of the significant slowdown you saw. Do you anticipate more coming, given that things haven't bounced back to the levels you expected?
Well, we took a very long view of the future. We knew that this thing was not going to turn around right away. And unfortunately, sadly, 2020 was a terrible year for our business. And unfortunately, we had to let go about 25% of our employees. And it was very sad about that. But we think that's done. We think things are going to start getting better, and we are not expecting any further cuts. In fact, we're hoping that things do get better sooner rather than later, but we know it'll take time. And that's something that we'll all be very happy about.
Yeah, 2020 was a terrible year for a lot of people, and also terrible for the customers of some of your services too. OpenTable is in your guys' umbrella of brands. When we spoke to them earlier last year, it was kind of shocking to hear the expectation that 1 in 4 restaurants would permanently close because of the pandemic. Is that still what you're seeing when you look into that OpenTable data?
Well, the fact is, let's face it, restaurants generally have a very tough time anyway. Margins are low, and a lot of them go out of business a lot. Absolutely, the pandemic, though, really threw a loop into that industry, and it's going to take time for people to come back and feel safe going to restaurants and dining indoors, but that absolutely will happen. Again, it all comes down to how fast do we get these vaccines rolled out? How fast do people start taking those vaccinations and start feeling safe so they can then travel and go to dining and do everything they used to do? That's why it's so important that our government continues to work so hard at getting this rolled out as fast as possible, using all the powers of the federal government in the U.S. and around the world to make sure that these vaccines are put into people's arms as quickly as possible so we can get back to a normal life.
That was Booking.com CEO Glenn Fogel. Well, we're going to hear more about the travel industry and the expectations for recovery tomorrow when we talk to Ed Bastian. He's the CEO of Delta Airlines. That's set for 3:30 p.m. Eastern Time tomorrow afternoon. We'll be right back.
Welcome back to Yahoo Finance Live. Let's bring into the stream Jeff Taylor. He is the co-founder and managing partner at Emphasis Digital Risk. And we're going to talk about what's happening in the real estate market. We saw prices are escalating. We keep hearing these stories about mass exodus out of big cities in the coast. You say still shallow. What does that mean?
It is still shallow. And thank you so much for having me today. So we have seen, people going from cities in the suburbs all over the country and growing, except the Northeast. But as far as mass exodus, I think people are getting to Texas, are coming to California for maybe tax reasons, for lifestyle reasons. But we still haven't seen that mass exodus area thought was going to happen. But we had definitely seen is people moving into the suburbs and looking for living spaces in a little bit of a different manner than they used to, which is houses that are not just to live in, but it's for their work. It's how they potentially do virtual schooling. It's a whole new view on what a house means to a family than it did 12 months ago.
And Jeff, another thing that we're seeing clearly is the rise of home prices, something that we've been seeing now for quite some time. The pandemic, though, exacerbating that. A lot of that has to do with the supply crunch. I'm curious just how long until you expect this supply-demand imbalance to be corrected?
It's a great question. So let's look at the key drivers. Last year, record number of existing home sales, 5.62 million, 811,000 new home sales. And that demand and supply, there's still a massive imbalance. Couple of things. One, as far as the supply chain for new home sales, that's still because of COVID. It's a little bit slower as far as getting all materials to meet the demand for what the home builders actually had. So in existing home sales, if people haven't moved already, a lot of people, believe it or not, are waiting for full vaccination to put their COVID vaccination, to put their homes on the market and potentially look for other places. So I expect to be another year of extremely of rising home prices. I think the median home price is going to get to about $360,000. And I don't see that slowing down anytime soon. Conversely, what you'll start to see is a lot of the exodus from some of the bigger cities, New York, San Francisco, where we've seen rental prices drop around 30% over the course of the last year. I do expect kind of that, go down to that Gen Z. The people will start moving back into the cities as renters, and you'll start to see that stabilize a little more, I think, in the second half of 21.
Jeff, we have about 30 seconds. Any cause to worry that there might be a bubble because of these artificially low interest rates?
Yeah, it's a great question, and there's not, because what caused the bubble back 10 years ago was basically, no money down, 90% leverage, and just you sign and sleep, right? We have a record amount of home equity, $18.7 trillion in these houses right now. So if somebody does have a financial life event, they're going to put that house up for sale. And to our question back to inventory, there's plenty of buyers for it. So you have a very healthy, steady housing market, and one that I think is going to actually driving the economy's comeback here for this year and for the next couple of years in the future.
Got it. Jeff Taylor is co-founder and managing partner at Emphasis Digital Risk. Thank you for joining us. We'll be right back.
The battle between retail traders and hedge funds, individual investors, we've been talking about this now for quite some time, a couple of days at least, piling into some of these heavily shorted names. We want to bring in Yahoo Finance editor-in-chief, Andy Serwer. Andy, you wrote about this over the weekend, about 5 trends behind some of the madness that we've seen play out in the market over the last week or so in the context of bigger trends. One of them that I want to focus on first is populism.
Yeah, I mean, that's right, Sean. A lot of people are talking about how what's going on with GameStop and Reddit and Wall Street Bets is somewhat similar to the populism you're seeing on the political front with Donald Trump and Bernie Sanders. And the bottom line is people are unhappy with elites. That's true in this country and it's true around the world. And it has to do with income and wealth inequality. And it speaks to the power that these people have been able to garner. I mean, retail investors, someone told me, used to always be wrong. Not anymore. And then another great line someone told me from Wall Street, 2020 was bad for humans, but it was great for finance. And guess who's getting revenge now?
So how does the media play into this, Andy?
You know, it's interesting. You know, at first blush, when you hear people saying, Adam, oh, blame the media, you know, I tend to discount that. But if you think about it, you know, is it a coincidence really that Donald Trump has stepped off the stage and has been banned from Twitter and Facebook, and now we have this giant news story? And a lot of people on Wall Street are saying you media people are just turning your attention to this story. And I think there's some truth to that. Another point that should be made is a lot of times people forget that Reddit is nothing more than a giant social media platform. We always talk about Facebook and YouTube and Twitter. Reddit's there too. And of course, this whole thing is of Reddit. And now, of course, it's on Twitter as well. So this is a great big story that we're amplifying, no doubt about it, Adam.
Certainly is. And again, you can catch Andy's full article up on yahoofinance.com. Andy Serwer, Yahoo Finance editor-in-chief. Thanks so much for joining us. We're less than 5 minutes, just about 5 minutes to go until the closing bell. All 3 of the major averages in the green. We're back with the closing bell in just a couple of minutes. We've got 3 minutes to go until the bell, and with that, we want to bring in Joseph Minarek. He's the Conference Board Chief Policy Economist and former OMB Chief Economist under President Clinton. We also have Chris Brightman of Research Affiliates. Chris, looking at the market today, Dow up 274 points, S&P and NASDAQ also in the green. What do you attribute some of today's buying to?
I think it's just a bounce from a difficult week last week. Perhaps with some relatively benign turn in the news from COVID.
Very quickly, want to go to you, Joseph, because as we look at this bounce, are you concerned about this back and forth so quickly?
I'm concerned. Well, I am afraid about optimism given the state of the virus. I think that's probably the underlying theme here. We have case numbers going down. We have a lot of risks to the outlook in terms of the effect of the virus. I think you could definitely hit a ceiling and bounce back. So that would probably be my biggest concern watching things right now.
We want to bring in Jared Blickery, who, of course, is watching this buying action today. And Jared, when we take a look at the markets today, certainly a different picture than what we saw several trading days last week.
Yeah, it seems from one day to the next, the opposite tends to happen here. So let's take a look at the Wi-Fi Interactive at today's price action. And it's really been about both the mega caps and the small caps. Look at this. NASDAQ and Russell 2000 each up more than 2%. And S&P 500 behind at 1.7%, and the Dow up 0.84%. But you take a look inside the NASDAQ 100 today, those mega cap names really stand out. Alphabet and Microsoft each up more than 3%. And then we also have Tesla up 6%, Amazon up 4%, and we will be getting Amazon and Alphabet earnings this week. A couple of these names here, especially in the software space, have been breaking out recently. Now, Amazon hasn't quite done that. It's been trading sideways for about 6 months, but you would think if they're going to have a great earnings report, this could be the catalyst that finally propels it to record highs, which it hasn't seen in a while. Same kind of going for Alphabet, although Alphabet already broke up, still has been going rather slowly at that. And then you take a look at the sector action for today. Tech, discretionary, real estate, and communication services all outperforming. But again, those small caps also rallying as well. There's a closing bell.
All right. Put it into the history books. When the hammer comes down, we got a closing bell, and it looks as if the Dow's going to be up about 240 points when it settles. S&P 500 will be up about 60 points when it settles, and the NASDAQ up. Are you ready for this? 332 points, 2.5%. Components, as Jared was saying, the big winner today on the Dow was Microsoft. Looks like it's going to settle up 3.3%, but don't discount Visa. They're going to be up, it looks as if, about 2.5%. We're going to go back to our guests to break some of this down. And Chris, I want to bring you back into the conversation because of the unintended consequences of wealth inequality. Some people today got wealthier, others saw their retirement accounts get better. What's the real story?
Well, one of the indicators that we ought to pay attention to from a market perspective is the VIX at 30. That's warning of trouble ahead. And I think that's directly related to the income and wealth inequality issue that you're talking about. Almost without question, the Fed and the Treasury have inflated stock prices by pumping liquidity into capital markets, as recently explained by Professor Schiller, among others, and explicitly acknowledged by Jerome Powell. The unintended consequences of this excess liquidity is speculative trading activity and intergenerational conflict, in addition to the wealth inequality. And that you see borne out in very entertaining ways with the recent drama surrounding Robinhood and GameStop, et cetera. I expect with Democrats in control of all three branches of government to see efforts to mitigate these unintended consequences through further regulation, including looking at payment for order flow, tightening regulations on securities lending, and inevitable witch hunts for speculative, evil speculators. And those will probably lead to a whole nother round of further unintended consequences.
Joseph, one of the things that investors watched or are watching, continue to watch, obviously, but one of the data points out this morning, CBO predicting a faster recovery than I think we initially were expecting, saying that GDP is expected to reach the previous peak by the middle of the year. Labor market is going to be back to those pre-pandemic levels next year. I'm curious from your perspective, do you think that this is overly optimistic at all?
The one thing we have to be concerned about is the businesses that have been damaged on the way down. You know, the effects of the pandemic have been so concentrated in the narrow sectors of the economy with respect to entertainment, hospitality, and so on. The question really is how quickly can those sectors come back because of the concentration of job loss among people who hold those kinds of jobs. It's going to be, I think, a difficult road up. We will regain last year's GDP level probably at some point within this year. That, of course, is not the finish line because we've got a much bigger population and a bigger, potentially bigger economy now. We've got to go further than that to get all of the people who lost their jobs and all of the new entrants into the labor force to work. And that is not necessarily going to be easy because we don't have all of those doors, all those restaurants and hospitality and entertainment facilities all set to go back into business. That'll take a while.
And what would you say to the critics in Congress who say too expensive, the stimulus plans that being debated to do that?
Some of the money that is being contemplated for spending will not go out the door if the economy recovers. So, for example, building up unemployment compensation benefits for the folks who are out of work and have no real prospect for getting back. If they find jobs, those benefits are not going to be paid. I'm less worried about the ultimate cost than I am about the possibility of a lingering weak economy with a lot of suffering going on.
Jared, one of the big movers that we've been talking about today is silver. Silver is by far, though, not the only commodity that we're seeing posting gains. I'm curious just what you make of this action and what does this tell you just in terms of what we could see play out over the next several weeks?
Yeah, let's go to our commodities heat map on the Wi-Fi Interactive. And there is a lot of green here. Guess what? Silver's up 8% right now, still trading electronically, up 15% over the last 5 days. And you can see it really started to break out late last week. And we did cover this a bit on some of the shows. But natural gas is up nearly 10%. Of course, this is a winter phenomenon. But you look at platinum, heating oil, crude oil up over 2.5% today. And put it together, on a day when the US dollar was broadly stronger. I think that's impressive. And I've read a number of analysts making the case that long term, we could be in another secular bull market for commodities. And that's because the Goldman Sachs GSCI index, that has basically been consolidating for a number of years and is just now breaking out. And put it all together, yeah, the GameStop, Reddit, Wall Street bets phenomenon, definitely juicing some trades here. But the silver thing, I think, is a little bit outside. Maybe some of those stocks, and we can take a look at a couple of them. The smaller miners benefited from some Wall Street bets love today. But other than that, I wouldn't discount this rally that we're seeing in commodities now. And I think we're going to see more in the years as the year develops. And it's really bullish on the reflation trade overall. And just to close out here, Healthier Choices Management. Now, this isn't an energy ETF, but this is up 118% today. And then here's the silver play, looking at Avino Silver and Gold Mines, up 60% over the last 5 days. And last week, they announced that they're going to do another stock offering of a few million shares, and they're going to be able to do this at vastly higher prices now. So if this is, in fact, Wall Street bets, really helping out this particular issuer.
All right, Jared Blickery, thanks so much. And we also want to thank Joseph Minarek, the Conference Board's Chief Policy Economist, and Chris Brightman of Research Affiliates. Thank you to you both for joining as well. Let's get to the latest down in D.C. Now, one thing that investors have been paying very close attention to is, of course, all the talk on stimulus. It is one of the Biden administration's top priorities during its first 100 days. In just about an hour from now, President Biden is set to hold a call with 10 Republican senators. Now, these 10 Republican senators are the ones that wrote the letter and also proposed will propose a $600 billion COVID relief plan. We want to bring in our DC reporter, Jessica Smith, for the latest on what we can expect from this meeting. Jess?
Yeah, Shauna, this meeting is happening in just about an hour. As you mentioned, these 10 Republican senators have proposed this plan that is $600 billion. They say they think it could get bipartisan support and move through Congress quickly. They did unveil the details of the plan earlier today. We know that it would have $160 billion for vaccines, testing, tracing, and PPE. It would also have $1,000 stimulus checks, but they would be more targeted than the previous direct payments. Individuals making more than $50,000 a year would not get any money. The plan would extend the $300 a week in enhanced unemployment benefits through the end of June. It has $40 billion for schools and childcare and more money for small businesses. It does not have the $15 minimum wage hike that President Biden is hoping to see. It also is missing state and local aid, another priority for Democrats. The White House press secretary, Jen Psaki, said the president is not going to make or accept an offer in the meeting tonight, but it is to hear these Republican senators out. She also defended the size of the president's stimulus proposal, which is more than 3 times the size of this Republican plan. Let's watch.
His view is that the size of the package needs to be commensurate with the crises we're facing. That's why he proposed $1.9 trillion. There's obviously a big gap between $600 billion and $1.9 trillion. I don't think any of us are mathematicians, otherwise we wouldn't be here, but we can all state that clearly. And so clearly, he thinks the package size needs to be closer to what he proposed than smaller.
Now, this afternoon, Leader Schumer and Speaker Pelosi did file a joint budget resolution. That is the first step in the reconciliation process, which allows Congress to pass legislation with just a simple majority vote. So Democrats would not need any Republicans to pass President Biden's stimulus package. Democrats say they are still hopeful Republicans will get on board, but Adam and Shauna, they are moving ahead with this plan in case they don't.
Jessica, the Reddit retail investor rage and GameStop saga has people on Capitol Hill talking about a financial transaction tax. Who and would that impact the retail investors they allegedly are trying to protect?
Yeah, we are hearing from some progressive lawmakers who are calling for the financial transaction tax in light of this ordeal that we're seeing play out with Robinhood and GameStop and all the rest. Congressman Ro Khanna and Congresswoman Ilhan Omar tweeted about it last week. Omar saying in part, financial transaction tax now. Omar tells Yahoo Finance that a financial transaction tax could reduce high frequency trading and raise revenue to go towards things like canceling student loans or making college tuition free. Omar and Senator Bernie Sanders did propose legislation on this a couple of years ago, but it didn't really go anywhere. But just a couple of weeks ago, Congressman Peter DeFazio reintroduced his legislation that would put a tax of 10 basis points on the sale of stocks, bonds, and derivatives. He says it would raise $777 billion over the next decade. And he told Yahoo Finance that the GameStop situation illustrated that Wall Street is, quote, completely broken. He says it's clear that comprehensive reform must be undertaken to repair the damage. Any reform must include my financial transaction tax legislation. The FTT would rein in the worst behaviors of Wall Street and help create a more level playing field for Main Street. Now, opponents of the financial transaction tax say that this would hurt everyday investors who are trying to save for retirement. Congressman Patrick McHenry was on our air earlier today, and we asked him about it, and he said that it's a bad idea. He says he does not want to, quote, destroy our capital markets, going after some Reddit users. So this is one that we'll have to watch, Adam and Shauna.
Certainly is. All right, Jessica Smith, thanks so much. When we come back, Wheels Up is joining in on the SPAC craze with plans to go public in a $2 billion deal. We're going to talk to the company's CEO in just 2 minutes.
always rewarding to watch success when an entrepreneur takes a risk. And 7 years ago, Kenny Dichter did that when he founded and is now the CEO of Wheels Up. Good to have you back in the stream, because at the end of the second quarter, not only will we be able to buy into your company through a SPAC that was announced today, we can still fly with Wheels Up. Enterprise value $2 billion. What are you going to do when this deal closes? What does it mean for your essentially Airbnb in the skies?
Yeah, thank you. First off, thanks for having me again. And it's great to be here. Incredibly proud of my team. Love our partnership with Aspirational Consumer Lifestyle Corp., whose chairman, Ravi Takran, is the former chairman of LVMH Asia. So we got a great partner here, an operator's operator, joining our board, joining our team to help us globalize the business. As you know, we started our business 7 years ago, membership model with King Airs. And today we're the everything store of private aviation. Again, looking to be that Airbnb Uber of the sky. And it's all about connecting millions of customers to tens of thousands of aircraft in real time. And it's about global digitization, organization, automation in a space that's been analog. So it's a really, really exciting times.
Hey, Kenny, looking at this space, just how well has it held up amid the pandemic? Because I think that's a big question. One, I guess you could probably argue that the people that are using your service maybe weren't affected as much by the pandemic, but what have you found?
We've added a lot of new people during the pandemic, a lot of people, first-time flyers, a dynamic group of new members. I would say while individual travel has stayed really firm, business travel is off a bit. And I think that in the back half of 21 this year, we're going to see a really big bounce back there. But the industry as a whole has held in, really well during 2020. I'm grateful. And, one of the things that we did, because we had a business that was viable and strong, was really shift all of our assets away from marketing Wheels Up proper into Meals Up, which is a partnership with Feeding America, where I'm proud of this business metric. We've delivered over 50 million meals to folks that need it during the crisis. So while business has been good, we want to make sure we're doing our corporate and our social responsibility that comes along with that.
The company is going to list on the New York Stock Exchange under the ticker UP, which is appropriate. And I guess I'd call it sales are up, flew more than 150,000 people in 2020. The money that you'll raise from this deal, is it global expansion? Is it Asia? Because you pointed out that the people who are helping you do this have experience in Asia.
Yeah, well, it's clearly global expansion. It's digitization. We did a big partnership this year where we took in Delta Private Jet. We also worked a great marketing deal with Ed Bastian and his team at Delta that's going to pay dividends in the out years here. But this new capital, $790 million of fresh capital from A-plus investors, including existings like T. Rowe Price, Fidelity, Franklin Templeton, Monashi, new investors like Durable Capital, HG Vora, and the list goes on and on. Third point, really, really excited to have this new capital here. We added 20 institutions in this process, and it's for strategic expansion, just as you mentioned here. Asia is surely on our list of territory. Europe is a mature private aviation market. The Middle East, all of the big global marketplaces where private aviation has infrastructure, we're going to be.
Kenny, what do you think is the, biggest challenge facing your business right now? Because it sounds like you've been able to weather the pandemic relatively well. What's the big question mark that's out there at this point?
Well, I would say, for us, the only thing standing between Wheels Up and greatness is us. So we have to execute on our plan. We picked up an incredible flight management software system called Avianis, which is really the double click, or think about the bookings.com, what that meant to Priceline. We need to empower all of the operators around the world. If they feed us their real-time availability and feasibility, the Wheels Up brand, the Wheels Up platform is going to deliver the customer. So it's really the challenges to get anytime you want a plane, anywhere, we're going to deliver you the right asset. It's going to be a win for the consumer, the millions of consumers on the one side of the marketplace, and the tens of thousands of aircraft on the other.
Kenny, post-pandemic, how important is it going to be to your business that you can go on a Wheels Up flight and you don't have to go through a 2-hour flight on a normal airline, takes you 6 hours because of the headaches at the airport. Your flight's going to a private airport, boom, you're there and done.
Well, I would say, look, when people ask me about the difference of, going to Teterboro versus LaGuardia, and again, TSA does such a great job keeping us safe. And yes, it's a bigger commitment when you go to the airport. When you go to Teterboro and you go on a Wheels Up plane, you walk up the 8 steps, you turn right, and you don't worry about it. So I do think that convenience, that predictability, some of the time savings that come along with, private when it fits the story, I think it's a great luxury. I would say on the commercial side, look, Delta, our partner, I spoke to Ed Bastian today. They've done such a great job managing the crisis, leaving the middle seat open. I think Delta's going to come out of this incredibly strong. 80% of our clientele at Wheels Up flies commercial at some point during the year. So incredible partnership with Delta. And I think that there are real pluses on both sides. And now we have a closed ecosystem where you don't have to leave the Delta system or the Wheels Up system to do anything you want to do in aviation.
Kenny, you spoke to Ed Bastian today. We're speaking to Ed tomorrow. So we will hopefully have a chance to bring up this partnership. But want to say, as they say on the airlines, bye-bye. Kenny Dichter, Wheels Up CEO, we wish you the best in Q2 and look forward to your first earnings report. All the best to you. Speaking of earnings reports, tomorrow we got Amazon and Google, PayPal. Bob O'Donnell, President and Chief Analyst at Technalysis Research. Thank you for joining us. This is big. And let's start with Alphabet, or what most of us would call Google. I always get a little glassy-eyed because you have to talk about the, the X traffic acquisition costs. How important is that going to be tomorrow?
It's hard to say. I think the overwhelming, to be honest with you, I think it's going to be a small piece of the puzzle, because the really big story we're going to see from Amazon, as we saw from from Google, pardon me, as we saw from Facebook, was huge advertising revenues in Q4. And then, of course, Google has the added benefit of Google Cloud, their cloud-based service, which we will hear from Amazon as well. So I think the story is really going to be around advertising for search-based advertising for Google, for YouTube as well. And then, of course, the cloud-based business from Google Cloud. I think that's going to be the primary pieces of the story. The other details are not going to be a big issue in my opinion. And I think we're going to see pretty big numbers. The question is, how does the market think about the potential regulatory concerns that are clearly going to be facing all the big tech companies? But I think Google, Alphabet in particular, could have some of the biggest challenges.
Bob, I wanted to ask you about the cloud, because this is going to be the first report where Google is going to break out the cloud's operating profit. I'm curious, you're saying it's so important to this. I think a lot of the people would agree, but what are you expecting to see number-wise tomorrow when we do get that number for the first time?
Yeah, it's a fair question. And I'm not sure exactly what we're going to see number-wise. My guess is it's probably going to be pretty good. I'm not going to try and throw out a number, because I'd be speculating in a way that I don't think makes sense. But I do believe that because of the maturity of the business and the way that they've been doing this for a long time, and essentially, doing the legwork behind the scenes, that when they are choosing to finally release this profitability number, it's going to be pretty good, because we know what they've been spending from a capital perspective. We can see that from the chip suppliers and everything else. They're buying the components they need to build their cloud infrastructure. And I think we're going to see that the profitability on that cloud business is going to be very strong.
Let's turn to Amazon, because there's a key metric you're going to be looking for. This could be their first ever quarter doing more than $100 billion in revenue. Anything to slow them down?
No, Amazon is on a tear. And remember that in Q4, that's when they had Prime Day this year. Prime Day used to be in the summer, but because of the pandemic, it was during Q4, during the holiday shopping season, which was going to be big anyway. So you put those two together and it's going to be enormous. And then again, as well, they have Amazon Web Services, their cloud-based computing. And both Google and Amazon, of course, are benefiting, as we saw with Microsoft and their Azure business. They are benefiting from the fact that so much of the computing infrastructure that every company needs to continue functioning, in this pandemic world is being driven by cloud-based computing. So that is going to be a huge part of the story. Amazon they hired 400,000 people last year to accommodate the growing business. If you just think about the number of bodies involved in shipping all the products they've had to ship out, it's going to be a blockbuster number. The numbers I've seen have been all over the map, but I think it could be really big.
Bob, you mentioned regulation earlier. Just in terms of what it specifically means for Amazon, how are you looking at that, just in terms of the potential risk that poses to the company?
Well, I think in the case of Amazon, it's not quite as clear because they have very distinct businesses. Obviously, they have a huge percentage of online sales, but remember that online sales, as big as it is still a very small percentage of overall retail sales. And their cloud business, yes, is industry leading, but they have very strong competitors. So I don't think they have as many of the big issues other than the fact that they're seen as a very large company. And therefore, they're going to be, subject to a lot more scrutiny because of that. But in terms of the specific details, I think Amazon is a little bit safer than some of the other companies that we've been talking about, Facebook in particular, obviously, and potentially with Google.
Do you think there'll be any kind of mention in the report about the military contract, the kerfuffle that was taking place from the last administration?
I doubt it. I don't think so. Look, they're going to focus on the positive things, right? They're going to focus on the fact, as I said, they're hiring lots of people, and in a pandemic when a lot of people, pardon me, have lost work, that's a big deal. They've been making a big deal of the fact that a lot of their business is actually through small and medium businesses, even though a lot of small and medium business retail stores have obviously been terribly impacted. A lot of them are doing quite well on Amazon, and there's been a real focus from Amazon to get these small and medium businesses online, to feature them. And that's been a big part of the revenue story. And my guess is we're going to hear them talking about that as well tomorrow.
All right. Bob O'Donnell is President and Chief Analyst at Technalysis Research. Thank you for being here on Yahoo Finance Live. Speaking about e-commerce, it has to get there somehow. That's UPS, right? A big earnings report. Also checks the pulse of commerce across the country. We're going to preview UPS's Make or Break quarterly report right after this.
UPS is set to report their earnings tomorrow. The stock essentially flat over the last 3 months. Over the past year, though, up just around 50%. We want to bring in Wells Fargo senior analyst Allison Poliniak-Cusick. And Allison, great to have you on the program. A lot of investors are going to be closely watching this earnings report that we're expecting to get from UPS last quarter. They posted a very strong quarter. What are you expecting to see tomorrow?
Yeah, so I would say Q4 earnings are quite important, but obviously a significant amount of challenges and opportunities came to pass at UPS this past year. They did, talk through some incremental headwinds on the cost side as we enter Q4. So as we think about tomorrow and we look at the numbers, we're actually more focused on the outlook for 21. CEO Tomei had really, articulated a better, not bigger UPS. So we're going to be looking more towards some incremental commentary around that strategy as we go forward here.
Allison, how does selling their freight business to TFI International make them better?
If you look at that business, roughly $3-ish billion of revenue, but really almost just north of break even for UPS. And I would say it's pretty consistent with her strategy, right? Better, not bigger. And it'll enable them to focus on the broader or the more core to UPS in terms of that transportation business.
And Allison, going off of that, I guess that begs the question then, do you expect more deals like this to take place as UPS looks to streamline their business and I guess kind of get rid of some of those excess businesses?
It's a potential, right? We'll be looking for that when she articulates her strategy more in depth tomorrow and into the balance of 21. It's a possibility, but I would say it's really consistent, and she's willing to make the moves, which is important to us.
Do you worry, or does UPS worry about the gains that Amazon might be making? We're discussing Amazon, but we didn't get a chance to ask about, they've been buying airplanes, and they're going to be a challenger to UPS, are they not?
I know that's been an argument for the past few years. Amazon is a customer of UPS, so UPS does deliver those packages. So I would say UPS is more focused on sort of the B2B plus the B2C, sort of the combination there. Amazon, I think it would take some time to build out such a logistics network that UPS has in place today.
Last quarter, we saw the average daily volumes there in the U.S. rose just over 13%. I believe it was almost a 14% growth. A lot of that strength coming from residential demand. Is that kind of growth sustainable, or what would you think would be a measure of success here for UPS looking out a couple of quarters?
No, of course. B2C was the story in 2020. And, I think there is a consensus view that there's been a structural step up in those e-commerce shipments. Now, if you keep in mind, the B2B side has been challenged. They did see some improvement in the small, medium businesses, but more importantly, that commercial business for them in Q3 had been still down in 7% range. And if we look to 21, you're looking more towards that industrial recovery and that B2B side recovering back. Keep in mind, that's a better mix of business for them as well. So it's 2021 is going to see them trying to find that balance and that structural step up in e-commerce shipments, adding to what is a more profitable B2B shipment business for them.
In 2019, I remember writing a bunch of stories about their drone delivery programs. They're already delivering in some tested situations from CVS pharmacies to front doors. When's that going to be a profitable business to them? Do you expect to hear anything from Carol Tomei about the future of drone delivery?
I would say technology in general has been a big story for them, investing broadly across the network, drones being a part of that. I would say that's a small business for them today. We'll be looking for that to grow over the next few years. But I would say it's incremental from here, right? Really sort of in that test phase at this point.
Allison Poliniak-Cusick, a senior analyst at Wells Fargo. Thanks so much for taking the time to join us. Yeah. Coming up next here on Yahoo Finance Live, a Clubhouse showdown. Elon Musk tells Robinhood CEO to spill the beans on what exactly happened to the trading platform last week. Julia LaRoche will join us to explain all those details in just 2 minutes.
We've been talking a lot about GameStop and the phenomenon of retail investors being able to stand up to big money. Julia LaRoche knows a lot of people on both sides of that equation. We bring her into the stream because even Elon Musk is giving Robinhood a grilling. What do you got for us, Julia?
Well, last night, of course, if you heard about Clubhouse, it's the voice chat app that is all the rage right now in Silicon Valley. Elon Musk joined one of those rooms last night, and it was basically a packed house, so packed that they had overflow rooms. You've seen some of these streams leak online, and the real surprise was at the very end. Elon said, like, "Hey, do you guys want to hear from the Robinhood CEO explain what really happened?" So that's how they kind of kicked off this conversation. And he was basically like, "Hey man, like spill the beans, like what really happened?" And he grilled him around things like, like, was this shady? So for 14 minutes, the Robinhood CEO had to explain, exactly what happened, especially with the clearinghouse side of the equation. So some of the things that came up during that conversation was that Vlad Tenev, who, by the way, was on our air just on Friday explaining a lot of this to begin with, was sharing with Elon Musk that he got this message at 3:30 in the morning Pacific time on Thursday from their operations team from the National Securities Clearing Corporation that they needed to put $3 billion up in deposit, but eventually he had negotiated that down to $700 million. But yeah, basically Musk kept on pressing him like, look, the whole thing on, well, you saw the order flow and, is something shady going on here, in which he has refuted a lot of these conspiracy theories that have been floating around. But really fascinating conversation. We've talked about it really capturing the popular zeitgeist. And here you have a major CEO, the world's richest man, also someone who's been a critic of short selling, giving the Robinhood CEO a grilling.
Yeah, Julia, there were so many interesting lines coming out of this discussion. The one thing that stood out to me, and you mentioned this in your article, was kind of going off what you were just saying with the National Security Clearing Corporation, the NSCC. Musk asked Tenev who controlled it or who was behind it. And Tenev actually defended the group's action, which stood out to me. And I thought I don't know if I would necessarily say it was surprising, but caught me off guard a little bit.
Yeah, it's interesting because I think I was trying to look into this. It's kind of like a quasi-regulator, self kind of governing body. You have these in finance, and he was like, "Look, their request was reasonable from the NSCC." But he was also, Musk was saying, "Well, if it's not really a government regulatory agency, but it's also a consortium, like who's part of this? Who gets to be part of it?" But that's kind of unclear at this point. And he kind of said to Musk, "Look, you're kind of getting into those conspiracy theories that have been floating around there." Shauna?
Actually, it's Adam. Julia LaRoche, thank you very much. An evacuee from the blizzard here in Manhattan, enjoying the sunny shores of South Florida. We're not done, though, talking about what's going on with GameStop. And we've actually heard quite a bit about this. Earlier today, Chester Spat, former SEC chief economist, joined Yahoo Finance Live to discuss how the SEC and regulators should be responding to Robinhood and other stock market apps restricting trades for certain stock.
Well, the SEC indicated late last week that it's monitoring developments, and I think that's extremely important in the current situation. Some of the issues that you were just chatting about, namely the capital needs of Robinhood and the necessity and the possible necessity of the trading limits that they imposed, are certainly something the commission staff ought to be getting a handle on and understanding. What was the nature of the capital before this happened of Robinhood? Was it inadequately capitalized? What are the restrictions that they've imposed mean? For example, restricting, I'm not sure if I understand it, but restricting the gaming stock to one share. What sort of brings about that particular restriction? I think these are all important to understand, and the regulator at the same time, may be interested in understanding whether the Redditors manipulated the markets to produce an artificial price. It seems to me all issues are on the table, but these are issues for the staff, for them to explore. These at this point, they don't seem to me to rise to the level of lawmakers already trying to do an autopsy. I think first we have to let the SEC staff do an autopsy, and only later should lawmakers be debating possible changes in the regulatory framework. First, let's see what our regulatory framework did, and why did it do that, and to what extent were the actions of the market participants appropriate?
And, Chelsea, you brought up the issue of market manipulation. I'd love if you could maybe briefly outline how the SEC goes about trying to define when a security has been manipulated, because I think there's perhaps a popular misunderstanding that discussing that a specific stock constitutes manipulation of that stock.
No, well, I certainly wouldn't think that discussing a particular stock would be manipulation. It's been a difficult issue for the commission to define. I think of manipulation in terms of attempts to create an artificial price. But I don't think just communication, for example, that this stock is undervalued because there's the potential for a short squeeze.
All right, want to check one more time where the market settled today. The S&P 500 was up 59 points. You got the Dow up 229 points, and the NASDAQ was up 332 points. Just real quick, regarding the Dow, some of the losers on the Dow today. Johnson & Johnson was off 0.25%, Home Depot down about 0.25%. We also saw 3M down about 0.5%. And then the big loser, not always, Walmart was off almost a full percent. We're going to have much more for you coming up, including Nike takes slip-on shoes to the next level. Our streetwear and sneaker correspondent Reggie Wade has the latest on Nike's Go Fly Ease shoe.
Time for your news on the move. Myanmar's military has taken control of the country in a coup after detaining civilian leader Aung San Suu Kyi and several state ministers. Now, the army announcing that it is now in power on state TV. The military claims last year's election results, where Suu Kyi's ruling party won a majority of the parliamentary seats up for grabs, was fraudulent. Myanmar's election commission has rejected the army's claims of widespread voter fraud. President Biden has also weighed in on this, saying that he plans to take, quote, appropriate action and that the leaders of the coup will be held responsible. Russian police detaining more than 5,000 people on Sunday after tens of thousands of protesters took to the streets across the country to demand the release of opposition leader Alexei Navalny. Now, Navalny's supporters are not backing down, with plans to protest in Moscow tomorrow, the day that Navalny is due in court. And here in the U.S., millions are facing heavy snow, strong winds, and coastal flooding as a powerful nor'easter hits parts of the mid-Atlantic and the Northeast region. The massive storm is expected to dump as much as 2 feet of snow here in New York City. More than 4,000 flights nationwide have so far been canceled. Well, let's talk retail. It's a big debut happening. Nike launching a brand new shoe. Now, this is a slip-on shoe, but it has a little bit of a twist. We want to bring in Reggie Wade for all of those details and who actually has the shoe here for us. Reggie?
Yes, Shauna, thank you. One of the things that I've missed most about working from home, besides seeing everyone's smiling face in the newsroom, is our unboxings. We used to take these big shoes, we used to put them up on the desk and really get a sneak peek, a good look at them. But we're going to do this virtually. So I have the new Nike FlyEase Go, the Go FlyEase. It is Nike's first ever completely hands-free shoe. And here you have them. And what really stands this out from other shoes that may be considered slip-on is it has this thing called the bistable hinge. You see, this is the open position of the shoe. So you put your foot in and then it just snaps right into place. And then when you want to get out of them, you use this kickstand back here, put your foot on it, and boom, it opens right away. This is the latest in Nike's FlyEase design. FlyEase was, of course, designed in 2015 to help people with disabilities get in and out of their shoes. And this is the next generation. And I have to tell you, this is seldom as many shoes as I look do you see a shoe and say, wow, I'm really blown away. But this is really impressive. This is blowing me away.
Hey, Reggie, I'm going to date myself here because I can go back to the original Vans on Fast Times at Ridgemont High. You mentioned helping people who might have a disability, but also, who is this shoe for? Is it for Spicoli or Mr. Hand? Is it for someone young or someone old, the teacher?
It's for everyone. I spoke with a lot of folks at Nike, especially on the design team, and they said their goal was to make a shoe for anyone, someone who has disabilities to an Olympic athlete. At first, when you look at the silhouette, it kind of favors more of a running silhouette. And the folks at Nike said it was looked at as a run shoe, but you can do a lot of different things in these shoes. And even pro fencers have even used these shoes. And I think a good kicker of this is that it has no laces here. So that's why I think it lends itself to a number of different sports. You don't have to worry about getting tripped up on those laces. And they really have Nike Zoom really embedded here in the heel. And this just gives it excellent comfort.
Reggie, I was going to say, when I first saw these shoes, I wasn't really convinced that I should be excited about it, but you're helping. Now I'm a little bit more convinced that this is something that could be a huge success maybe here for Nike going forward. But I'm curious just to get your take as we step back and take a look at Nike and how Nike has performed over the last several months. It's actually been able to weather the pandemic relatively well. I guess from your point of view, what do you think has been the strong parts for the reasons that we've seen this outperformance in Nike, and also where the company could potentially see that success going forward?
Well, Shauna, that's twofold. It's tech like this, and it's also tech within direct-to-consumer. Nike has really said, listen, we want to make a direct-to-consumer business model that's unparalleled. So when you go into the Nike stores, they just embed so much different features. There's right now in their new Nike by Eugene store, you can go in and you can actually grab a product and you can ship it right from the store. So you don't have to go back online. You can ship it right there from the store, wherever you want. So Nike is really saying that, listen, direct to consumer is what we're about. And they're really pushing the envelope. And quite frankly, they're doing it better than anybody else right now.
Reggie, that shoe had me at hello because I suffer from middle-aged man disease. When I throw out my back, that thing's going to be a godsend. I'm curious, though, are we going to have that shoe on in 10 years as a collector item? Is it the kind of thing that will get the collectors excited?
You know what? That remains to be seen. As a sneakerhead, I'm kind of digging this. I always liked the unique stuff. I asked folks at Nike, is this going to be the future? Will we see this technology in a Jordan shoe or in another type of shoe? And they said, we don't want to give anything away, but we might. So I think that's based on whether they integrate this in other tech. If this becomes really common, then I don't think it would be a collector's item. But if this is as far as they go with it, I think definitely.
Reggie, two-part question here. One, if I missed the price, how much do these shoes cost? And two, is this something that Nike is just targeting for here in the U.S., or is it more of a global marketing event specifically with this shoe?
This shoe retails for $120, and right now, February 1st, it is on sale, but only for select Nike members, and that is through the Nike app. Later this spring, they'll have a more worldwide release.
All right, Reggie Wade giving us all the details that we need to know about Nike's brand new shoe. All right, Reggie Wade, thanks so much for joining us. Coming up next year on Yahoo Finance Live, we'll take you through the next couple of days of trading and what's really standing out to us just in terms of what you need to watch. We're back with that in just 2 minutes.
And welcome back to Yahoo Finance Live. As we take a look at where we're going to be heading tomorrow and for the rest of the week, just want to remind you that the markets closed higher today with the Dow up about 229 points. Shauna, before I bore everybody with what I'm going to look at tomorrow, what do you got on your plate?
Well, I might bore everyone too, but we're going to be looking at the two big tech earnings that are set to take place after the bell. Of course, we're going to bring you those numbers as soon as they cross. First up, Amazon. We were talking about it with one of our guests earlier this afternoon, but Amazon has clearly been a beneficiary of the pandemic. The stock has continued to outperform. So the big question is whether or not the outperformance will continue, not only for the past quarter, but also into 2021. So any information on guidance is something that investors will be closely watching. Then, of course, whether or not the company has another blockbuster quarter. Regulation will be something that we're not necessarily expecting executives to comment on, but if analysts do bring up that question during the earnings call, that of course will be of note for investors here. The other big name, Google, and Google will be interesting, especially in the wake of what we heard from Facebook last week. And that of course is the fact that Facebook warned about significant uncertainty when it comes to its ad business this year. So Google and Facebook's, although their ad businesses is not necessarily an apples to apples comparison, it does beg the question as to whether or not, in terms of the larger picture, if it's going to be a tough environment for online advertisers. Adam, how about you?
I want to let everyone know we have that exclusive interview tomorrow, 3:30 with Ed Bastian, CEO of Delta Airlines. And one of the things we're going to talk about with Ed is that during fourth quarter, when they reported, they generated 12% more total revenue on 9% less sellable capacity. Remember, they still block the middle seat than the average of United Airlines, American Airlines. So we're going to keep an eye on that and ask him, because some of the other CEOs are saying at the airlines, time to go back to Congress for another round of assistance. Remember, they've had two versions of the payroll support program. So we're going to see what Ed Bastian has to say about that, but we're also going to get his opinion and the efforts that Delta has made, because this is Black History Month. He's been making an effort for a year now to make Delta more inclusive and more diverse. We're going to talk to him about that as well. But Sean, I got to ask you, because that's what we're looking at for tomorrow and for the rest of the week. But we had Jordan Belfort on the program today. I mean, this is the guy who was the author of The Wolf of Wall Street. As everyone knows, he pled guilty to stealing hundreds of millions of dollars from his clients, 1,500 of them. I mean, he's a convicted felon. I asked him, will Robinhood make it because of the GameStop issue? And he said, toast, I think. Were you taken back when he said that?
I was taken aback that it was such a definitive answer, because I think that's a question that everyone has been asking themselves over the last several days. And I don't know if we can necessarily conclude at this point whether or not they will be toast. Of course, Robinhood CEO, he has come on Yahoo Finance a couple of times over the past several trading days. He has made a number of appearances basically saying that Robinhood will be fine, that they will be able to make changes to their business model in order to ensure that something like this never happens again. But I also think, Adam, the other thing that Jordan Belfort said that really stuck out to me was just his warning almost to retail investors out there. He was saying, I understand why you're getting so excited. I understand why this is happening. It's retail investors versus the hedge funds. But he's also saying that you need to be careful, because you also have to remember that things like this, they don't go on forever. They do come to an end. And in that, he said, it's when that happens, it's going to be like catching a falling knife. You don't want to be the last person that is basically left here holding GameStop shares or holding AMC shares, when there's lots of questions. And clearly, when you look at it, the fundamentals do not add up to where the stock prices are today, or really as they've been trading for the last several trading days.
And when we were talking with him about the potential for a pump and dump kind of scheme, I mean, takes one to know one. That's what they were doing at Stratton Oakmont back in the 1990s. So we're going to post the interview with Jordan Belfort. We're going to write that up for you as well, so you can watch that, because forget his past. Well, don't forget it, but take it with a grain of salt. He has some insight that you're going to want to pay attention to. But something else to pay attention to is where we settled in the markets today. The S&P 500 was up 59 points. The Dow was up 229 points, and the NASDAQ was up 332 points. We don't always include it, but we should. The Russell 2000, remember, a lot of our guests have been talking about the shift to small cap stocks. Russell 2000 up 52 points today. And one thing, as we get ready for the stimulus talks, crude oil closed today up about 2.6%. Much more for you on Yahoo Finance Live tomorrow. Have a great evening.